Me, my colleagues Nigel and Rima. Guys, hi, morning.
Morning.
Hi, morning. Looks like it's going to be a good session. Wall Street at record highs. Brent crude prices sub $80 per barrel. GIFT Nifty is up 150 points. RBI MPC decision will be out at 10 a.m. But perhaps since we're not expecting too much, it could be a bit of a sideshow.
Rima is greening.
I'm greening. Green's the color, my friend.
Well, that's right. Setup's good. And then the last half an hour now always has a bit of spice. So let's see how that goes.
Not today, Nigel. Today is going to be nothing. It's going to be a boring day because there's no expiry. So tomorrow is going to be the action-packed kind of day, like yesterday, because yesterday was expiry as well. Let's take it from the top in terms of where we are at in terms of the session. So oil fell to 79 and we're at 79. I mean, basically the high yesterday was 86. The news basically coming through, and this is Treasury Secretary Scott Bessent, U.S. Treasury Secretary Scott Bessent saying that U.S. could reach a deal with Iran to open the Strait of Hormuz today or tomorrow. That is the comment. And we'll play out that soundbite. You can hear it straight from him. This was an interview to our network, CNBC. And Qatar is saying that the proposal has been drafted. Iran has essentially constantly been saying that, we're in talks with Oman. Remember, the Strait of Hormuz, on one side there is Iran, the other side there is Oman, and both have been in talks. Now, the problem is this, at least to my mind, is that Iran's fundamental position has been that the Strait of Hormuz is under our control. We will charge a toll. If you remember last time around as well, I mean, it all went well and the agreement was signed. 3 weeks later, oil prices fell to 70, and 3 weeks later, both sides realized that, well, what they signed on perhaps is not what the other side agreed to. So how is that going to get resolved? Is that basic fundamental issue? Is Iran going to essentially say that, well, we don't need it? If you can move that graphic to what Scott Bessent said, the line before this, I think that's the more useful line. So that's the point. I mean, is Iran essentially going to give up its demand with regards to the Strait of Hormuz? So far, they've said, well, there's no way we're going to negotiate on that. The other demands can be worked around. I mean, for example, if Iran says, and this was part of the agreement last time around as well, that, this is, here's whatever, $200 billion, $300 billion, this is our money which was frozen. We want this on day zero of the agreement. That perhaps still one can think is possible. But this is something which we'll have to see. Maybe they find a workaround, but we've been here before. But to be fair, prices did react. I mean, we got 70 for a while, and then we went back above 100. Now, U.S. equities, that's the other leg, which is doing very well. Equities rallied back to a new all-time high for the first time since June, and 2.6 higher on the Nasdaq. There's a big one. And, of course, the Philadelphia Semiconductor Index was up 6.6%. So, this is a pretty solid stuff. The entire correction seems to be, we'll see if this is a completely durable turn, but these are very strong pullbacks we are seeing. Treasuries also rallied, which means yields fell between 4 to 6 basis points. The 2-year the yield is back below 4.2%. So bond markets are also, heaving a sigh of relief in that sense. And tonight, later, you have the ADP number, that's a private payroll number. You also have the ISM services data. The manufacturing number, of course, was pretty strong. Just a couple of single stock action. Palantir jumped 29%. And remember, Alex Karp, the CEO of Palantir, essentially is the one who started this entire debate about whether we should give all this agency data, everything to frontier models. And of course, he's been sort of, has been pretty vocal about it. But Palantir was up big time. Quarterly revenues nearly doubled, and they raised their outlook. Caterpillar was up 5.6%. They reported a 35% jump in construction sales. Again, I mean, what is Caterpillar talking about? What is the reason for this? It is data center construction in the US, which they're talking about. SpaceX reported numbers, and after market hours, the stock is down 7%, although numbers were a beat, but they've kind of announced big spends on AI and very large spends on AI, which I guess, like in the case of Alphabet, the market did not like, at least not immediately. We just, once again, just to tie in the levels here, I'm looking at and plotting the levels like yesterday on the Nifty futures. There's no other way to do it. Either you basically, for all purposes, right, for derivative strategies, for technical strategies, you've got to look at either the Nifty price as of the close of 315, or you look at the Nifty futures price. So because the 330 price is meaningless in that sense, for those purposes. So again, I'm looking at the Nifty futures prices. And if I can, the spot price, the Nifty spot yesterday at 315 left off at 24,463. And at 3:30, that price was 24,615. So there was a 160-odd point jump which came through. And as a result of that, I mean, and I think we discussed this yesterday, option prices, etc., all went up and down. So based on all of this, right, that's basically what happened. Look at that. I mean, premium went into discount. Futures premium went into a discount. 24,614 and 24,555 on futures. So the resistance on the Nifty futures, I mean, this is a extension level, stands at 24,980. Because, I mean, we can look at near-term levels, recent highs, etc. But that's the bigger number. This is extension of the same number we put out yesterday as well. It's basically a projection of the last rise that we've seen. You project it on top of where we are right now, and 24,980 is that level. So actually almost 25,000. Supports very immediately come in at 24,540 and then 24,350 or so. So those are levels on Nifty futures that we are looking at for the second straight day. RBI MPC policy today at 10 o'clock, and we'll hear from the RBI governor, etc. And I think like last time, last time I think the policy was on the 5th of June. It so happened that prices into that policy were very high. On the day of the policy, prices were pretty low, oil prices that is. So we'll hear from the governor in terms of what is likely, etc. But no changes expected. I mean, a neutral stance is expected to be maintained. So that's where we're at. On the rupee, I think you will have an impact of all of this. I think if you look at 1 month offshore yesterday, the rupee almost was at 95. And in all likelihood, with oil prices where they are, dollar rupee that is, I think you are going to start maybe, under 95. We'll see. But 95.37 was the close yesterday. Nigel has walked across to the wall with what's he picking up on positioning and the F&O cues. Nigel, take it away.
Well, the RBI governor's commentary is going to be tracked today. And as you said, it'll have an impact on the money market in particular. But overnight, the troika is very well behaved. You have Brent crude prices that are lower because hopefully the passage of oil is smoother. The dollar index has cooled off a little bit. It's sub that 100. Remember, a few trading sessions ago, it was at around 101.5. And the US yields as well have cooled off. So the troika is well behaved, and you like that. The rupee additionally has shown some stability. Besides other cues, well, that's what's helped the FIs to turn positive. And even in yesterday's trading session, the FI showed some money. Remember, there were some large trades as well, so you need to keep that in mind. But otherwise, more or less for the last month or so, the FI flows have either been flattish or mildly positive, which is heartening to see after the kind of selling that we've seen. Now, the closing auction session needs to be tracked as always. Well, one positive is that at least the volatility in that session yesterday was a little lower than the previous one. That was on Monday. And hopefully participation is more balanced, which in turn will iron out all of those rough edges. So that's the hope for the time being. The Nifty is trading at a bit of a discount, but that is lower in comparison to the previous trading sessions. Hopefully those rough edges gradually get ironed out as more participation comes in and more balanced participation comes in. Well, moving to the FI action on the future space, well, they added some mild shorts. They continue to remain net short with close to around 87% of their positions on the short side. But if you look at it, both on the index as well as on stocks, they went ahead and they added some shorts. They remain net short, but in absolute terms, the short positioning has come down closer to around 155,000 contracts, which is much lower than what we've seen earlier this year of around 270,000 contracts or thereabouts. Well, moving to the options data then. The PCR, that was getting to the upper end of the range. It had moved to around 1.45 yesterday. That's cooled off yesterday to around 0.85 and it ended closer to around 1. So that's telling you that that adjustment has taken place. Normally, when the PCR moves to around 1.6, you see some consolidation or some kind of profit taking. For the time being, we'll take it as some kind of consolidation, and PCR cooling off to 1 is good news. Moving to the options data, there's a mix of activity out here. So the 24,800 call, that's seeing some buying interest. But the premium has moved to around 45 rupees or thereabouts. So all you lose is around 45 rupees. However, the smarter money seems to be writing the 24,600 call, which is telling you those bears believe that they can defend the 24,750 odd mark, which is exactly where the 200 DMA is at. So it appears that the bears will come in to fight for this 200 DMA or thereabouts. But I think in terms of a reference point, the recent low at around 24,300, that becomes a bit of a reference point going by the options data. So we're bracing for a good trading session. Let's see how the volatility goes as the course of the day goes. But otherwise, we're waking up to far more positive cues, and the Indian markets have been in good rhythm. I expect that trend to continue.
Well, indeed, the handover has been fairly constructive, and even some of the big earnings that we were tracking post-market hours were positive, whether it's Bharti, Marico or Nykaa, which gives you the consumption flavor. But back to the macro overlay, the big story is the decline in crude prices. Brent crude is now sub $80 per barrel. When we closed, closing bell yesterday's trading session, Brent was at $86 per barrel. So compared to that, there is a sharp decline, and the reason is Strait of Hormuz reopening optimism. So diplomatic efforts to reopen the Strait of Hormuz are ramping up, with Iran saying talks with Oman are proceeding positively. U.S. Treasury of State Marco Rubio also reported progress in talks on the strait, while Treasury Secretary Scott Bessent, speaking to CNBC, said an agreement could be possible as early as today or tomorrow to reopen the Strait of Hormuz, and there will be freedom of movement. Basically, no tolls. Listen in.
We are in talks with the Iranians, and I think there is a chance we may have a deal today or tomorrow to open the strait and move towards a more normalized position in this conflict.
The idea of having a deal today or tomorrow to reopen the strait, would that be reopening the strait, but the Iranians somehow having the ability to charge a toll on that? Or would that be reopening the strait and it's free and clear and anybody can move through?
I think it would be freedom of movement. And even though things are still a little dicey there over the past few days, we've saw quite a few ships coming out even now. So, I'd expect the energy prices to settle back down, which, as I said, will be good for the entire world.
I think that there's a conversation and negotiation that we are involved in between Oman and Iran on how more ships can be able to go through there safely in the short term as we move towards these longer term talks about denuclearization. And suffice it to say, there's been progress made in those talks, but not finality yet. We're hoping that will happen very shortly.
Richard Yetsenga, Group Chief Economist at ANZ Research, is now joining us on the show. Richard, thank you very much for joining in. Good morning. How are you reading the possibility of a deal between US and Iran? What are the signals that you are picking up on the macro front?
Well, it's another chiropractor moment, isn't it? It wasn't that long ago we were at 70 in Brent spot terms, and then we were at 100, and now we're back at 78. So all we can do is go off, I guess, the verbiage that we're getting from the US side, even though we know historically it's probably had a bit of over-optimism about what was about to be achieved. At the end of the day, this is all noise. The supply-demand balance in the oil market needs oil to start flowing through the strait at some point. Until that happens, oil, I think, in the 70s is too low. Equally, oil above 100, I think, doesn't reflect, if you like, the political realities of the situation that both sides are in. And we've touched both sides of that range. And so far, we don't have an agreement which is concrete enough across a number of issues to say that we're going to stop this ping pong.
So what's your fair value for crude prices? You're saying in 70s is perhaps too low. So what should it trade at, given the political and the geopolitical tensions right now that we're seeing? And what does this mean for US inflation? We were talking to a guest just earlier last week, and he said the big macro risk for the market is rising bond yields, not just the US 10-year, but even the 30-year bond yield. Of course, overnight it's cooled off a bit, but generally the long-term trajectory worries him.
I have some sympathy with that. I mean, maybe back to oil. I think the market's really struggling to identify what fair value is, because we've got this kind of serious binary event. Is the strait open or not? And despite the Secretary's comments about some ships moving through, it's effectively closed. Really, and if it stays closed, that fits with oil in the 90s probably, and if it's open, it fits with oil at 80 or something of that sort of scale. But it's clear that even during the optimism of oil back at 70 a month or so ago, bond yields globally did not retrace the moves they put in over the course of this conflict. Tightening pressure didn't go away. In fact, since Fed Chair Walsh has come in, the market's always priced tightening from the Fed, regardless of what level the oil price is. And I think that says the market is concerned about the oil price move having unleashed something which is going to need central bank action to put it back into the bottle.
So if you were to put, I mean, just who knows, right, if we'll get an actual deal which works or not. Richard, what odds would you put on it that you actually get a real deal with things settled now this time around? 50%, 60%?
I think we will get a deal eventually because the global economy won't function as people currently.
Right. No, I'm saying this time around, this episode.
No, I have no view. I have a coin. I can toss it for you if you
That's
like.
what I wanted you to do. Well, anyway, yeah. What else, Richard? Because U.S. economy is running pretty hot, the large U.S. tech stocks are all back. Nasdaq's at all-time high, so it's all go.
Well, all of that does bring focus on this new Fed chair and his, if you like, transformation of the Fed. And he certainly talks a lot about a lot of things. I mean, less about what the economy is actually doing and where inflation will go and what that might imply about Fed policy, but certainly Fed communication and the balance sheet and what the market should price off and whether it should price off the Fed. I am alert that what he's doing is allowing the market to drift away in its focus from the Fed's core tenet from a macro sense, which is 2% inflation, 2% inflation, 2% inflation. We haven't been there for 5 years. The recent numbers don't suggest movement back there. I mean, they don't suggest inflation is getting worse, but they don't suggest movement back here there. And yet the Fed chair seems confident that 2% is still the target, but won't talk about policy action.
So, Richard, if 2% has not been met for years, and they've not done nothing about it to really get to 2%, and now there is this suspicion that maybe he wants to move away from 2%. So why is the market freaking out?
Well, I think you answered your own question. There's this suspicion he wants to move away from 2%. I mean, I would be surprised by that. But ultimately, central bank statements, if you like, a fiat currency, they may or may not have credibility or value. What actually is hard currency is you achieve your inflation target, and the market will give a credible central bank some time away from its target. It's temporary, but eventually that fiat currency will start to erode in value if you don't start to act to bring inflation back to target. And I think the market is starting to just say, we need to see something a bit more than what we've seen so far.
But do we get a hike later this year? If yes, what's the quantum and when?
Look, I don't have a hike in my forecast because I don't think the Fed will hike. I don't think the Fed wants to hike. And so for that reason, I think the market will remain concerned about the Fed's commitment to its inflation target.
Okay, well, Richard, thank you very much. We'll leave it there. Appreciate you joining us. Good talking to you as always. We have a macro event here in India with the Reserve Bank of India policy. 10 o'clock is when we will get the decision. We will hear from the governor as well. Lata is here with the editor's take. What should we watch, Lata?
Well, 5 points I would want to just keep in mind. One, of course, it's a no change policy. Ritu's poll also said 100%, and my Citizens Monetary Policy Committee also voted 5-0 for a status quo, and likewise on the stance. So it's going to remain a neutral stance, which gives the RBI the flexibility to go up or down as the situation, as the data warrants. So what will you watch out for? You will watch out for whether he hints at a hike in the second half. Now, there, the market is deeply divided. Ritu's poll was 60-40 in favor of a hike in the second half. In the Citizens MPC was, let us see, at the moment, no change in 26. But in FY27, which means early next year, there could be a rate hike. So that is what we will all be reading his lips. Is he sounding hawkish enough? What data will he look at to make up his mind about the next hike? That is really the most crucial statement. When it comes to data, they won't change their growth and inflation forecast is the normal expectation because they changed it in the last policy. You don't change your forecasts every policy. But if they do change, then they will have to bring down their inflation forecast. They are sitting at 5.1. The market is at about 4.7, 4.8. So the RBI clearly guided up so that, it could prepare the market. But things have not gotten so bad. And today when he's speaking, crude is actually below 80. So chances are they are not going to change the forecast. If they do, the CPI will have to be brought down, Growth forecast is sitting at 6.7. First quarter was 6.6, their forecast. It definitely has to be pushed up. Look at the auto sales. Look at the credit growth numbers. So if growth is changed, it will be up and inflation will be down, which will be very good for the market. But chances are they won't do that at all. And finally, everybody will watch out for any update on dollar. The FCNR ECB flows, the update we just got on July 31. But people will have questions around that. And moreover, what do you do when this 40 billion becomes 80 billion by September 30? That's a lot of rupees when the dollar is exchanged for currency. So any liquidity management steps, even that he may dodge, saying that who is to say there's 80 billion? So probably this policy is all about watching what he will do in the next policy. Today itself, I think it will be, for the markets, not a very big event.
Thank you very much for that, Lata. This will begin at 10 o'clock. Our coverage will start at 9:45. But till then, let me tell you the interactions on the show today. So coming up 8:35, the management of MapMy India will discuss the June quarter earnings. 9 a.m., Abneesh Roy of Nuvama Institutional Equities will focus on UBL, Marico and more. 9:20, Dheeraj Agarwal of Ambit Investment Managers will be a market master for the day. 9:30, the management of Uno Minda joins in. And following that, the management of Glenmark Pharma will chat with us at 9:40. And then at 9:45, we go and speak to a slew of experts ahead of RBI Governor Sanjay Malhotra's MPC address.
Well, time to slip into a short break. We've got a lot of stock-specific action they're going to be tracking in a special top 10 segment. For the time being, I'll run you through the list. ONGC, Bharti Airtel, Marico, Nykaa, United Breweries, Deepak Nitrite, as well as Ask Auto. While on the flip side, you'll have MCX as well as Kalyan Jewellers that will be reacting to negative news flow. And PNB Housing could expect a mixed reaction on that one. Take that break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk about stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, everyone. Sonal, let me begin with you. ONGC?
Strong set of numbers. We've been talking about higher crude oil prices, and that is what aided earnings for the company. It was a beat on all parameters on a quarter-on-quarter basis. The revenues were up 29%. EBITDA more than doubled to come in at 28,355 crore rupees. Margins also doubled to levels of 61% versus 35%, and profits came in above estimates at 17,034 crore rupees. A lot of it was led by crude oil realizations coming in at $99.5 per barrel. The estimates were anywhere between 92 to 95. The share of new well gas also reached 38% of the total revenues from nomination fields, and these are the wells where pricing is much higher at a premium versus APM gas, and that is where the profits also came in from. And oil and gas production remained flat during quarter one after declining for quarters, so that is a positive sign as well. So going with green for ONGC, if it or it doesn't react to lower crude oil prices that we are seeing currently.
Let's go to all right. Thank you very much for that. Let me take the next one up, and that's Bharti Airtel, and it's a good set of numbers ahead of expectations. The company's consolidated revenue growth was up 5.7% quarter-on-quarter. EBITDA margin steady at 56.9%. Airtel Africa numbers were strong, very strong, but we already knew that. So we were watching for the India mobile performance, and that has positively surprised. So the India mobile business, that's the B2C numbers that we look at, revenues went up 3.8% quarter-on-quarter, ahead of estimates and ahead of its peer Reliance Jio. And this was driven by a very strong increase in average revenue per user. So the expectation was that the ARPU increase would be 1.5% because there was no headline tariff increase. But the company managed to actually increase their ARPUs by 2.7% on a quarter-on-quarter basis. One of the analysts I spoke to indicated that perhaps it could be due to some of these sporting events like the World Cup, etc., and people wanted to increase the data plans, and that may have led to some migration, and therefore the ARPU was higher this time around. So that was a big positive. Net debt to trailing 12-month EBITDA also declined from 1.42 times to 1.26 times. So all in all, it's a good set of numbers from Bharti Airtel. But let me now go across to Mangala. Mangala, Marico's numbers. We have the cheat sheet, the quarterly update. So compared to that, how did the numbers look?
Even better, Rima. The cheat sheet told you that these numbers are good, but the actual numbers told you that they're better than what the street was expecting as well. Solid set. Revenue growth of 23%. Net profit and EBITDA actually the highest growth that we've seen in the last 28 quarters. So revenues coming closer to 4,000 crore. The number was closer to 3,900 crores that we were expecting. EBITDA 819 crore versus expectations of 776 crores. And the net profit at 652 crores beats expectations of 587 crores as well. Domestic volume growth came in at 11%. This is a mild miss as against expectations, but no real worries out there because a large part of that is from the commoditized business. The volume growth by itself is the highest that we've seen in the last 20 quarters. It's been led by 10% growth in Parachute. Value-added hair oils grew 22%. Saffola edible oils, that's where there was a volume decline, and that's caused a bit of a miss, but that's no problems because the foods portfolio, which is the mainstay of the company, has grown 43%. And the outlook is also fairly strong. They will expect high single-digit volume growth in FY27. Double-digit revenue growth in this year, crossing 15,000 crore on the top line with high teens EBITDA growth. So all things point towards green.
Right. Well, thanks very much, Mangalam, for that. But, Nykaa is the next one, so it's right back to you. And I think this is a pretty good set.
A pretty good set. Let's put it that way, Prashant. 29% revenue growth, 68% growth in the EBITDA, and the net profit on a low base jumps by about 227% as well. Going into the numbers, the smidge of a recovery was the last hour, but remember the internals there as well. Beauty business growing at 27% in the revenue, 65% growth in their EBIT, margins expanding out there. Fashion as well, 48%. We had the cheat sheet for Nykaa too. The stock rallied thereafter, but these internals look fairly strong. And add to all of this, they've made an acquisition as well, 51% majority stake in a company called Aminu for about 32 crores. This company had about 19 crores in sales, but it's been growing extremely fast. And we've seen what Nykaa did with the Dot & Key acquisition. If this is one of them, then it'll be another growth driver for the company. So going with green, if not pink, for Nykaa today.
Nicely put. Thank you very much for that. Let's go across now to Devyani for MCX.
Well, MCX reported a weak set of numbers in quarter one of FY27 on a quarter-on-quarter perspective, but that was largely expected by the street. Now, transaction revenue fell, led by a significant cool-off that was seen in volatility against Q4, which was a high base, where gold and silver both reached all-time highs, and the volatility was high on the back of the West Asia disruption. Now, F&O average daily turnover still came in strong at 10.5 lakh crores, but revenue fell 21% quarter-on-quarter to 702 crores. Now, EBITDA fell sharper to 494 crores, down 26% quarter-on-quarter, with margins dropping 460 basis points this time. And PAT fell 22%, but that was slightly cushioned by higher other income this time around. All in all, a weak set of numbers quarter-on-quarter, going with the red on MCX in trade today.
All right, let's hop across to Mangalam. He's here to tell us now about some more exciting stocks, United Breweries and Kalyan Jewellers, the big mover of the last few months.
Let's talk about Kalyan Jewellers first, Nigel. The revenue's very strong. We knew about that, and the stock has seen a big move also. Though I expect the stock to see some red today, largely because the margins were a little shy of expectations. The EBITDA margin came in at 6% versus 7%. The revenue grew 25% despite a 46% jump. Rather, the EBITDA grew at 25% despite a 46% jump in the revenue. And the company said the gross margins have been impacted by higher proportion of exchange gold, which actually jumped all the way up to 46% versus 30% same time last year. And the share of revenue from franchised operations also increased by about 57%. And the EBITDA has a slight miss despite a 41 crore one-off gain coming in on import duty hike during the quarter. But then again, remember, the jewelry players are in a strong footing, so any decline in the stock may see some sort of recovery. But for now, I'm going with red on Kalyan Jewellers. Can't say the same for United Breweries, though. It was a longish summer, and the volume growth of the company has been 9% versus expected 5 to 8%. So a lot of beer was consumed, but a large part of that was not the premium beer, but popular beer. The overall revenue coming in at 3,065 crores, the EBITDA largely in line. Net profit had an element of other income support as well. So that's why it's a slight beat on expectations. But premium segment, there the volumes grew just 7% versus expected 12 to 13%. In that, one particular business is doing extremely well. That is Heineken Silver, that grew upwards of 28% in revenue. But by and large, going with mild green on United Breweries.
Okay, all right, Mangalam, thank you very much. Busy day once again for you. PNB Housing is also going to be in focus. There's a bit of a miss as far as margins are concerned. Actually, a pretty decent miss on margins. But in terms of the rest of the stuff, numbers look okay. Ananya is here with details. Ananya, take it away.
Well, yes, miss on margins, but operationally in line or stable quarter, we can say. The growth was healthy. Loan AUM, if you see, it grew 15% and NII grew 6%, PPOP rose 9% and PAT increased 4%. But if you look sequentially, it was down around 15%. It was mainly because of the margins, as I mentioned. It fell 19 basis point quarter on quarter and 24 basis point on year-on-year basis to 3.5%. While ROA and ROE also moderated. Your yield remains stable quarter on quarter, but if you see year on year, it also moderated to 60 basis point. Now, asset quality, however, it remains strong with GNPA at 0.95% and NNPA at 0.58%, both still better year on year. Credit costs continue to stay negative, led by recoveries. Now, recoveries from the written-off pools stood at 67 crore here. Now, the con call is also currently going on, started at 8. The management mentioned that Q2 will be better than Q1, and we can see margins and gross NPAs improving in Q2, so we'll watch out for that also.
And we'll let you get back to that conference call to try and glean more details. Thank you very much for that, Ananya. It's over to Sudarshan now for Deepak Nitrite and ASK Auto.
So it's a blockbuster quarter as far as Deepak Nitrite is concerned, led by the phenolic segment, which is the biggest contributor to the company. And there we have seen an increase of 36% in revenue, and EBIT has seen a jump of almost 255%. And the growth drivers, favorable product spreads, firm realizations, and also stable volume offtake. Another segment that company has is of advanced intermediate. Their revenue has increased by 33%, and EBIT here too has seen a jump of almost 91%. If you talk about the overall numbers, revenue has increased by 35%. EBITDA has seen a jump of almost 160%, and margin has doubled to 21.4%. Next on the ASK Auto, good quarter, highest ever revenue, highest ever EBITDA, and highest ever profit company has reported. All the segments have seen a revenue growth of more than 20%, and their overall revenue has seen a jump of 52%. But if you include pass-through impact of alloy price, revenue there has jump of 25%. Margin has come at 11.8% versus 13.4%. If you talk about the segments, advanced braking systems, revenue revenue growth of 48%, aluminum lightweighting precision up 75%, and safety control cables up 20%. So going with green for both Deepak Nitrite and Ascoto.
Thank you very much for that. And so many other stocks that you can see at the ticker desk. I mean, on the ticker, Avalon Tech, Sheela Foams. Keep your eye on those as well. There's one more news which we'll discuss with Yash. The Supreme Court has increased the mandatory period for third-party motor insurance. So for two-wheelers, it's gone up from 5 to 6 years. For four-wheelers, from 3 to 4 years. And that will put the spotlight on a name like ICICI Lombard, which has the highest market share in the third-party motor insurance. So we'll discuss this stock in greater detail. Even Go Digit should be in focus. But it's going to be a busy day, lots of individual stocks, but the big ones, the ones with big news are ONGC, Bharti Airtel, Marico, Nykaa, United Breweries, Deepak Nitrite, ASK Auto. According to our analysis, these should open up in the green. Stocks with negative news flow are MCX and Kalyan Jewellers. We've got a mixed view coming through on PNB Housing Finance. Get into a break. On the other side, the management of MapMy India will join in to talk about the Q1 numbers and the way forward. Welcome back. Let's invite the first corporate on the show, MapMy India or CE Info Systems. The company reported a decent set of Q1 numbers, consolidated revenue growth at 14% year-on-year, but margins were impacted by a one-time write-off of 4 crores. That's the reason why EBITDA margins came in at 40% versus 46% in the comparable quarter of last year. Rohan Verma, Joint Managing Director of MapMy India, Mapples, is now joining in. Rohan, thank you very much for joining in. In a seasonally weak quarter, you've delivered about a 14% growth. Why are you not giving an FY27 quantitative hard guidance as you used to in the past? And are you on track to achieve the 1,000 crore top line by FY28? Does that at least hold?
Hi, good morning. Thank you for having me. Yeah, Q1 was a good quarter. We continue to grow year on year. And the revenue visibility is there. I mean, with the open order book that we disclosed, which moved from 1,500 odd to 1,750 crore odd, end of FY26, it gives us good visibility into the strength of our growth this year. So no specific guidance that we give on a quarterly or for the year basis, but things are looking good. Start is good and open order book is strong.
And the 1,000 crore revenue target by FY28?
We're working towards it. I mean, as you'll keep seeing how each quarter develops. So.
Okay. When you're working towards it, or are you confident about achieving it?
I mean, I think the best thing is to see what we do on a quarter basis. I mean, like I said, with the 1750 crore order book, with a strong funnel, new orders coming in, I mean, business is looking strong, but on a quantitative basis, I'd like to hold off right now till we're closer to that time.
Rohan, morning. And I think this is the first time we're talking since you've... I'm not sure whether we've had a conversation after you took over and in that sense, the reappointment, right? Back at the helm of things. So congratulations. So just give us a sense of what the numbers will look like. I mean, what's the visibility aspiration that you have for 27, the year we are in, and FY28 as well? I mean, I think the big headline numbers will help, Rohan.
Yeah, Prashant, I mean, as I said, we've been working hard and the open order book is there of 1750 crores. Q1, we hit about 140 odd crores with a EBITDA margin of 40+%. And I mean, I think that's going to hold us in good stead. I won't be able to give specific quarter numbers or year numbers, but the trajectory is looking very good.
Hi, Rohan. Good to see you. And Rohan, this 1,000 crores will be what, organic, or you're factoring in some inorganic growth as well? Because you're sitting on good cash.
Yeah, we're sitting on good cash. I think cash is now 745 crores.
Correct.
Crores in the last quarter. And so we have the optionality, both organic and inorganic, to grow. There's anyways a bunch of growth bets that we're doing organically, which we've been focused on for the last few years.
Okay.
Inorganic is also an opportunity, but
Rohan, this 1,000 crores aspiration is factoring in some inorganic, or it is all organic? That's what I want to ask you.
If you look at MapMyIndia, it's a multi-product, multi-industry, multi-use case company. There are lots of growth opportunities for us, both organically and inorganically. I think that we take a call at any point of time what is right for the business. So it's not that, that is factoring or not factoring in. It's just that based on the opportunity ahead for us and the plans that we have, we do see strong visibility into the future, and we'll take the right decision at the right time.
Rohan, most of your revenues today come in from the automotive sector and the enterprise sector, where you provide maps to, say, banks, consumer companies. But you are increasingly focused on the government business, so whether it's defense, oil and gas, GovTech, digital twin, etc. What is the current revenue contribution of the government business to your top line? And what is the aspiration here? What can that scale up to 3 years, 5 years down the line?
Sure. See, on a yearly basis, last year it was, I think, around, I want to say around 18 to 20%. And in this quarter, government was 12%. Out of the 42 was automotive and 46 was enterprise. About 12% was government. But Q1 is generally slow for the government. It kind of builds up over the course of the year. So, I mean, I think, it will be in that range typically of about 20%. But then also we are kind of selective about what type of orders we take, based on kind of payment schedules and type of projects, etc. So we're calibrated, but we see a lot of opportunities. Like last year, defense and oil and gas were kind of two big kind of breakout segments for us from a market penetration point of view, green shoots, and that kind of will hold us in good stead. We continue to have bunch more wins in defense and oil and gas, some that we kind of reported in this earnings presentation as well.
Okay. There was a write-off of, some of the receivables, close to about 4 crore. I think the last update that we have is your receivables stand at 176 crore. Is that the correct number as of Q1? And are you confident about getting them back, about collections, or is there a risk of a further write-off? How do you feel about the receivables and the number?
Yeah, this specific customer in government, we ultimately felt that, look, we're not going to receive it. So we wrote it off just so that instead of postponing it, that had an effect on EBITDA margin, as we explained. Receivables is something we look at carefully as well. I mean, majority of our receivables is from government, but not like a large majority, and aging is okay. So it's in that sense controlled. But yes, as any other company which is engaging in government, I think we have to be careful, and that's what we keep our eyes on. Compared to peers, I mean, I think our receivable days are significantly better.
Rohan, I had a slightly broader question, but I think a lot of people who've tracked this company for the last 10 years, I mean, I've heard, this coming up. You're not running things now, right? I mean, solely and wholly in that sense. You got the company behind you?
No, Prashant. I'm joint MD. I report to our CMD, my father. I look after the public sector, the government business, and the IoT business, after those two subsidiaries. And in the listed company, I look after like our AI native initiatives and marketing. And generally, I provide support where the company needs. I've been CEO in the past. So wherever the leaders in the automotive and enterprise business need, or the other tech domains need.
Sure. I don't know if this is appropriate to ask you at this point, but is there a line in sight for you to step into your father's shoes as the CEO?
So I think this is a really good blend of experience and youth, and the wisdom and kind of tech focus. So I think we're really sorted from a organization point of view with the founders kind of there and the next generation at all levels. There's succession at all levels in our company, but the fact that we can leverage the experience and expertise of 30 plus years, and then 20 plus years, and then 10 plus years, and 5 plus years, and then now the Gen Z, which is really bringing in an energy into the company. I think that's what keeps us at the cutting edge of deep tech, but at the same time at the fiscal prudence of kind of the old school, make sure you're profitable, growing, and cash generating.
Okay. Rohan, we'll leave you there. Thank you very much. Good luck as you execute and appreciate your time here on CNBC TV 18. Well,
thanks, Prashant.
We'll track the numbers. We'll track, what comes out of MAPMA India over the next few quarters as well. Well, we'll take a break. We're back. Some volume buzzers. We'll connect with Devin Chokshi of DR Chokshi FinServe as well for some fundamental stock conversation coming up.
Welcome back. Hope you're having a good morning. Well, it's that part of the show when Harmesh joins us to tell us about some of the big movers yesterday and some of them that were backed by delivery. Harmesh?
Morning, Nigel. And of course, the conversation around the closing auction session continues. And yesterday, there was a marginal increase as well seen in the turnover. But look at the top 5 names. Yesterday, Infosys had a 100 crore turnover yesterday during the cash. And the reference price ended above the reference price. ICICI Bank too closed well above its reference price, had a turnover of close to around 85 crore. Bharti Airtel, of course, will be reacting to results. That one saw a bigger reaction. The reference price was around 1950, closed at around 1970, and turnovers of close to 77 crore here as well. The Reliance Industries was another one. There was no significant change there in comparison to the reference price, but considering the weightage had a significant turnover. And HDFC Bank too, continuing to remain near its 52-week lows, saw turnovers of close to 60 crore. But there were stocks that did well yesterday beyond the cash, and Ather Energy was one such name. Result reaction, a double-digit gain as well for the stock. 2.5 crore shares were traded yesterday. The 20-day average is only 47 lakh shares. And 20% of those shares were marked for delivery. So close to 50 lakh shares were marked for delivery. The 20-day average is only 13 lakh shares as well. Another positive result reaction was KEI. Stock ended almost 10% higher yesterday. Close to 40 lakh shares were traded. The 20-day average is only 3 lakh shares. So significantly higher volumes compared to the 20-day average. 19% of those shares were marked for delivery. So close to 7 lakh shares on the delivery front. Here too, the 20-day average is only 1.5 lakh. And lastly, a negative reaction yesterday coming in from UPL. The stock was down around 6.5% yesterday. Close to 75 lakh shares were traded, almost 4x the 20-day average. And a third of those shares were marked for delivery. So around 26 lakh shares on the delivery front. Also the 20-day average being around 10 lakh shares for UPL.
Okay, all right. Thanks a lot for that, Hormuz. Well, Devin Choksi, MD of DR Choksi FinServ, joins us on the show. Hi, Devin. Good morning. Good to see you, Ben. Devin, a couple of government-owned companies I wanted to ask you about. One, ONGC, which has been a bit of an underperformer, came out with a set of numbers. And the other one is LIC. What do you do on that one?
Good morning, Nigel. Well, I think the government-owned companies, they normally don't end up giving rewards to the investors. The government companies are definitely good businesses. I think no doubt about it. At the same time, I think and growth is also continuing in the business. But as far as I think the reward to investors is concerned, I think it is far less. Look at, I think, likes of LIC. It's a good company. Definitely, I think fundamentals are absolutely very strong and convincing in the insurance business. However, I think because of the supply of the paper, certainly, I think the market is not going to be comfortable buying this particular stock beyond a point. Today, it is available, I think, discounted rate. To that extent, I think the comfort is there. But otherwise, I think from the point of view of investment, I don't think that I think we'll have definitely better options compared to PSUs as far as portfolio investment is concerned.
Okay, all right. Well, there are a couple of good earnings, though, that we saw. Nykaa was one such number. What's your view on that stock?
Not honestly done, I think, a very deep dive into the numbers. Those numbers, I think, are showing a distinct recovery. And at the same time, I think on-branded portfolios are also showing up in the performance as far as the company is concerned. But it would take some time to dissect the numbers and then probably, I think, come up with a firm view on the subject.
Okay, all right. Kalyan Jewellers, one of the stocks that rallied from 400 to around 640, if I remember that high. Last few days, getting into its earnings, actually, there was some kind of profit taking. I think the stock ended yesterday closer to around the 600, a little less than that. Bulk of the good news in the price, or do you think it can scale the highs that we've seen earlier, 900 rupees or thereabouts? From there, it went ahead and it became a third of what it was at its peak.
Given the fact that the company earns handsomely on the capital employed, and that's where probably you see the larger amount of following also with conviction from most of the portfolio investors. So definitely the buying opportunity is best when the market is in correction mode. Chasing the value at this point of time probably may affect the investment portfolio. That's what my viewpoint would be. So maybe I would always want to buy during the correction, not immediately.
Got it. All right. So you want to buy it post the correction. Other stock that we've been talking about yesterday as well as today is Ather Energy. What marvels me is that the bikes are not cheap, at around 1.5, 1.6 if I compare it with other, two-wheelers. But people are willing to load on even their software because they believe it's special. So they're spending another 18,000 rupees. which is telling you that people don't mind paying for quality and something that will hold them in good stead. But the stock that listed around 300 rupees is close to 1450. Now, what would you do with the stock? Will you talk about a fresh buy because management is talking about gaining market share, gross margins moving up, or do you think bulk of the good news is in the price?
So management commentary remains, I think, absolutely very comfortable, and the kind of optimism that is being reflected with the confidence that they are having in the business, that is amazing. And at the same time, we do believe, and after having talked to some of the other EV two-wheeler companies, including Bajaj, we find that the business conditions remains absolutely robust for them. In fact, today the situation is the demand side is so strong for the EV two-wheelers that today I think they are again short of supply, and everyone is trying to put across the additional capacity for electric vehicles. From a perspective of looking at the company from investment point of view, yes, I think a good opportunity. However, would be comfortable buying at lower levels. Would not like to chase the value once again because I think most of it is that seems to be in price at current levels.
Okay, you're driving a hard bargain now, huh? Deven, you want to buy stuff at lower prices. Not.
Yeah, Nigel, I think the challenge in this market, that moment market gets some amount of stability,
Okay.
the punting starts in this market, and that's where you remain very uncomfortable in such kind of situations. So, want to definitely take a close look at the values before jumping to it. And there are plenty of other opportunities available in the market.
Yes.
So, certainly, I think that is where probably your focus should be in this kind of market situation.
Bulls, bears, and hunters.
Yes.
So, Deven, is there an opportunity in LIC at 382?
So downside risk, Rima, I think in LIC definitely I think is protected, as I was making a point earlier, because I think the kind of value at which the stock is available, embedded value to EBITDA is I think probably far more cheaper at 0.6 levels. There is no argument on the downside. I think the stock is well protecting it. The opportunity in the public sector companies, I think, is denied to a greater extent because I think the supply side situation continues. Fundamentals remain absolutely strong and convincing, but I think the muted upside as far as I think the stock is concerned in my viewpoint.
And Bharti Airtel posts numbers at 1970, Deven?
Looks convincing as before as well. I think they are on a trajectory to go up to 300 ARPU. 261 is the number that they have achieved in this quarter. So certainly with this particular run rate that they are seeing in the ARPU, they are getting the premiumization benefit coming to them. And that's where probably the upside should continue. Maybe the buying opportunity is best when some correction in the market. But otherwise, I think stock looks convincing.
Okay, Deven, very quickly, I want to ask you about these motor insurance companies. There's been a Supreme Court mandate that's changed with regard to third-party insurance as well as when you're buying a new two-wheeler. I'm looking at a note coming from AMSEC. They believe that, in fact, Go Digit could be one of the big beneficiaries. Besides that, ICICI Lombard as well as New India. They're bullish on all these three names. They believe this is going to be a big impact. Yash, my colleague, he'll be covering it in detail in just a bit from now. But any view on these motor insurance-related names?
We like the Lombard business model, frankly. I think the way in which they innovate the products and the penetration that they would have thereafter is amazing. So certainly, I think if one has to take one company out of the those you mentioned, Go did it. Of course, I think I have not understood subject enough in detail, but Lombard certainly looks, I think, much better from a perspective of looking at long term again.
Okay, all right. Deven, we have to take a quick commercial break. Thank you very much for joining us with views on all those names. It's always useful. We'll take a break. We'll be back with Abneesh Roy of Nuvama Institutional Equities. We discuss the trends in the FMCG space. Lots of numbers have come through. So Abneesh weighs in on those. Sudarshan Sukhani and Mitesh Thakkar will also join in with technical trading ideas. Okay, welcome back. You got market pre-open coming up shortly, and we'll have first rates. And I think on the rupee, dollar rupee, it should be a pretty strong start. The Nifty is starting 60 points, and the point is, the last 15-minute 150-point bump that we had, right? So 315 close was 24,615. So let's take it from there. Sorry, the 315 close was 24,463. And now the pre-open is kind of settling in slightly above, about 50 points higher as compared to the close yesterday, the 330 close yesterday. So, you got all those adjustments basically which will have to be taken place. Look at the Sensex, right? But this is first minute. Let's give it 2-3 more minutes. Dollar rupee, please, if you can have that up. Are we at the 95 handle, or maybe where are we at? We don't have a rate yet. We should. It's 9 o'clock. We'll have it shortly. Sudarshan and Mitesh are with us with what they'd want you to do as far as trades go. Sudarshan, the cash session is ramping the close higher, 200, day before 150. The only good thing is there is strong US markets to boot every night and some positivity to boot. So it's not getting all reverse in that sense. What are your trades and just way of thinking on the indices for Sudarshan?
Yeah, well, my way of thinking is I look at the 315 price and then work from there. At this point, I'm ignoring 330. And as you rightly said, it was thanks to the US markets that we are opening higher. If that were not there, we could easily have covered all the gains of the closing and opened at 24,450 again. So it's best to ignore it till there is stability. Work on 315. Now, about the index, the market is in a very strong uptrend. No matter what happens today in the RBI meeting, if there is a dip, you must buy the dip. That's the theme. You can divide your trades into two parts, have a core position. I would expect all of August to be fairly decent and bullish. And for the trading positions, sell the exit on a rally and buy on a dip. So today and tomorrow, if you get a dip and you don't have a position, go and buy the Nifty. Don't chase the gap up.
Yeah, don't chase the gap up. By the way, look at the dollar rupee. It's in the 94 handle now. From 95.30 or so yesterday, it's a big move. It's almost a 45 paisa move coming in on the dollar rupee. So we are back in that sense. After the big drop in oil, deal insights, whether it'll be hold, not hold, it's another matter. But for now, markets have got to react. How can you now sit out saying, well, this is not real and I'll react to this or that? Markets will always react. And then, of course, they'll react the other way if it does not materialize. But for now, 94, 93, it's a pretty good start, strong start as far as the rupee is concerned. Mitesh is with us as well. Mitesh, just quickly, if you will, are you also looking at, chartically speaking, you got to take the right price, right? The right price perhaps is 315. Is that what you're doing as well?
I think the price which we get in the software is the price which happens at the end of the day, which is at the end of the auction. So I don't know how we can adjust it. But honestly, I think we're still trying to get to terms with the new way of discovering the closing prices. And the divergence is still really, not sure exactly how the market movement next day is affected with that, because we hardly have any sample data. For the time being, I think what is important is that yesterday we kind of went to 23,400, 24,400, which was the earlier breakout pivot, and bounced back after a low of 24,427. So as long as that level is protected, I think I would still maintain the upside target at 25,050 to about 25,100. Similarly, on the back Nifty, a close above 58,500, 550 zones would suggest fresh momentum on the upside, but that's yet to happen, and Nifty has already done that. So that's the view on the indices in the short term.
Levels are, that's my question, is based on what, Mitesh? Is based on 330 price, 315 price?
This is all 330 price.
Oh, you're using 330. Okay. You're the minority. I think like Sudarshan, most are, and to my mind also, that makes sense. Either look at the futures price or you look at the 315 price. But anyway, if you're taking a broader view and you're not doing day-to-day, more positional, I guess the larger structure does not change in that sense. But that's where we are at. We'll get to stocks now. Sudarshan, what do you have?
Well, I have Axis Bank as a buy, stop under 1235. Delivery is a buying opportunity, stop under 475. NHPC is a buy with a stop under 75. My only sell is DLF with a stop above 655. But given the news, I would prefer to stay with the longs.
Yeah. Mitesh, what about you? What are your trades?
I have 3 buys and a sell as well. On the buying side is Hindustan Zinc with a stop at 545 for targets of around 585. A buy on ITC with a stop at 284 for a target of 300. Force Motors has been a call earlier around these levels. So right now, again, it's a buy with a stop below 18,100 for targets of 19,400. And Dabur has broken down. So that's a sell call with a stop at 416 for a target of 395.
All right, we'll come back to you, gentlemen. For now, let's talk about the earnings from the FMCG consumer space. Marico, Pidilite, United Breweries, Kalyan Jewellers, Nykaa. Abneesh Roy, Executive Director at Nuvama Institutional Equities, is now joining in. Abneesh, morning. Rima here. Let's begin with Marico. Very strong numbers. And what stood out for me is that even in their core business, say Parachute, we are seeing premiumization. So the company increasingly is launching these almond oils, etc. So in the, while Parachute volume growth is up 10%, value-added hair oils revenue growth was close to about 22%. Where do you stand on Marico, and is there comfort on the valuation front to buy today?
Sure. Hi, good morning. Thanks for having me. Yes, so generally we have seen results from FMCG companies being quite strong in Q1. That started in Q4. Yes, Marico, very strong numbers. Their EBITDA growth, 25%, was at a 7-year high. And we do see that near term, broadly, 20% plus EBITDA growth will continue. And overall India volume growth, again, double digit in Q1 was a good achievement. Although my sense is Parachute, that 10% volume growth should not be the new normal. But we see that even high single digit kind of volume growth in Parachute should continue. The rest of the portfolio, like Saffola Foods, which grew 43%, etc., the premium personal care, the digital brands, all are doing well. Only thing which did not do well for Marico was Saffola edible oil, but that is not a high growth or focus segment. Coming to valuation, yes, the stock has done exceedingly well last 1 year, 3 years. So valuation comfort may not be high, but 4 stocks I want to highlight, which always looks expensive, but generally they are top tier. So Marico will be one of those. So apart from that, Pidilite, Nestle, Asian Paint, Radico, I think these 4-5 companies always look expensive, but generally they will continue to deliver top tier growth. So we are positive on Marico.
Positive on Marico, yeah, strong numbers in that sense. Abneesh, hi, morning. Do you have a view on Nykaa? Do you track it or have a view?
Yes, we have a view, we have a coverage, so we are positive on the company. So clearly, company has really surprised on the fashion business with a 68% kind of a strong growth in terms of the EBITDA overall, and in terms of fashion, 53% NSV growth. So company has been really delivering on the most of the guidance, and BPC continues to be very strong. The beauty part of the business, 29%. So I will say that fashion was the key surprise, and we have upgraded our numbers slightly. So we are positive, and we have a buy on the company, and we have a target price of 414. So we do see the company doing well. It is expensive, but we have to see SOTP valuation here, given some businesses are in growth segment, some businesses are in the mature phase. So just seeing P multiple again in Nykaa will look very expensive, but here we have a SOTP target price of 414. So we are positive on the company.
414. Abneesh, Nestle was a standout performer on the earnings front in the current quarter. But yesterday at the analyst meet, something that the management said spooked the street and the stock declined. What was your read of the analyst meet? And this is also one of those expensive stocks, trades at 60 times forward multiple. So what should investors do?
I think nothing to worry. I think these are healthy corrections which keep happening in expensive stocks. So yesterday in the presentation, one slide was there. I think that spooked some investors, wherein they are given the overall category growth rate. Frankly, in Q2, I would still expect Nestle to deliver 20% revenue growth on a reasonably good base of 10% in the last year same quarter. So 20% is not a bad number. From Q3, Nestle will become slightly more normalized growth in my view of around 10 to 12%. Again, not bad for such a large company. So yesterday in the analyst meet, they gave a lot of data points on increasing penetration opportunity which is available in chocolates, in the prepared dish, even in terms of the pet food and all that. So I will say that Nestle, don't get spooked on that 3%, 4%. The stock has done well. So it was a healthy correction, but I think that's a buying opportunity. It remains one of the top tier growth companies even in Q2.
What's your highest conviction idea right now, Abneesh? And any absolute sell calls?
So we like the Alcobev space because Tamil Nadu clearly big reforms are likely. TASMAC is likely to get privatized and it's a very big market. So we like all the three listed companies which we cover there, United Spirits, Radico and Allied Blenders. Valuation comfort is a bit more in United Spirits because there is a 10% dividend yield likely because of the IPL team sale. So that is one thing we wanted to highlight. In terms of sell, we don't have, but definitely one thing which I think cigarette stocks worst is behind, but even in Q2, there will be a decline in terms of volumes and profit. So ITC, I think, should be looked more from a 1 to 2 years perspective, but near term, we will not prefer cigarette stocks in spite of valuation comfort because of the severe taxation. So that is how in Sin stock will prefer Alcobev companies rather than cigarette stocks.
All right. Yeah, I mean, maybe I don't make some sin joke, but I won't. Thank you very much, Abneesh. Appreciate you joining us. Useful conversation, and we'll track how all these stocks start up. Nykaa, actually, the pre-open is on, right? So maybe we should look at how these are starting up. Nykaa rates will come up, and I think Marico will come up, and Pidilite, and some of the others as well we discussed, and eye on all those names. The Nifty as well, maybe just look at where the Nifty is finally left off at, and 24,669. So we are starting about 55 odd points above the 330 points. So the bump is about 55 points on top of the 330 price. But from the 315 level, we are up 200 points, 210 points or so. So you've got to account for that. Sudarshan is back with us, and so is Mitesh. Sudarshan, 9-10 calls?
Yeah, we are starting 200 points higher, which is fair given the US markets.
Yeah.
Axis Bank is a buy with a stop under 1235.
Axis Bank is a buy. Got it. Mitesh, what about you?
I go with a buy on Force Motors for targets of 19,400.
19,400, Force Motors. Got it. Thank you very much. We'll talk again soon. Now, the Supreme Court has extended the mandatory third-party motor insurance coverage of new vehicles. Yash is now joining in with more details. Yash, take it away quickly.
Well, Prashant, general insurance companies kept asking for a motor third-party price revision from the Ministry of Road Transport, from IRDAI, but the blessing really came from Supreme Court, which in yesterday's order has enhanced the period for mandatory motor third-party insurance to 6 years versus 5 years currently for two-wheelers and 4 years from 3 years currently when it comes to four-wheelers. Technically, 1 year has been added in terms of mandatory coverage of motor third-party insurance. Whenever you buy the motor insurance policy and the motor third-party comes along with it, you have to pay upfront currently for a period of 5 years for two-wheelers and 3 years for four-wheelers. 1 year getting added, which means that the insurance companies will be able to receive 1 year of premium, more than what they were receiving earlier. That becomes positive for general insurance companies. The biggest positive will be for Go Digit General Insurance, simply because of the share that it has in terms of the motor TP book in the industry, followed by ICICI Lombard and New India Assurance. Just giving some numbers, motor TP contribution to GDP at the gross domestic insurance, ICICI Lombard was 20%, Go Digit was 42.5%, New India Assurance was 14%. This certainly is a big positive for general insurance companies because, as I said, 1 year worth of premium will be collected more as far as these companies are concerned. But for auto companies, it's a mild negative. It could lead to an increase of about 1 to 3% when it comes to ownership of any vehicle going forward. That may or may not have an impact on the demand, but certainly a big positive as far as general insurance companies are concerned.
Yash is Yash in a new look with Yash has got a mustache going on. Looking good, Yash.
Thank you.
And we'll track the story as stocks open up this morning. We'll have first rates come up in just a bit from now, and you've got the the Nifty, the Sensex, the indices which will come up first, and we'll look at broader markets. I don't know if we have time. We should look at the stocks that we've discussed on the morning. I don't think so. So we will get straight to the open itself. 79,055 on the Sensex. The Nifty is going to be in focus. 24,646 is the first start, which is actually flat compared to the 315 close, right? The Nifty Bank is down about a third of. Is it down 1/3%? Nifty Bank, but this is all. We'll have to look at for the Nifty Bank also. We'll have to look at the close as of 315 and compare.
Then it would be up about 300 points.
Yeah, that's the point.
It would be up about 300 points.
We will need a new calculation. Actually, if I can request the ticker team to just put out the changes roughly, approximately. I mean, the Nifty Bank compared to 315, the Nifty compared to 315, and because that will give you the right perspective. Because, I mean, a lot of people will be wondering, oil's down to 79, rupees so strong, why are banks, where it should show up the most down or starting lower, but they're not starting lower. The index is just adjusting compared to the 315 price because of the last 15-minute move that we had. And similarly for the Nifty as well, we should do it. But the Nifty is at 24,650, which means, we are starting about 180 odd points higher compared to the 315 price, roughly. Mid-cap index, small-cap indices are also coming up on your screens at this point in time. The heat map should come up, the Nifty heat map, and then we will look at individual names. I'm sure that's where bulk of the action lies. You've got Indigo, the top gainer, as oil has fallen. L&T and Bharti follow behind. On the other side, you got Apollo Hospitals, Nestle, and SBI Life, which are lower. So 25 up, 25 down is kind of neatly divided this morning. Rima.
Well, I think Nestle was one of the stocks which had a big move in the last 15 minutes or so. So at 315, Nestle was down about 3%, but it ultimately closed at a much, better level. And I think some of that is getting recovered today. So it's showing 1.5%, but you need to adjust it to the 315 close. And I think the picture then, the tape would not be as bad as the 1.5%.
Those are the flashes, right? Yeah. Nifty currently at 24,650 versus, and I mean that number is, that will change, but you've got the live rate at the right of the next to it, doesn't matter. But the point is the comparison is what will give you the sense, because we closed at 24,463 at 315. That's the point, which is important. And similarly, we'll put it out for the Nifty Bank as well. The Sensex did not see that much of a move, but maybe might as well put out the Sensex value out there as well. Prima.
Well, peace in Middle East, the hopes of that, the optimism of that is lifting Interglobe Aviation. That's the top gainer. L&T Finance is moving up smartly. NBFC, stronger ones, larger ones, Shriram Finance, Bajaj Finance on buyers' radars. The street investors like Bharti Airtel's Q1 numbers ahead of estimates, ahead of peers, and the stock is getting bid up today. Wipro, M&M, Geo Financial also seeing some buying. Metal names like Hindalco, Tata Steel have opened up in the green. On the way down, Apollo Hospitals is your top loser. That's down 2.5%. Not sure if there's some news here, but Apollo Hospitals is weak. Nestle India, we spoke about. SBI Life, Titan, TCS, ITC, Coal India, HCL Tech are some of the stocks opening up deep in the red. But I think the stocks to track today would be ICICI Lombard and Go Digit on the back of the revision in the third-party motor insurance. It's now going to be extended by 1 year, what's mandatory, and that's giving a lift to the stock. So ICICI Lombard up 4% and Go Digit up 10%. And oil marketing companies too have opened up quite smartly.
Well, that's right. I'm looking at an AMSEC note, and Yash should neatly explain that as well, that Go Digit will be the biggest beneficiary of this, and that's why the stock is reacting positively. The stock is up 10% or thereabouts. And New Assurance as well, that one as well has moved up, in style, New India Insurance. So both those two are gaining in trade. But on the flip side, actually, there are some stocks that are reacting negatively to their numbers. Pull up Protein, eGovern, that is down close to 7.5%. Sharp downtick is what you're seeing on that one. The other one we're looking at is Mapma India or CE Info. That stock is down 6.5%. Wellspun Enterprises, that's down as well, close to 5.5%. Volume's not very, very high, but in fact picking up actually. All those three are a little bit lower in trade today. Metro brands as well as slipped close to around 4%. So a fair bit of stocks on the broader markets actually are getting a little bit knocked back in today's trading session. Metro brands as well comes up. On the flip side, Morpin Laboratories. Stock was up 20% yesterday. It was up close to around 10% today. So good move is what we're seeing out there. Restro brands, yesterday was up 20%. It's building on close to around 7% in trade today. Sheela Foam, margins are tempered down a little bit, but top line growth was good. And that's why the street is cheering that particular number. And that stock is up and about in today's trading session. Another stock from the broader markets is Uniparts. Just pull up that stock. They delivered very robust numbers. Revenue growth of 27%, EBITDA growth of 55%, and PAT number up by close to around 64%. And if you analyze those numbers, it appears the stock is trading at around 11 to around 12 times, which explains why that stock as well has opened up close to around 4% higher. Good move is what we're seeing out there. And happiest minds, Rima, quite happy this morning. Stock up 5.5%. Unsure if there's any fresh news flow, but a good uptake is what you're seeing on that name.
Yeah, no, absolutely. And I think, it's a decent start, and you got to look at the index values at least in conjunction with what's happened in some of the, in terms of the 315 rates. So that's what you'll have to do. MTAR Tech should come up on your screen. It's basically been on, we highlighted it on the way down. It had fallen, from almost 9,000 rupee levels to about 5,000 rupees. And from 5,000, it's basically every day it's gone up circuit since then. So this is, I'll tell you, 1, 2, 3, 4, 5th circuit day for MTAR Tech, straight. 5 straight circuits on MTAR on the way up. I mean, it doesn't do anything less, either on the way down or the way up. So that is MTAR for you. Bluestone Jewelry is up about 3%, which is coming up right now. PNB Housing is up 4%. I'm not sure. I mean, it's maybe it's the broader environment, but in terms of yields, etc., there was a bit of a miss. So we'll see what happens through the course of the day. Muthoot Finance, right? We had the management with us recently. That was a big day. I mean, 2,600 odd was the low, and the high was about 2,900. Yesterday was flat. Today it's up about 2.5% or so. Look at, I think Ethos reported numbers, and KDDL, which is Kamla Dials, which is the parent company, that is up about 10%, 4,041 on KDDL. That's a company which will come up. Kamla Dials, KDDL, you'll find it with those names. And Paytm is another one which is up about 1.25%. DLF is up about 2. Uno Minda, you'll hear from the management shortly, is up about 2.5% as well.
Just that point on PNB Housing, Prashant, as you said, numbers not too great, but the con-call highlights are very, very good. And I've got a few highlights. They expect to do better than the guidance of around 18 to 20% on overall AUM growth. So that's point number one. Point number two is they're saying affordable housing book will grow at around 50 to 60%. So that's why the street likes that. And they're expecting a pickup in the second quarter itself. And the big trigger is yields and margins have bottomed out. They'll inch up from here on. So that's the reason why the stock is up.
I think we're not. The rate is not changing because I can see the futures price is significantly off. Let's just refresh this, please. Yeah, that's now it's moving. It was not up 7, it's up 4. So from the highs, I think it's come off at this point in time. 16 points, by the way, is where the Nifty is at. Dheeraj Agarwal is with us, Managing Director, Ambit Investment Managers. Dheeraj, good morning. Good to have you with us here. Thanks for joining us. Earnings season, full flow, and I dare say a pretty good one so far, Dheeraj. What caught your eye?
No, I think the earnings season has been pretty strong, especially on the mid and small, where the earnings growth is almost 20%. Even for Nifty, after a long time, we are seeing a double-digit earnings growth. But what I find more encouraging is the top-line growth. Even, let's say, 3 or 4 quarters ago, when the earnings growth were decent, the top-line growth was a little tepid, which has actually come back, which is a more encouraging sign in the current environment, that the top-line growth is also in double-digit at this point.
Okay, got that. Dheeraj, hi. Morning. Rima here. Your framework to invest is predictability, quality, and valuation. So currently now, post the earnings season, or what we know, the visibility that we have, what fits this criteria? Where are you putting incremental money?
So, as I've been saying on your channel last couple of times, it's a very themeless market. It's a very, very bottom-up market. You have to look for stocks where all these 3 criteria actually fit in, where earnings growth is there with reasonable amount of predictability and reasonably good amount of quality of earnings coming in. So that's we are able to find individual stocks in each sector at this point of time, which fits the criteria. Where earnings growth is better than the sector, is better than the money, better than the market. Overall, the quality of earnings are also quite decent, and valuations are supportive. So it's a very bottom-up stock pickers market. Sorry to sound repetitive on this one, but that's where it is.
Yeah, it's a market of stocks rather than a stock market right now, Dheeraj. But you want to give us some ideas, some hints how to about the stocks that you like with due disclosure?
So let's talk about broad themes at this point. So in general, we are seeing a better traction in consumer discretionary, whether it is jewelry or automobiles or even retailing. That's one space, by and large, which looks good. Banks continue to do well on all metrics, both growth as well as stress on the book. Banks have to differentiate between relative growth versus valuations. Few of the banks are slightly richly valued, not doing so well. Although they're doing okay, but they're not really galloping. NBFCs, once again, this quarter result shows that they are back to 30%. Many of the names are back to 30% plus sort of AUM growth with little or no stress on bad assets. So that's another space that we like. And beyond that, I think it's a little bit of cherry picking across all the sectors. So pharma is one theme which by and large looks good. Pharma has a large variety of names in the sector, so you have to pick and choose, obviously. But broadly as a theme, pharma continues to power ahead.
Yeah, and we will hear from the Glenmark management in a little bit from now, Dheeraj, so it'll be interesting in that sense. So I'm as a theme, I'm hearing just financials, right? In that sense, and maybe at the margin, pharma as well.
Automobiles as well, right? So consumer discretionary. So financials, I think a little bit more mixed, but more of a theme is, I wouldn't say automobiles, I would say consumer discretionary. So consumer discretionary demand is where we have seen the maximum positive surprise this quarter, and the auto numbers continue to be very strong even for the month of July as they came out 2 days ago. So across consumer discretionary, there is a demand bump up. We can see that in GST collection numbers as well. I mean, although a lot of GST collection growth came in through imports, but even if you strip that out, the numbers don't look too bad.
Yeah.
Okay. Dheeraj, short conversation today, but we've got the RBI Monetary Policy, and before that, a couple of corporate conversations lined up. Thank you very much for joining in. Let's invite Uno Minda, reported a steady set of Q1 numbers. Revenue growth is healthy, but higher costs have put a drag on the margin. Sunil Bohra, CFO of Uno Minda, is now joining in. Sunil, let's talk about margins. Q1 margins at 10.3%, but your guidance is for 11% plus or minus 50%. What makes you confident you will be able to achieve it for the full year? What's the bridge to get there?
Yeah, so good morning. As we know, the margin, there is a slight drop also because of the higher commodity prices. So even if you are able to say, for example, recover 100% of the commodity price hikes from your customers, it still dilutes the margin by almost like 40 basis points or so. So that's one. And number two, historically, we have seen, and if you see last few years, our Q1 margins normally tend to be a little lower. And as we move forward and with volumes also increasing, margins in Q3, Q4 tend to be better, because a lot of your price increases, a lot of your settlement with the customers, price settlement normally takes time. Number two, also we know there was a commodity price increase post the global geopolitical issues. And there is always sort of normally a lag of a quarter or a 6 months period in terms of price adjustment with your customers. So once we move to the next quarter, we do expect some of those price adjustments to start kicking in. And that's what gives us that confidence, and that's why we are retaining our margin guidance as
well. Got that. So you're maintaining the full year guidance, Sunil, right? Morning.
That's right. Good morning.
Right. What about top line growth, Sunil? What's it? Where will you be by the end of this year, and how is that looking?
Yeah, so while we normally don't comment on the top line, because you all know that our top line is dependent on the end customer volumes, which is not in our hands. But if this momentum sort of continues, we are looking at a significant growth in revenues in this year compared to last year. While this first quarter, our revenues are up by almost 26% quarter one to quarter one. We do expect as we move forward this momentum to continue. Obviously, the volumes obviously have to support in terms of delivering those kind of outperformance. But based on what current intents are, based on the July numbers which are already out in the market, and based on what the intents are for the next couple of months, we are pretty confident that this growth momentum will continue. We should be able to deliver continuous outperformance with respect to industry and continue to grow at the pace we have been growing.
So you could be around 20% for the full year? I mean, without putting a number specifically, but wouldn't be wildly off.
Ideally should be more than that if this trend continues.
Okay. Your exports have crossed 200 crore in the current quarter. And in the conference call, you're talking about doubling, tripling the absolute export numbers. I know it's on a very small base, but what's the timeline to triple your export quarterly contribution from current 200 crores? And what will be the key drivers?
Yeah. So as you see, last year, the Q1 exports was only 140 odd crores, and now we have done 200 crore plus. And we also have informed of a lot of new export business wins which we have received, specifically in one of the business. And all these new businesses, we know that there is a cycle of product development to the product start, right? And it's almost like a 2-year cycle. So from FY28 onwards, we'll start seeing in a significant bump up to be fully realized in 28-29, which is business already received. On top of it, there is also a discussion in terms of getting a lot of new businesses which we are currently in pipeline with our customers for exports.
Yeah. You know, you usually, Sunil, when you come on, you talk about how's the, what portion of the overall kit value you're now playing in. Could you give us a sense of how that has progressed in Q1 compared to same year last year? Last year, same quarter.
Yeah. So in terms of kit value, if you see our two-wheeler segment, our two-wheeler kit value ranges from 12,000 to 20,000 rupees for ICE vehicle. On top of it, we have another 25,000 rupees for an EV specific products. And for a pass car, the kit value for a normal vehicle, which is maybe ICE or EV, whatever, because products are agnostic to the energy they run on. The kit value goes up to almost 2.5 lakh plus another 1 to 1.5 lakh rupees for what we call the EV specific component. So overall, for two-wheeler, if you see the kit value for an EV, all the components is almost like 36,000 rupees, and for pass car is almost like 3.5 lakh rupees plus for a top-end D segment car. And in terms of further additions, we recently have added a seating business also with the announcement of a new plant to be constructed in CSN with a capex of roughly 320 crore. There, the kit value is almost like in a 5-seater premium car, almost like 40 to 50,000 rupees per car. That's the kind of addition we have seen in the quarter.
What is the addressable opportunity? But as you said, you have entered the passenger vehicle seating business, right? And the kit value itself will be a bit of a booster shop to the entire kit value. But what is the addressable opportunity, Sunil? And if you could help us out with how do you plan on penetrating into that?
No, it's a huge opportunity. Actually, the way, if you see the entire car now, the way it is seen as a third living space, so to say, after your home and office and whatever sequence you might say. But there is a lot of premiumization which is coming in, and the features in the seats has been consistently been increasing. So today, if you see a 5-seater car, as I said, in a premium segment, maybe somewhere close to 40,000-50,000 rupees for the business which you have already secured, right? And in terms of potential, you can imagine, obviously, they are currently maybe in the top-end car, but in terms of potential, it is very, very sizable. From Uno Minda perspective, the capex currently which we have announced of 320 crore, that potential is almost more than 2x of the investment. So maybe more than 650-700 crores kind of a revenue at peak, which is what currently we are looking at. And as you move forward, this will only sort of grow, because currently we have added only one customer. We are already in discussion with another model for the same customer, and so on and so forth. So this business obviously will build as we move forward.
Okay. On green energy, I think green mobility, it contributes about 10% to the consolidated revenues. And the total revenues for EV systems, EV business and controller has increased 24% in the quarter gone by to 218 crore. On this, what is the visibility that you have for growth?
No, it's actually, as we all know, EV business has been doing pretty well. Even the EV penetration, if we see the last quarter, the pass car penetration is almost like 6.5%, and two-wheeler EV penetration is more than 9% now, 9.2% to be precise. And if you see a year back, this was significantly lower. Like two-wheeler was like 6 point something, and EV was around 4%. So there has been phenomenal jump in the EV penetration, and as we move forward, this will only grow. So as a strategy, what we have also been doing is we have been keeping flexibility in our businesses, and that's what our original plan has been. So we build the plants, what the eventual business potential might be, but we keep on building equipments or adding equipments or plant machinery as the business grows up. So this is throwing actually a huge positive upside. And as you mentioned, while this growth is only 24%, which is looking at as we move forward, this will only going to grow up as the penetration grows.
Sunil, we leave the conversation here. Thank you very much for joining in. Always a pleasure. Okay, moving on now. Sources tell CNBC TV 18 that SEBI is closely watching the closing auction session rollout, the CAS rollout. Yash joins in with an update on the framework and more. Yash?
Well, it's been 2 days since we've had the CAS rollout, and of course today being the third day. But at the end of the both those days, we've had concerns coming in from brokers, market participants in terms of the wild swings that we've been able to see between the spot and the futures, and those concerns, according to our sources, were echoed to the SEBI chairman as well. That was one of the main reasons which was cited to SEBI chairman in terms of why there is very low participation and liquidity when it comes to retail traders as well as the large desks coming into the CAS framework. What market regulator SEBI chairman told market participants and brokers is that at this point of time there is no review which is on the table or any changes which are being considered by market regulator SEBI when it comes to the current framework which under which CAS has been implemented. According to our sources, SEBI wants it to be implemented in the same fashion, to work in the same fashion for some more time. That will be monitored, before any discussions can take place. But at this point of time, there is no review which is on the table or changes which SEBI is considering as far as the CAS framework is concerned. SEBI chairman also, told the market participants that he does not see any sort of, problems with the framework or the regulations or the mechanism itself. The problem which lies is low liquidity when it comes to the CAS framework after the implementation of it, and SEBI has urged brokers to encourage more retail participation, liquidity coming into the CAS framework, which SEBI sees could be, a reason why there are such wild swings, and that could be mitigated if there is higher participation which is coming from retail investors, retail traders, as well as far as, markets under that framework is concerned. But the big headline, of course, is that currently no review, no changes being considered by market regulator SEBI, though market regulator SEBI has assured market participants that there will be constant monitoring, and of course, there will be further discussions on this.
Absolutely useful, Yash. Thank you very much for that. I want to say this, that the system, of course, has been, there's a lot of anxiety and, and of course, it's a problem on expiry days. But that's the thing. The problem is not the closing auction system itself. The problem is the fact that, the 10-minute window, 3:20 to 3:30, for the closing auction system will work when there is enough demand and supply from both sides, and people are made aware, and it's maybe an education issue and all of that stuff, right? That's absolutely fine, and these things take time. The problem is the F&O side of it. The fact that futures and options prices are dependent on that close at 3:30. I think all that perhaps needs to be considered is delinking that, right? Make it so that we had Rajesh Baheti, for example, yesterday, who said that maybe, close the F&O segment before the closing auction segment. So that like, for example, yesterday we saw option prices going absolutely haywire, berserk, because that 160-point move on the Nifty happened. But you look at, and today will be largely be uneventful. The Nifty may move between 315 and 330. And then again, it'll be, and people, of course, what to take as the closing price. Is it a real price if it moves too much? And all that is, you can still live with it. But the point is, tomorrow there is BSE expiry. What happens then? So I think those are questions. It's the F&O segment being linked to that 330 discovered price, which I think is the issue. Otherwise, I think, as Yash put out, SEBI is watching things closely, and we will get you more updates as and when we find it. By the way, we are at 24,616, which is yesterday's 330 price, which basically means that we're up 160 odd points from the 315 price. I mean, 160 points is the reaction this morning. I mean, you're up 160, you're not flat as the screen shows you in that sense. Well, the next management, Nigel, Glenmark management is with us.
Well, that's right. Let's go across to Mr. Anurag Mantri, the Executive Director and Global Chief Financial Officer of Glenmark, who joins us on the show. Hi, Mr. Mantri. Good morning, and thanks a lot for speaking to us here on CNBC TV 18. Well, before I get to your numbers, I just want to address the recent news piece where President Trump, he's looking at putting a tariff on generic drugs. If you could tell us, how does it impact Glenmark? How much does the company manufacture in the United States right now? And are you looking at more onshore manufacturing in the United States? A quick word on this first.
Thanks, Nigel. So, Nigel, there is no immediate impact on tariff on us. And if you see strategically, we have two distinct points. One is that our overall business mix, only 22 to 25% comes from US. So as compared to the other pharma, we have a comparatively widespread geographical mix. Second is that we have our own plant in Monroe, which started commercial production last quarter. And from FY28 onward, we see that meaningfully contributing it. So it will be coinciding with the tariff timelines with that. And while we continue to watch the situation when evolving policies development closely, there is no immediate impact, and we'll prepare accordingly in sync with the strategic evolvement of these trade negotiations and other developments.
It's an evolving issue. We'll see how that goes. But since you mentioned Monroe, let's talk about the US business as well. Now you're at around $100 million approximately on a quarterly run rate, which is a good growth of the last few years. How do you see this part of the business pan out, and what's the quarterly run rate we should be looking at, say, in a few quarters?
See, US is now this year, US will be a very strong growth for us. And because, as you know, that we launched Fluticasone 44 mcg last quarter, and we saw a good growth. That was a CTG exclusivity. And we also have two more filing which will be launched in H2. This is the Fluticasone 110 mcg as well as the ipratropium. So we see a good growth across respiratory plus royalties. We launched our own commercial through our own commercial network. So that's a relaunch of royalties. Then so overall we see a strong growth this year. If you see this quarter, just delivered almost 18% growth. But I think going forward, we continue to see a momentum. Part of it was also contributed by the currency, but still that we are seeing a good growth traction in US.
So Anurag, what as Nigel asked, what will that $100 million become? Because that run rate,
Yeah, so this year, I think overall we will close more than $430 million sort of overall full year. So run rate wise, it will be upward of $100 million.
If you want to give us a sense of, say, next year, FY28, just trying to understand that how does that move up? You may have some visibility, right?
Yeah, so see, US will continue to move up around 10 to 12% annually. So this year, that's why I'm saying this year, FY27, we expect a $430 million plus of sort of closing for the year. And run rate wise, for this year, it will continue to $100 million.
Anurag, your margins adjusted for the AbbVie licensing income was at 16.6%. While your headline margins were at 20%, but your guidance for the full year is 21 to 22%. What exactly gets you to 21 to 22%? If you could, give us the outline for that.
See, margin, if you remove the IGI revenue from the top line, then you have to remove the IGI expenses also from the thing. And if you remove both from the both sides, the margin are still above the 20%. So, and that's what exactly the guidance, what we have given is that 21 to 22%. This quarter margin was 20% despite the escalating cost pressures. We have seen across the API cost, packing material cost, as well as logistic cost across the there is a continuous cost pressure. So despite that, we delivered 20% margin. And if you see the revenue, our EBITDA growth has been more than the revenue growth, which clearly shows that our quality of earnings is improving in terms of the mix, as well as we are mitigating some of these cost pressure through these measures. So overall, we are confident that we should be able to, we are keeping our guidance intact for 21 to 22%. So like to like basis, if you remove IGI or income from the revenue, then you have, if you remove the IGI expenses from the P&L expenses, then the margin is still above 20%.
That. And India growth momentum, you are guiding for 12 to 15% growth. What is that contingent on? And what was the contribution of the semaglutide? Because you did launch a vial and pen combination. So how much did that contribute in Q1 and for the full year, your expectations?
So India has been a very strong franchisee for us. It's been growing. This quarter, it has grown almost 15.5% in terms of the revenue. All our cardiac, chronic respiratory, OTC business, also the growing oncology products are growing very fast. So we continue to see a good growth momentum. If you see IQVIA across, we are growing much faster than the market. Semaglutide we launched, that actually helped us in terms of reigniting our diabetic franchisee. Though it's not going to be one key growth drivers for us, but at least it's helping us in terms of our reigniting our diabetic franchisee. So we'll continue to see the momentum in Glipit. But however, the other key growth driver will continue to be chronic respiratory, cardiac, derma portfolio, as well as the oncology portfolio.
All right, Mr. Mantri, very quickly then, tell us about the European business that's growing in double digits. Do you expect this to sustain? And also the emerging markets that's growing, I think it grew last quarter by more than 25%. The outlook on both these two parameters.
See, emerging market, we are very optimistic for this year because we have actually expanding our field force. We are launching the oncology product. So we are building the entire oncology franchisee in this market. If you see this quarter, LATAM, MEA, Asia, CIS, all the three actually continue to see a good growth momentum, and APEC also continued in that momentum. So overall, we see this year to be a very strong year for our emerging market business. Europe, if you see, we are expecting the higher single-digit growth this year because last 4 years we have been growing one of the almost double-digit and 25% growth. So Europe this year, but we have a good launches in terms of derma and respiratory. So Europe will be a more or less higher single-digit growth this year.
Okay, Mr. Mantri, short on time. It's a big day for the RBI, so we'll have to wrap up with this conversation, but request you to join in sometime during the quarter.
Okay, thank you.
We'll take a short break on that note. On the other side, we'll go full tilt on the RBI policy. Ritu as well as Lata as well will be joining in.
Hello and welcome to the special coverage of the Reserve Bank's monetary policy. We are bringing it to you straight from Mint Street. I am at the Reserve Bank of India head office, and I must say that the Reserve Bank and its governor are blessed. Look at the backdrop in which the policy is going to be announced. Up until a week back, we were struggling with crude at nearly 3 digits. Today it is below $80 at 78. Probably to make life easier for the Reserve Bank. Likewise, the rupee, which was threatening to touch, 97, just in the third week of July, is today at 94.98. I mean, the dollar has not been this cheap for a while now, for a month now. It's a monthly low for the dollar and a monthly high for the rupee. What a clement backdrop for the Reserve Bank to announce its policy. Ritu Singh is joining me from the studio. Good morning, Ritu.
Good morning, Lata. And, it's turning out to be more about what the governor says in his commentary than what he does on rates. I mean, the markets is largely priced in a no rate action policy this time around. But what are the cues? What are the hints he drops about the next rate action? I think all of the market focus is going to be centered around that. A quick, insight into what our poll threw up. The stance is unlikely to be changed. The rates are unlikely to be changed. Most people don't really see any rate hikes through the fiscal year. It's a very small minority. And those who are seeing a rate hike only see it after October or perhaps even later. But apart from that, the macro forecast, 6.6% on GDP, widely expected to be left unchanged, although a very small minority is expecting an upward tick to about 6.8. Inflation again at 5.1% currently, likely to be left unchanged. The first quarter numbers have been below what the RBI projected, so we'll have to see if the RBI tinkers with that number. The tone of the governor's commentary, like I said, that'll be all the focus. Not much expected on liquidity in this policy, even with that gush of foreign money that is expected to come in with the FCNR flow. So we'll, probably hear more from RBI after this policy, closer to September, October. And lastly, in terms of forward guidance, whether he reiterates that 4% middle mark for inflation targeting, all of those are going to be the focus areas, Lata.
Absolutely. I take your point that his speech is going to be way more important than action, because action, perhaps the market has clearly priced in no change. Let's invite our guests. We have with us Parul Mittal Sinha of Standard Chartered Bank, Indran Ilpan of Yes Bank, the chief economist there, and Kaushik Das, economist from Deutsche Bank. Gentlemen and Parul, thank you very much indeed for joining us this morning. Parul, what's the market bracing for? What is that one word or phrase that you will watch out for, given that it may be a status quo on action?
Hi, Lata. Thanks for having me. So, as you mentioned, we are all celebrating the move lower in oil today. And the market is quite happy with rates moving lower, equities driving higher. Today's MPC, everybody is quite, in a consensus mode that no rate hike happens and stance remains neutral. What we will watch out for, what markets are looking out for, is whether the growth trajectory is moved higher substantially, if the governor acknowledges the strong growth momentum, and also on inflation. So last MPC, we saw that the inflation projection was moved higher to 5.1%. And the last inflation print of June came in higher than 4%, close to 4.4%. So any commentary on inflation now starting to move higher than the 4% target number, how does that influence thinking? That will be the core message we'll watch out for.
Fair point. Similar question to you, actually, Kaushik. If you looked at the forecasts, they should hike next quarter at least, next policy at least, because according to them, we would be above 5% inflation. So what do you expect these forecasts to be tinkered with at all? Will that be your hint to his next action?
So Lata, good morning. We expect a hawkish pause. As Ritu mentioned, the statements will have, the forward guidance, if any. And we expect the governor to sound a bit hawkish and keep that optionality with RBI and MPC, that in case the Fed were to move in September and hike rates, and given that the forward-looking real rates, will narrow quite significantly, RBI's own forecast for October-December is 5.9 on inflation, and January-March is 5.4. Even if I assume 5% inflation for October-December, January-March, and then April-June, they'll give out the new numbers. If you're at 5% inflation and repo rate is at 5.25, then it's too low, and real interest rates need to be seen from a forward-looking perspective. RBI's mandate is headline inflation. Obviously, core inflation, excluding precious metals, are lower, but the mandate is headline inflation. So keeping that in mind, I think RBI should sound hawkish. Also, the fact that I said that there is a possibility that the Fed may hike 50 basis points this year, that also will narrow differentials. All the other central banks in Asia have already hiked interest rates, so relative interest differentials will matter. And the other important thing is that RBI governor in a recent interview mentioned that rate hikes were premature before the June policy meeting in their discussion. And he said that if we had to give a strong signal, we would have changed the stance to something from neutral, and that would have been a giveaway that there are rate hikes coming. Now, the problem is that if the stance is not changed and the RBI doesn't talk hawkish, then market will assume that there are no rate hikes in October. And I don't think, that will be a prudent thing to do, because the optionality needs to be kept in case the Fed were to move and suppose oil prices and other inflation metrics were to go up, because this food price thing, you never know. In the next few months, suddenly inflation can again move up. And anyway, we are talking about more or less 5% inflation, and rates need to move up, and RBI should keep that optionality with them.
Okay, finally to you, Indranil, what's your expectation on any steps he may announce? I think everybody is agreed on action not being much, but any liquidity steps he may hint at. 40 billion has come in. Even if in the very least another 40 billion comes in, that's a lot of liquidity. You're expecting any announcements on that?
So I think liquidity, the last data that I checked was almost a visible surplus of 3.3 trillion, which is the market surplus, and the overall sort of durable liquidity is about 5.6 trillion. Now the point is that yes, flows are there. But to a certain extent, I think what he would be looking at this point in time, I'm not really expecting any incremental CRR to be announced. That's number one. Number two, most of the liquidity tools that are being used currently should be used to guide the market. And more importantly, I think the current measures end around September. Now, post-September, we will be getting into the busy season, and the currency in circulation should also be going up. From the experiences of the last years, the currency in circulation can go up quite significantly if we are talking about relative stability in the economy, not much of an erosion that has happened out of the West Asia crisis. So that in itself will sort of drain out some of the visible liquidity that we see in the market. So this policy for me is more sort of a tick-off policy, no clear measures. Most of the measures have come in the last policy. On the stance, I think my personal view is that the stance should not be changed, and forward guidance becomes very difficult at this point in time. Given that if I look at the June policy, they had taken the stance of a 95 oil and moved all the forecasts around. Immediately within 2 months, moving forecasts around and again sort of facing volatility in the oil is something that they would possibly not want. So they will keep a status quo, wait and watch is what is likely to be continuously guided, which clearly means that they would remain data dependent.
Kaushik, very briefly in a line or two, could you guide us to specific words in the governor's commentary you'll keep an eye out on to take cues about future rate cuts or, future rate hikes or future action at all?
Ritu, all RBI has to say in their statement is that they remain data dependent, and from here on, each policy is live, and they'll decide on the merit of each of these policy and the data that comes from now till October. And remember, seriously speaking, nobody is expecting any more rate cuts in the coming quarters. So if you think of the stance kind of is more in terms of rates. So neutral means you can cut, you can hike, and you can pause. There's no question of rate cuts. So ideally, if RBI wants to change the stance to, say, a calibrated tightening or withdrawal of accommodation, they can do that, because we are talking about just a choice between pause and hike. And if they don't change the stance, then it has to be offset by hawkish remarks. If growth forecast is raised higher while inflation is kept at 5%, that will also be seen as more hawkish. But I think RBI can, in different ways signify to the market that from here on, all policies will be live to decide whether to hike rates, in the upcoming policy or December.
All right. And Parul, very quickly, what are the specific words you look out for in the governor's commentary? If you could just train our ears.
So the number of times they use the word caution, so that cautious and the market conditions remain extremely uncertain. I think also what we'll watch out for is the commentary on growth. The credit growth being very high, much stronger than the last many quarters at running at 17.5%, 18%. And I also want to mention that the positive effect of the FCNR and ECB related flows that have come into the system. And we expect another 40 billion to come. That has loosened the financial conditions materially. I would say it has had an effect of almost 30 to 50 basis points of rate cut. So growth positive and liquidity takes rates lower. In this backdrop, does RBI want to take the opportunity to give rate hikes which will not have much adverse impact on the market? So some commentary on growth, FCNR flows related impact, and how uncertain the conditions are.
Okay, perfect. Indranil, just a few seconds to go before we hear from the governor. Anything at all on liquidity in this policy with all those FCNR flows coming in, 41 billion so far? Anything at all?
Well, I did mention that I'm not really expecting anything on liquidity, but continuing from the questions to Kaushik and Parul, if I were to look at something and which signals that the RBI is more on the tightening cycle, and rightly so, Parul mentioned about the easier financial conditions. Liquidity measures is something that I would definitely watch out in terms of incremental behavior of the RBI, whether they continue to guide towards that 1% of NDTL, which means that they should be actively looking at sucking liquidity out from the system and maintaining the overnight rate more anchored to the policy rate. So that's something that becomes important for me in terms of the...
Got that. Let's, we have the governor speaking. Let's cut across to that.
Challenge the global economy by disrupting key trade routes and supply chains, amplifying market volatility, and repressing business sentiments. Trade uncertainty lingers as US imposed fresh tariffs. The global economic environment has become increasingly unstable. Global growth is projected to soften, while inflation forecast is higher for 2026 vis-a-vis the previous year, 2025. Some central banks have tightened policy, others remain vigilant. Crude oil prices, currencies, and financial markets remain volatile, fluctuating in line with the changing intensity and the uncertainties of the West Asia conflict. In this backdrop, the Monetary Policy Committee met for its third bi-monthly meeting of this financial year on 3rd, 4th, and 5th, that is today, to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments, as well as the outlook, the MPC decided unanimously to keep the policy repo rate unchanged at 5.25%. Consequently, the SDF rate shall remain unchanged at 5%, and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for these decisions. The MPC noted that headline inflation has edged up above target as expected. The realized inflation for Q1, however, remained marginally lower than projections, reflecting limited pass-through of cost pressures. The higher inflation is mostly on account of fuel and food, with little signs of generalization of price pressures so far. Core inflation, excluding precious metals, continues to be benign. As projected earlier, headline inflation is expected to rise further in the near term. It is expected to peak in Q3 of this year, primarily again due to food and fuel, and thereafter moderate. The underlying inflation reflected by core inflation excluding precious metals, which has been benign for some time, is set to align with core inflation towards the end of the financial year. growth continues to be supported by the resilient domestic demand, sustained expansion in manufacturing and services activity, and robust exports. It reaffirms India's position as the world's fastest growing major economy. To sum up, the MPC noted that even though headline inflation is projected to increase, it is primarily on account of supply-side pressures caused by food and fuel. It is not getting broad-based. Core inflation continues to remain moderate, and it is expected to decline after peaking in Q3. Growth, albeit resilient, is expected to be lower in this financial year. The outlook, however, is hazy because of the uncertainties regarding southwest monsoon, El Nino, geopolitics, and global trade policy. There is a need for greater clarity to emerge, especially regarding inflation, its path, and composition before taking any policy action. Any such action would also have to consider the need for recalibration of policy rates in line with the evolving growth inflation dynamics, especially the normalization of the underlying inflation from its benign levels seen hitherto. Considering all these factors, the MPC voted to keep the policy repo rate unchanged. The MPC also decided to retain the neutral stance to respond appropriately to macroeconomic developments. The MPC underscored that it will maintain a close vigil and remain resolute in its commitment to align inflation with the target. I will now come to our assessment of growth and inflation. Let me first of all talk about growth. The supply side pressures caused by the West Asia conflict have eased somewhat since June 2026, leading to withdrawal of temporary measures undertaken by the government and normalization of key input supplies. However, the re-escalation of the conflict since the first week of July has amplified volatility in energy prices and renewed uncertainty about supply chains. Amidst persistent global uncertainty, domestic economic activity has exhibited resilience as reflected by the high-frequency indicators available for Q1. Early results of corporates for Q1 indicate healthy performance in the manufacturing sector. This is also corroborated by an expansionary PMI. Services activity too maintained its momentum in the wake of strong domestic demand. Private consumption continued to be driven by buoyant discretionary spending. Investment activity remains steady on the back of robust government spending on infrastructure and construction. Merchandise exports rebounded with double-digit growth. Services exports growth sustained its momentum. Overall, the Indian economy performed better than expected in Q1. Looking ahead, the prospects for agriculture are clouded by deficient and uneven southwest monsoons amidst El Nino conditions. The reservoir levels, which remain close to normal, bode well. The government's initiatives for crop diversification, including short duration as well as climate resilient crops, and water harvesting and conservation, inter alia, are expected to mitigate the impact of deficient rainfall. Although manufacturing sector may face cost pressures, the growing diversification of global supply chains should help mitigate the impact. Services sector is expected to maintain its buoyancy on the back of strong domestic demand. On the demand side, impact of weak monsoon on rural consumption may be partly offset by supportive allied sector activities and various government schemes. Buoyancy in services sector and steady employment conditions should support urban consumption. Strong capacity utilization, robust credit flow, and the government's continued thrust on infrastructure are expected to sustain investment activity. Net external demand is expected to derive strength from bilateral trade agreements, many of which have been recently concluded, and some of which are now being operationalized, as well as the market diversification efforts of our manufacturers. Renewed tensions in West Asia, which are disruptive of global supply chains, volatility in international financial markets, and weather-related shocks, however, pose downside risks to growth. Taking all these factors into consideration, real GDP growth for this year is now projected at 6.7%. This is 10 basis points higher than our previous projections. Q1 at 7%, Q2 at 6.4%, Q3 at 6.5%, and Q4 at 6.8%. The risks are evenly divided. Let me now talk about inflation. While CPI inflation increased to 4.4% in June after remaining below target for 16 consecutive months, it turned out to be lower by 30 basis points than what was our earlier projections. The increase in June was primarily due to higher food, fuel, and fuel-induced inflation in select categories, such as restaurant services. Notwithstanding the pressure from higher input costs, core inflation, which excludes food and fuel, remain unchanged at 3.9% in May and June. Core inflation, excluding precious metals, was even lower, 2.3 to 2.5% during this period. Going forward, El Nino impact on temporal and spatial rainfall distribution continues to remain a major risk, although proactive supply management and adequate stock of food grains should provide comfort. Global oil prices have remained highly volatile, with sharp two-way movements triggered by geopolitical developments. This blurs the near-term outlook. Although generalized inflation pressures continue to remain modest so far, the risks of second-round impact of higher food, fuel, and other input prices translating to broad-based inflation persist. After considering all factors, CPI inflation for this year is now projected to be 5%, 10 basis lower than our earlier projections, with Q2 at 4.7%, Q3 at 5.9%, and Q4 at 5.5%. Inflation for Q1 is projected at 5.3%, with risks being evenly balanced. Core inflation is projected at 4.3% for this financial year. Core inflation, excluding precious metals, is projected to be lower than core, although it is likely to align with core inflation towards the end of the financial year. Let me now talk about liquidity and financial market conditions. System liquidity, as measured by the net position under the LAF, the Liquidity Adjustment Facility, stood at an average daily surplus of 1 lakh crore rupees since the last MPC meeting. Going ahead, the usual return of currency during the monsoon season, drawdown of government cash balances, and our special measures to attract capital inflows are expected to aid banking system liquidity in the near term. Since the June meeting, the Walker weighted average call rate traded within the policy corridor. It averaged 5.31%. Short-term money market trades, especially rates of commercial papers and certificates of deposit, moderated in July. G-Sec yields, buoyed by measures undertaken by the government and the Reserve Bank to attract foreign capital into Indian debt markets, eased across maturities during June and July. Transmission in the credit market, however, moderated slightly during May and June with hardening of deposit and lending rates. Nevertheless, credit growth continues to remain robust and broad-based across various sectors. Through its conduct of two-way operations, the Reserve Bank will proactively ensure sufficient liquidity in the banking system, guided by the objective of aligning the Walker to the policy repo rate. I will now speak about financial stability. As mentioned earlier, the system-level financial parameters relating to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. There is, however, some moderation in NIM as compared to last year. Similarly, the system-level parameters of NBFCs too are sound, with adequate capital position, improved gross NPAs, and higher profitability. Let me now turn to the external sector. Despite the challenging and turbulent global macroeconomic environment, India's current account deficit last year remained modest, much below the levels considered to be sustainable for emerging markets. During April to May this year, the current account recorded a surplus of $2.8 billion US, primarily led by services trade and strong remittance receipts. In Q1, India's merchandise trade deficit widened to about $86 billion from about $69 billion in Q1 of last year. This is mainly driven by imports of crude oil, electronic goods, and gold. Going forward, moderation in global trade growth, surge in energy prices, and persistent trade policy uncertainties pose upside risks to India's current account deficit. On the other hand, implementation of the India-UK trade deal, along with many other recent agreements with major trading partners, healthy services exports, and buoyant inward remittances are expected to mitigate these risks. On the external financing side, gross FDI inflows were buoyant at $30.7 billion in the first quarter of this year. They are higher than $26.7 billion in the same period last year. This underscores the continued interest of global investors in India. Net FDI inflows also mainly driven by higher gross inflows and a slowdown in growth of outward FDI increased during the period. Moreover, FPI to India has seen a turnaround in June and July this year with net inflows of $7.1 billion. This is, of course, primarily driven by the debt segment and after registering net outflows during April and May of this year. Going forward, capital flow measures undertaken in June will support inflows. As a result, the balance of payments is expected to register a healthy surplus. India's foreign exchange reserves continue to be adequate in terms of the standard metrics of reserve adequacy, with import cover of over 10 months and external debt cover of almost 91%. As for the exchange rate, as mentioned earlier, we will continue with our policy of it being determined by market forces, while at the same time curbing excessive volatility, checking speculative behavior, and preventing disorderly movements so as to ensure that it is not out of sync with the fundamentals or it is not disruptive of economic activity. For this purpose, we have a very broad range of effective regulatory and market-based instruments. Now, before I conclude, as has been the practice, I have a few additional measures also to announce. I have two measures to further strengthen the cooperative sector. One, on the basis of the feedback received on the discussion paper on licensing of UCBs, which we had done some time ago, we are now issuing draft guidelines for resuming licensing of the urban cooperative banks. Two, in light of the experience gained and the developments since 2008, when the credit monitoring arrangement for rural cooperative banks was last revised, we are issuing draft directions after undertaking a comprehensive review of this arrangement. There is one measure for interest rate on advances in order to enhance transparency in lending rates and further strengthen consumer protection. It is proposed to harmonize and standardize the regulatory framework on interest rates on advances for all regulated entities. To conclude, global economic conditions and sentiments continue to remain hostage to the rapidly oscillating developments, both in scale and intensity, of the West Asia conflict. While these have impacted the domestic growth inflation outlook adversely, the stronger macroeconomic fundamentals of the Indian economy are helping navigate this global shock resolutely. As alluded to in my last statement, this presents an opportunity to accelerate measures to enhance our resilience to withstand such shocks. We shall continue to implement policies that further fortify our economy, whether it is facilitating sustainable growth or promoting consumer protection, whether it is preserving stability of prices, the financial system, or the currency. We will do whatever it takes to ensure the same. Thank you, Namaskar, and Jai Hind.
Okay, now this is to some extent as expected policy because there was no change in the action. But the governor has surprised by tinkering or tweaking the growth inflation forecasts. Actually, it's very positive for stock markets because growth has been upped from the earlier 6.6 to 6.7. And for the quarter gone by, it has gone up a whole lot actually, 6.6 to 7%. April, May, June, I'm personally happy because I had written very confidently that a 7% growth is the minimum we should expect in the first quarter. The RBI now aligning to that number. It's a positive in terms of growth. And inflation from their earlier 5.1 has been brought down to 5. This is the best combo you can have, inflation lower than earlier forecast and growth higher than earlier forecast. It's a great combo for the markets. Stock markets, of course, are in their own confusion because of that closed auction system. We are having divergent trends, but this is extremely positive even for equities. The bond yields went down a smidge and they are now flat, and the currency, of course, has not reacted much. But all told, this policy, I would say, is even more dovish than expected. There was a feeling that the governor might hint at some hawkishness, but I don't find much of it at all. In fact, he isn't even saying that food and fuel higher prices are becoming generalized. He said he will watch whether they will become generalized. So even to that extent, the sounding, the phraseology doesn't seem to indicate a man in a hurry to hike rates, if at all he will in the current year. But let me ask the experts. I have with me the SBI Managing Director, Mr. Ashwini Kumar Tiwari, joining us. We will also be joined by other experts, Ashish Vaidya of DBS, and our economists, Kaushik and Upasna. But Mr. Tiwari, thank you very much, sir. What have you made of the policy? What does it mean for a bank like you?
The policy, Lata, is on expected lines. There is no change in the rates as expected. The positive side, as you were highlighting, in terms of the growth projections being taken up, is positive. And I would argue that all this Q1 and prior to that, the Q4, both of them have shown the tremendous resilience of the Indian economy. Despite everything which happened, the growth rate has been brought down, but otherwise the inflation is, except for the fuel and food, is fine. And the banking sector credit growth continues to be very strong, stronger than what it was in the Q1 of previous year. So overall, the economy is doing well, and the banking sector, as a result, is also doing well.
So what are you reading in terms of his future move? As a banker, it is to your advantage if they hike rates, because to that extent, the NIM pressure will go away. You have a lot of externally benchmarked lending rates, and you can expand your margin a bit. But if you were to read his lips, what are you sensing?
I don't think he is hinting at increase of rates, as you have already indicated. So therefore, we will have to see the next 2-3 quarters. Our house view is that the rates are not likely to be taken up in this financial year. But as the governor said, we'll wait for data. And as he said, if the inflation gets generalized, then they will take a call or watch it. But so far, there seems to be no indication of any rate increases.
And what is your sense about the credit growth itself, given the kind of macroeconomic parameters he has drawn? He is indicating that he will keep liquidity and the weighted average call rate at 5.25 and between that corridor. Since he has indicated that, and there is of course this FCNR flow, are you expecting liquidity to be plentiful? Do you expect any pressure at all?
So liquidity definitely will improve as a result of the FCNRB flows, which have been pretty good. And as we have been saying, the credit growth for us and also the banking sector in general has been very good. In fact, the corporate sector, which normally sees a lot of negative growth in the Q1, this year the negative growth has been much less. So which means the overall growth of credit in all sectors has been pretty good. This has not subsided at all, despite all the uncertainties which are around us. And as a result, the support from FCNRB flows will go a long way in easing the liquidity conditions. And we expect the liquidity conditions to be benign going forward.
By the way, your FCNRB flow is the highest. And that's not surprising. You are the largest bank. A net of 6 billion when the data first came out from the Reserve Bank. Net 6 billion. The gross flow was higher. What is the sense you are getting? Will you be able to double that in the remaining 2 months? The first 7 weeks has given you 6 billion net. Will the remaining at least double this amount?
So while we are engaged in pushing this and our current flows, and so far it has been very good, I wouldn't like to hazard a number because some countries, there have been some difficulties in regulation where the flows have not picked up as expected. So the focus continues to be on the Middle East, etc., from where bulk of the flows are coming. So therefore, while we expect from good flows going forward as well, but to giving a number, whether it should double or not, I don't think we can warrant at this stage.
No, only for you, from your point of view. I'm not asking for the system, sir. I'm asking from your point of view, will it improve? I'm asking you because the market is guessing that if you get a substantial amount over there, your margins will improve. So if you can comment on that as well.
Yeah. So I was also speaking only on our behalf. I don't expect to speak on behalf of the system. Our flows have been good so far. We expect them to be good going forward as well. But how much they would end up with, we can't say at this point.
Okay. And margins will improve, you think, because of this at least?
Yes. Margins are likely to improve because of this.
Oh, okay. Ritu, I'm sure you're bursting with questions.
No, I was just wondering if Mr. Ashwini Kumar Tiwari will confirm what the current number, at least on FCNR, is, because I believe, when the Parliament data came out, that was net inflows, HSBC looked higher. Your number by 31st had changed. If you could update us with the current number to begin with, Mr. Tiwari.
Ritu, I don't think we have been updating number in the market, and therefore we will continue to let the RBI speak or the Parliament speak if at all those questions come. We are not giving out this number publicly, so therefore let's hold that for the moment.
Okay, there's one more thing in terms of non-policy measures that the governor announced, and that is, to enhance the transparency in lending rates, they're proposing to standardize the regulatory framework for interest rates for all regulated entities. I just wanted to understand, how this currently works, banks versus NBFCs, and what this kind of a change would entail, especially for large banks like you.
So we will wait for the exact instructions as to what the standardization will entail. But RBI has been doing these things. For example, the MCLR framework earlier and prior to that, the base rate framework. They have been trying to standardize these rates so that comparison across banks is easier and customers, as a result, are able to take a informed decision. So I'm not aware of the exact details of what this entails currently. We will wait for those instructions, and then we have been transparent all through. So therefore, I don't see any challenge for us. Exact instructions we will wait.
Okay, Mr. Tiwari, anything else that stood out for you in the commentary, that gave you a sense of, when, if at all, that rate hike will come, or is this a extended pause given the slightly dovish tilt to the commentary by the governor?
So there was no indication of hike, as I've already said. And as I said earlier, the one thing which came out clearly from the macro numbers and the overall commentary which the governor gave, that the resilience of the economy really stands out. Despite everything, we are still doing well comparatively, and the future going forward looks quite okay as well. So we will wait for further data, etc. And I don't think any rate hike is on the anvil at this point, at least.
So before I let you go, Mr. Tiwari, anything you want us to ask the governor, we will get him for an hour. Any questions?
Lata, thank you, Lata, but you have enough questions to ask, and you have been really representing all of us very well. So we leave it to your better judgment to ask what you deem fit.
Okay, no. I just thought that the bankers may have much more on their minds, which they want to.
But we want to ask him.
Thank you very much, Mr. Tiwari, for joining us.
Thank you.
Of course you will. You all have a hotline. Thank you very much, Mr. Tiwari, for joining us. Let me get the market perspective as well. We have Ashish Vaidya with us. Ashish, would you say it's entirely on expected lines or actually more dovish than expected? Will you actually go out and say that the yields may fall? They did fall when he was speaking.
Yeah, absolutely. I think on the expected line, but like you rightly mentioned, it is a little bit more dovish than what we really expected. I think very comfortable on the inflation situation, very comfortable on growth, and basically the governance is giving a lot of reassurance that everything is sort of stable, and we have done very well. So I think clearly a little bit, to my mind, slightly dovish than what we expected. But yeah, I think that's in good state. So let's see how exactly the macros pan out in the future. That's how the markets will behave.
What is your sense about the yield range now and the rupee range? Today we have, of course, come south of 95.03 as I speak. But what is your range now that we know where policy is headed? For the yield first.
Okay, let me start with the yields. I think the yields would be quite range bound in the near term. I would think a broad range of about 5 to 10 basis points as of now. Having said that, I think we are back to the global cues. So if really something happens in the global fixed income markets, it will actually start to reflect in the India piece as well. And that's like the normal course of markets. The important thing on the FX side, clearly the FCNR has been a great support, and that's sort of resulted in stability of the currency. However, I continue to have a view that the FX bit is doing a rather heavy lifting because your local rates are much lower than the offshore implied rates. So the currency, while it will do well in the near term because of the FCNR flows and the fact that the RBI did indicate this time that they want to curtail and continue to curtail the volatility, I think the currency should be well behaved. Another important point which I want to mention is we'll have to really see over the next 3-6 months as to how exactly the dollar index and how exactly the AI bubble is or the AI story is playing out. So if you have an anti-AI story developing in the world in the next few months or that story getting deflated, it'll actually be very positive for the the FX also, because you could have a situation where you could start seeing YCC or QE back on the table for most central banks, at least on the DM side, and that actually translating into much better currency flow into emerging markets. So that's something which we need to watch out for. But broadly for now, I think everything looks good, and the way things are panning out, it's very, very resilient.
Well, yes, let me quickly also point out to our viewers two additional numbers if we had missed before. There are two projections that have come in for FY28. For the first quarter of FY28, GDP growth is seen at 7.3%, and for the first quarter of FY28, inflation is seen at 5.3%. This is after, of course, already hiking growth for the current year and lowering inflation for FY27 as well. Upasana Bharadwaj, quick thoughts with these kind of numbers, better than expected growth, lower than expected inflation. How do you think the pause gets longer? What had you penciled in before this policy? And how does that outlook on the next rate action change with these current forecasts?
Yeah, if I can just mention two things here. One is, of course, that the governor has sounded fairly balanced, wherein markets were fearing a little hawkish tilt, which is, of course, there. But having said that, the numbers, if we look at, are suggesting two things. One, growth is robust. Even the first quarter, as you mentioned, FY28 numbers are looking at GDP numbers of 7.3%. And if I look at the first quarter FY28 inflation estimates, they too are north of 5%, 5.3%. Now, in that context, if I look at H1 CY27 next year, now that is looking at an average of 5.4% as per RBI's estimates. In that background, can we have repo rate at 5.25% when we are looking at 1 year ahead inflation at above 5%? And that is the reason, well, I am of the opinion that there is still scope for rate hikes, but obviously a lot depends on how several aspects play out. And that is and we were earlier of the opinion that December is where they will begin hiking probably, and that we still retain as of now 50 basis of a rate hike in FY27, but starting December.
Okay, got that. Kaushik, with inflation for the full year at 5%, current rates at 5.25%, real rates at 25 basis points. Just a quick thought on whether your own projections and, how long the pause could be changes with these forecasts. And, how long do you think we could sustain with that 5.25% kind of a rate?
Yeah, I mean, as you made out that this statement was very dovish, more dovish than warranted in my view. So in this case, as you're mentioning that 5% is the inflation forecast, repo rate is 5/4. So your real rates are just 25 basis points. And from October, December, real interest rates will turn negative because RBI's forecast is 5.9 in October, December, then 5.5 and then 5.3. So we are talking about real rates negative for 3 quarters if repo rate has to stay unchanged at 5/4. So that probably is not going to be the case. So rate hikes definitely have to happen, particularly in the context when you're talking about growth being above 7% forward-looking by April, June. And even January, March, I think they have given a forecast of 6.8. If you go back and check that before COVID, the 3 years prior to that, when growth averaged similar 7% and inflation was around 4%, headline inflation, the repo rate was at 6/4. So the real rates were 225 basis points, probably too high than what was needed. But then if you have the similar kind of, you have similar kind of growth at 7%, even if I take just average 7%, and if you take inflation, which is 100 basis points higher than the previous period, repo rate is 100 basis points lower than where it should be. So in my case, the terminal repo rate should be 6/4. and that will have a decent real rate of 125 basis points, which is what RBI has always wanted to maintain, somewhere between 125 to 150 basis points. And in that case, RBI needs to hike. Also, as I mentioned earlier, that there is a possibility that the US Federal Reserve might increase their rates by 50 basis points. So it's just not real interest rate in India. You have to think in terms of interest differentials with US economy, with the other Asian economies, which have already hiked. So in order to get inflows from the debt side, interest differentials will matter over a period of time. And if you use simple Taylor rule formula and put 7% growth and 5% inflation, it will suggest terminal repo rate much higher than where we are today.
Okay. Kaushik, your argument is absolutely correct. Watertight argument in terms of real rates being negative. But just concentrate on the governor's language. Wouldn't you say this is a dovish tone? See, even in the business line interview, he said that they're already seeing signs of some generalized inflation spillover, but they will wait to see if it increases. Today, he has not even said that. He said we will wait to see if food and fuel become generalized. It looks to me even more dovish than the business line interview. Wouldn't you say that his own position is dovish?
I completely agree with you. I mean, I didn't expect this, this dovishness today. So the statements that have come is all with respect to, inflation not being generalized till now, and they need more time to wait and watch and see, which is fine. And, which probably indicates that October RBI may not want to do anything. We'll still buy more time and see what needs to be done. But all I'm saying is, if you're a forward-looking central bank, inflation targeting central bank, then if you stand by your forecast that and your mandate is headline CPI, not core CPI or core CPI excluding precious metals. So in case you see after a few months that inflation is moving higher, in line with your forecast, and your real rates are turning negative, then there can be questions about whether you need to move faster or even higher than what you would have done if you had started early with small doses. And also the global backdrop can change very easily. I mean, if you get a strong US CPI data next week and the market starts factoring in short rate hike in US in September or October or December, then the narrative can change quite significantly. Remember that all the central banks in Asia, for different reasons, some countries for FX, some countries for other reasons, have already hiked interest rates and are some way ahead of the curve. So if it is not going to have negative impact from a global macro point of view, you are safe up to a certain point of time. But if things turn negative, and as you've seen, oil prices can turn very easily and go up higher also in the next few months, then the question is, do you hold on and then take a bet that all things will be correct, or you move in small doses and hedge yourself against the risk that if things go right, then I can again pause, but not kind of fall behind the curve completely.
No, I take your point that he is sounding dovish, but maybe he's missing a trick here. Maybe the Reserve Bank perhaps should have used this opportunity to sound hawkish at least. Now it looks like October is written off for a hike, if this is the language that they're persisting with. Would you say that, Ashish, that now October looks unlikely?
While I completely agree with my panelist, and we are on the same page, because fundamentally it's looking like it's not stacking up so well, because inflation is real and the other central banks are also sort of hiking rates. So that's why I mentioned about the FX doing the heavy lifting, because then you'll always have a situation where the FX actually gets damaged because of your lower interest rates in the local segment. I think going forward we will have to do with the rate hikes. I'm completely with what Kaushik and Upasana say, but the language today was extremely dovish and much more than what probably I anticipated, and the level of caution which I would have expected from the head of the central bank was actually very, very discerning, very, very comforting that everything is okay. So I would think for short term, I think we're fairly stable, but overall back to global cruise.
All right, with everything A-OK, as you say, let me just get a quick poll from all of you, starting with you, Upasna, on, when you see the first rate hike. I think you already said December, and if we see a stance change before that. Starting with you, Upasna.
Again, Ritu, I'm not convinced necessarily that a stance change has to happen in a policy prior to the rate hike. So I think it's going to be fairly data dependent for this for October. We will have the FOMC on 16th of September. We would exactly know how the geopolitics is playing out, how the monsoon period is playing out. All of that will play an important role while defining the stance in October. It could still continue to be neutral, and then we see a rate hike and a change in stance, or even in a neutral stance, we can see 50 basis of a rate hike. So I guess it's not a given that a stance change could happen, but I think a pause looks for now a given for in October.
Pause in October, 50 basis point rate hike in the cycle, perhaps December or later. Kaushik, your summary of your expectations from here.
So if you go by the statements made today, then October looks very unlikely unless things change very drastically from now till October. But I think not even 50. You need 100 basis points rate hike in this cycle. It will not be done in one go. There will be some hikes, and there is a pause, and then you'll have more hikes. Because if your inflation at April, June is 5.3 and your growth is 7% plus, then you need rates to be higher. And you can't have just 50 basis points rate hike. India, whenever it has moved, it has either moved on the rate cut side 100 to 125 basis points. On the rate hike side also, it has moved at least 100 basis points. So I would expect 100 basis points hike in this cycle. Whether October or December, data will determine that. But you need to raise rates over the next 6 to 9 months to take it at least to 6% from where we are today.
Absolutely. Take that point. So 100 basis point hike in this cycle, October, December, or even later. Ashish, quickly, summary of your expectations going ahead.
So I think October, I would think it's more of a pause unless the entire macro situation completely changes. But for this cycle, I would actually agree with Kaushik, 100 basis point, but that might actually take 12 to 18 months.
That's a pretty unanimous view on, at least ruling out rate hikes for the month of October. And then, of course, 50 or 100 or higher hikes, we'll have to see. Lata, any closing comments before we thank our guests?
No, I would agree with how the panel has read the governor. This is an unusually dovish statement. People were preparing for a hawkish status quo from the governor because we are staring at 3/4 of 5% plus inflation by the Reserve Bank's own forecast, 5.9%. This is a seriously negative real return for the saver, and therefore one would have expected that they will at least alert that there can be a generalized spillover of inflation from food and fuel. Nothing of that sort has come, so it is looking very much like October is written off. But I would distinguish here between what the governor has said and what perhaps we should expect given the kind of inflation trajectory. We will of course ask him in the press conference whether he is not concerned about this negative real return for the saver and what impact it can have. This very aggressive growth, it is 7%, already upped the growth forecast for the quarter gone by from 6.6 to 7. That's not a small uptick in forecast. That's an almost half a percentage point higher growth forecast that he is giving, and that should follow through in other quarters as well. He's not saying it, but for the full year, this should mean an upper forecast, a 6.97% should come in subsequent policies. Given such an aggressive growth and such an aggressive credit offtake, with liquidity coming in via FCNR, perhaps the Reserve Bank should raise its guard. We will ask him to defend that dovishness, of course, in the press conference. We will get to know more. It will be far richer than the policy statement itself. Thank you very much, Ashish, Upasna, Kaushik and Mr. Tiwari, if he is listening, for joining us. Over to you, Ritu.
Well, for viewers tuning in, that was our RBI policy coverage. Rates, as expected, left unchanged. Stance continues at neutral. It's good news on both the macro fronts. Inflation is seen lower than expected versus, it's 5% now is the inflation forecast versus 5.1 earlier. And growth has been revised higher to 6.7% versus 6.6% earlier. And for the first quarter of next year as well, there's strong forecast of 7.3% on growth and inflation 5.3%. And our panel seems unanimous that a rate hike is ruled out, at least for October, perhaps even December. And on that note, Lata and I take your leave. It's a wrap on this special edition of the Monetary Policy coverage. But stay with us. Trading Hour comes up next.
Good morning, Avitas here on Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia, and in a new look Trading Hour today, joining us Ekta Batra and Sonal Bhutra. Ladies, good morning. The policy is finally done on expected lines, and the markets are having a ho-hum reaction to that as well.
Oh, yes, it is. The markets fell when the policy data was out or the commentary was out, but it has recovered yet again. And we do have Nifty, which is absolutely flat, but with some positive bias. We started on the back foot despite strong handover that we got from the Wall Street Asian markets as well. We came off sharply from the highs of the day, attempting some bit of recovery for now, but that again got sold into. So continues to be very volatile session for our own markets. Overall, it's the realty pack, which is seeing some relief. It was the top loser yesterday. So the Nifty Realty today is up around 2.5%, followed by autos and some of these consumption names as well. No rate hike is always a good news. But despite the fact that growth forecast has been increased, inflation forecast has been reduced, markets not giving it a big thumbs up, maybe looking at earnings and a lot more on West Asia developments.
Well, yes, Sonal and Hormuz, welcome. Good to be on Trading Hour today. But definitely, the markets are unchanged post the RBI policy. It is the third time that they've met this year. And that is basically what the markets are reacting to, that maybe there wasn't that sort of rate hike that came through. The neutral stance is maintained at this point in time. But just want to point out that there is a little bit of a softness which came into the 10-year, which softened a little bit. So the last time I checked, there was just a little bit of a movement in terms of the 10-year on the downside. So that is definitely always a little bit of a positive indicator in terms of what cues the RBI is giving the markets at this point in time. So generalized inflation pressures continue to remain modest so far. That's basically what the Reserve Bank of India has said. And even headline inflation pressures are primarily due to supply side pressures, and they are not broad-based at this point in time. So a bit of, positive statement you would have to say or read through for inflation. So the GDP estimate for FY27 is now 6.7% versus 6.6% earlier. And the CPI estimate for FY27 now stands a little lower at 5% versus 5.1%. So GDP growth higher, CPI lower is basically what the RBI is saying marginally, but nonetheless, that's basically the indication at this point in time. But let's go across to Hormuz. He's here with us now as he puts the spotlight on the movers in the market. Hormuz, tell us more.
Well, it's still adjusting to cash, and that's what has been happening over the last couple of days. So the divergence between the spot prices and the futures prices continues to remain. And compared to Monday, the divergence yesterday was slightly lower, but there was divergence nonetheless. And even today, when you see the spot price is at 24,630, when you look at the futures rate as well, that will give you the picture as to where the divergence actually lies when it comes to the difference that you see. Same is the case for the Nifty Bank as well. The divergence between the spot prices and the futures prices. So even though technically we were supposed to be higher by almost 200 points based on what the index, the GIFT Nifty was suggesting, the implied open, the screen shows that we are still flat. And even the Nifty Bank has had a bit of a V move that you have seen right now, fell off the highs and then has seen some recovery from the lows of the day. Now take a look at the result reactions that have come in. On the positive side, PNB Housing is leading that pack, 5.5% higher on that one. ASK Automotive 2 has done well today, 8.5% higher on that one. Morpen Labs, after its results yesterday, was locked in a 20% circuit, is extended those gains now, adding another 9% to that tally in today's session. Take a look at the negative result reactions, and despite very, very strong results, Nykaa is down 3.5% right now as we speak. Mapma India 2 down around 6%. Bharti Hexacom is down 3.5%. And then take a look at the two capital market names as well, BSC and MCX. It shows you how positioning has been playing a part when it comes to these result reactions. BSC is down around 2%, but MCX, weak numbers, yes, down around 3.5% in today's session. The newsmakers today were the general insurance players because of the new motor third-party insurance rules. Go Digit is up around 6%. New India Assurance is a similar quantum. ICICI Lombard is now building onto those gains slowly and steadily, 3.5% higher on that one as well. Sonal highlighted real estate names. Godrej Properties, after its results yesterday, is extending those gains now, 4.5% higher. Some strong commentary coming in the earnings call as well. DLF, Oberoi Realty, Prestige Estates, all the stocks in the real estate index are doing well for themselves. And lastly, stocks at 52-week highs today. Saregama came out with numbers yesterday, extending those gains today, 4% on that one. Exide is up 4%. KDDL as well, up around 9%. And Sansera Engineering is having a good day at the office. All of them at 52-week highs today.
All right. Thank you so much, Hormuz, for giving us that detailed list of all the stocks which are buzzing in trade today. A lot of action in the broader markets. So let's go across now and move on and have a market conversation. Nimesh Chandan, CIO at Bajaj Asset Management, is joining us now. Nimesh, Good morning. Thank you so much for joining us. Well, the policy was in line with what the street was working with. There has been a cut in inflation forecast, an increase in GDP forecast. Do you think this is something that the markets would like, or we do need some more clarity when it comes to global turmoil and a lot more on tariffs now as well? What is the next trigger for the markets apart from earnings?
For the past few months, actually, the markets have been more worried about external front than the domestic economy. I think a lot of things are working right for the economic cycle, the business cycle, and the credit cycle in the market. For most of the investors, I think they keep watching the crude oil price to see what can happen in inflation and growth rate for the coming year. The RBI policy was mostly as per expectations, and a bit dovish, maybe, we can say that. But overall, we will be watching the external front more. It seems things are progressing towards a deal in West Asia. So keeping fingers crossed and hoping that crude prices remain down and we can focus on the results here.
Nimesh, hi. Welcome to the show. Well, just on that thought, then, from an RBI policy perspective, how would you approach the rate sensitives, the banks, the autos, as well as the real estate stocks now?
For the time being, we are bullish because apart from just the net interest margins, where we track their rates, we are bullish on the credit growth in the economy, and the asset quality remains quite benign. And in many banks, the valuations have come down to a significantly attractive level. So while we'll go through an interest rate cycle based on maybe inflation and crude oil prices, but I think the valuations for a long-term investor in the financial sector are quite attractive. There are many interesting plays there. Large banks, I think a lot of experts have come on your channel and said that large banks are trading at their decade-low valuations or among the lowest valuations in the last 5 years.
But Nimesh, to play the devil's advocate, they may be trading at decade-low valuations, but if you take a look at the performance over the last 5 years, the returns are almost negligible or even almost zero when it comes to a lot of these large banks. You say the likes of HDFC Bank, Kotak Bank and the likes. You still stick your neck out and you would say that, okay, the worst possibly is now past them because clarity has emerged on a lot of issues that were plaguing them? Or would you take a bet on the NBFCs, the larger ones, say for the likes of Bajaj Finance, which was at a 52-week low in April, in 4 months is now at a record high?
It is difficult to generalize on all of them together because some have had their specific issues, and I hope that they are also moving towards conclusion somewhere. Some leadership changes issues or some accusations on, say, corporate governance or so. But I think they are getting towards resolution. As a pack, if I can generalize one thing, see, 5-7 years back, these companies were trading at much higher valuation. And while the earnings have grown, they've got derated over a period of time. And now again, the valuations have become quite attractive. Growth is reviving. And India is on a firm uptick on the economic cycle. And one of the best plays for this cycle will be the BFSI segment. I'm not saying it starts performing next quarter because many of them may require a trigger. But it looks like from here on, there is money to be made in this sector. One may have to be a little bit patient there.
Nimesh, I wanted to speak to you about small caps as well. Your small cap fund has seen a return of 16% in last 1 year. And this is a category which did see flows come back in a small way, at least, in the month of July. In the month of June, I'm sorry. Industrial products is the biggest weight here. You do have pharmaceuticals. There's auto components. What makes you positive on industrials? Because valuations are sky high now. Do you think there's still some space for an uptick, at least in the small cap space here? Is this a category you are bullish on from here on?
We are very bullish on small caps overall because the growth numbers that we are seeing in small caps as a category are quite attractive. In fact, we were just doing the numbers on the result season so far, and we were seeing there is a very good beat on numbers for the small cap category, both mid cap and small caps. But small caps gives you a little more variety and diversity to choose from. So small caps as a category, we are quite bullish. Within that, now there are many bottom-up stock picking ideas there. Some of them are on the export side. Some of them are on the capital goods side, where we are quite excited. Valuations, yes, they have moved up on the capital goods side in the last 1 year. But the growth seems to be getting upgraded. So we have, I'm not saying across the board, but at least in the portfolio, we are retaining those companies which are seeing earning surprises. Within our small cap universe, we've seen about 56 to 57% of the companies actually give an earning surprise, even in a tough quarter like what we had between April and June.
Okay. Nimish, wanted to extend that conversation about earnings surprises. Sector-wise, which one do you think possibly surprised the most on the upside this time round in terms of earnings across large cap, mid cap, as well as small cap? And similarly, which probably disappointed the most?
I think disappointing is easy to answer. Where the IT sector is concerned, I think there's still some issues on growth. We are seeing some kind of pricing pressure also there. Now, on the beat side, there are many sectors which have beaten because, again, within our total universe, which may overlap about 75 to 80% with BSE 500, we've seen 75% of the companies at least meet or beat expectations. So only 25% seems to be below expectation. Within that, I would say consumer sector, because the expectations were very low in this sector, the beat has been actually quite significant. It's a very vast sector, whether you take everything from groceries, FMCG to building materials, real estate, there has been a significant beat, and the commentary also has been quite good. And I would highlight this because of oil price increases, inflationary issues, the sentiment being low, and El Nino hovering around, we were expecting consumption companies to be a little less upbeat and maybe suffer on volumes. But we've definitely got pleasantly surprised here.
But do you believe that this is going to sustain, Nimesh? And what within the consumption basket would you be betting on? Because HUL's volumes were a little lower than expectations. They haven't been very upbeat on the road ahead as well. Nestle in its analyst day said yesterday that consumption going ahead may moderate in the near term. So are you betting on the staple side, or you are betting on the names such as Marico and the Nykas or the likes? Because Nykaa and Marico were the ones that stood out within this FMCG space, or do you believe that discretionary is a better player?
Hormuz, we definitely are more bullish on the discretionary. I would still say that FMCG, most of the companies, except some of the companies that you mentioned, have given very good growth, and the guidance is also better for them. Let's say in some sectors you become bullish because things are less negative than what you expected. In some other sectors like consumer discretionary, we are bullish because there are more positives than what we expected.
Okay, all right. Take that point, Nimesh. While we are talking about consumption names, they are leading the recovery for the markets as well. But thank you so much for joining us today with your thoughts on the markets and macros. That's the word coming in from Bajaj Asset Management. By the way, there is a recovery which is underway in the markets. The Nifty is off 90 points from the lows of the day. We do have it trading with gains of around 50 points. Across the board, there are big gains that we are seeing. We do have the likes of HDFC Bank, Dr. Reddy's, there's SBI. So Bank Nifty is the one which is contributing to the gains that we are seeing from the lows of the day. There's Tech Mahindra, Eicher Motors, Titan, Bajaj Auto. So a lot of recovery in financials and some of these pharmaceutical names which is underway and leading to the gains that we are seeing on the markets as well. Bank Nifty, of course, continues to be in the red, but there is a recovery which is taking place. We'll slip into a short break. Up next, we'll be joined by Gulshan Pahuja of Motherson Sumi Wiring on their Q1 numbers. Stay tuned for that conversation.
Welcome back. The markets continue to remain very choppy. Just 5 minutes ago, before going into break, Sonal was highlighting the recovery from the lows of the day, and there you can see the recovery has started to get sold into yet again. So we are back at the flat line on the index. We are continuing our earnings coverage, moving on to the next corporate on the show, Motherson Sumi Wiring, and it reported a strong revenue growth, although margins were under pressure because of the inflation in copper and wage hikes that weighed on profitability as well. To discuss the quarter gone by and the road ahead, we are now being joined by the CFO, Gulshan Pahuja. Gulshan, good morning. Thank you for taking out time. Let's start off with the margins then straight away. The margins were under pressure despite revenue growth. You've highlighted factors. How much of that came due to the copper inflation, and prices are still remaining at record high levels in the global markets still? Do you believe that this pressure continues to persist as you go into the second half of the year as well? What kind of steps you are taking to mitigate that?
Good morning, and first of all, thank you so much for having us on CNBC TV 18. You have seen that the quarter has been phenomenal. In terms of the growth, there is a year-on-year growth of 37%. And if you just take out the copper inflation of 7%, growth is still there, 30%. And it's an account of various factors. You have volume on your side from the industry, where the industry grew by 17%. And the other factors which led to this kind of growth is like content per vehicle increases, premiumizations and shipping our demands quarter on quarter, and our presence on the new model launches. So that's the growth story. So as far as cost pressure are concerned, they are continue to be there. So copper have been very, very high levels in the previous quarter as well, and quarter on quarter there's upsurge of 7% also, which we have seen in this quarter, which again has some lag impacts in our current quarter profitability. On the top of that, there are some of the minimum wage revisions across the states, especially in NCR region, where the impact is more than what is reflected in our results. So that the cost pressures are there. So in the beginning of the fiscal year, we have not anticipated that this much increase to the tune of 30 to 40%, which we have seen in this quarter. So that is the main reason which tracked our the profitability in this quarter. But we are hopeful that we should be able to minimize that by increasing our productivity. Of course, our discussions with the customers are also on for this much increases.
Okay. Gulshan, based on the visibility that you have right now, though you are guiding for increasing productivity, what can you guide on margins, considering that you have taken I think wage hikes, plus you are seeing this upside in terms of copper prices. So if you did 7.6% in this quarter, what are we expecting in the coming quarters, and what might your exit margins be based on the internal steps that the company is also taking to mitigate all of the cost pressures?
I think one of the things we need to understand from this quarter is that even if this minimum wage revision impact is quite significant. Just take out that impact, so marginally directions are going in a very, very, very good. I mean, there is significant improvement from the previous quarter as far as margins are concerned. The second is, obviously, this increase is not usual. The increase in the tune of 30 to 40%, where our product is quite manpower intensive. So see, directionally, we are going in a way where we have been improving from this quarter onwards. But having said so, our company is quite growth-focused company. And if you look at the margins, looking at the margin on quarterly basis is not a right picture. So you have to look at it at 3 to 4 quarters. Then I think the suitability of the margin would be better. And as I mentioned, that we are a growth-focused company. And in the past years also, from the last 4 years, we have been consistently delivering more than 40% growth. So I think...
So just on that point, I know you can't look at it on a quarterly basis. So what is the exit rate that you're looking at for FY27 when it comes to margins?
See, you're going with a very cost-challenging environment these days. At the inception of this quarter, nobody has predicted that this much increase in the wages would be happening, right? So you have seen that impacts, and I cannot predict what kind of cost additional challenges would be there in the next quarters. So that's why I just focus that in terms of rows, we try to deliver, our focus is to deliver more than 40% growth by the end of the year, and it will be reflected in our margins also. Because the margins would be better, then only we would be able to deliver that 40%. Okay, so I think you have to maintain that now.
Okay, so you're looking at return on capital employed at 40% going forward as well, unable to give a margin guidance because things are very volatile on the supply side. Gulshan, you also mentioned premiumization is something which is leading to growth. Is this something which is flowing to the bottom line? I want to understand because EV continues to be getting bigger in your portfolio. Are the margins higher there? What is the content per vehicle that you've seen in your core portfolio versus EV portfolio? If you can give us those specific numbers.
We don't see the business with the lens of EV or ICE. See, what our focus is to remain relevant for our customers and how the customer behave in the market. So we are engine agnostic organizations. Be it, and always try to be relevant for our customer. Be it ICE platform, be it hybrid, be it your EV platforms. As far as current traction of the EV is concerned in the market, our share of 8.6 is relatively better than that. So as far as customer needs are evolving, we need to remain relevant for that.
No, Gulshan, I totally get that point. I'm trying to understand it from an investor's perspective. Does EV come at a higher margin for you as a business? Because we have seen other companies talk about it being a higher margin business. So just I'll make us understand whether it's a higher margin business for you as well or not. And what has been the content per vehicle here in this case? How do you plan to improve it going forward? If the supply side issues are not remaining, what is the growth plan?
See, that is what I'm trying to explain that. See, when the EV models would always are content accretive.
Yeah,
so
how much more is that?
In the content per vehicle. See, generally, what we have seen in the passenger vehicle, if the ICE is like 1.6 in terms of the content per vehicle increases in the EV. So first, the content increases is there as far as EVs are concerned. But as far as margins are concerned, that is what I'm trying to tell you is that it depends on model to model. It is not like that this particular EV model will give you more margins and this particular EV model is. So whenever we pitch for any RFP for a new product, our purpose is to have the more and more margins only, and that is what we are. But it not depends upon that the EV will translate into a more profitability or be it like or ICE will turn into a less profitability. That's not the case with us. That's what I'm trying to tell you. That's all. You have to look at the blended margin. Then only you would be able to turn out the product profitability.
So now that you are at 8.5% when it comes to electric vehicles as a part of your overall sales, how much do you plan on taking it by the end of the year?
Our plan is to go as the industry grows. So whatever the volumes we have received so far, our forecast is that we plan to evolve with the same traction we have the same. Because currently his market is around 8%, and we are around 8.5%.
So would 15% be a fair number by the end of the year?
Depends how the market is. That's it.
All right, Gulshan, tight-lipped in this conversation about a lot of parameters. So we're hoping that you get more visibility as the year goes on, and we discuss more guidance and your EV market share as well. So that's Motherson Wiring. That stock up around 5% for the markets as well, just about flat for the Nifty. So higher by around 17 odd points. The Bank Nifty sulking a little bit, so down around 0.2%. Let's see whether there's any kind of movement which takes place on the banks. We'll take a short break, but we'll get you a lot more in terms of markets on the other side. Stay tuned.
Welcome back. Markets continue to be very volatile. Nifty now is absolutely flat with some positive bias. So the seesaw move continues on the Nifty for now. But there is a new kid on the block. Manipal Health, which operates Manipal hospitals across India, has made a steady debut on the street with gains of around 10%. Ekta, tell us more.
Well, yes, it's a good debut for Manipal. It's one of the largest healthcare IPOs in recent times. So 9,275 crores is what they've raised via the IPO, 8,000 crores via fresh issue. Subscription was okay. It was just about 4.92 times totally, QIB 8.25 times, NII at around 1 times. Now, remember the anchor book was very strong for them. They raised around 4,167 crores from 133 anchor investors. This was at the upper end. The price band, remember, was between 560 to 590. Now, Manipal Hospitals itself, pan-India multi-speciality hospital network, 49 hospitals, 13,000 licensed beds, India's largest private hospital network by licensed bed capacity and second highest revenue amongst private hospital chains. Now, the use of the proceeds, 8,000 odd crores, majority will go into debt repayment and the remaining will go into buying stake for Sahyadri hospitals, and post this they would be retiring around 47.5% of their debt. In terms of financials, they did around 10,300 crores in terms of FY26 revenue. EBITDA margin pre-exceptional was at around 27.05%. Now, what has the company said and what can we expect from the company going forward? It will be net debt zero post the IPO fund infusion. M&A, they are looking at Delhi and North as a focus area going forward. They do have launches lined up in the city of Mumbai. They did buy a hospital in Juhu around 18 months ago. So the launch should come about in the next 1 to 2 years. Sahyadri, their recent acquisition which took place, the target is improving margins to 23% from the current 18%. Price regulation, obviously, for all hospitals remains a risk. And as of now, Temasek, which is going to be the promoter of this company or the largest shareholder, has no plans to exit at this point in time. Guidance, occupancy is 65%, aspiration 75 to 80 odd %, blended RPOB or revenue per occupied bed is around 72,000 rupees per day. They're looking to hike it up by around 9 to 10 odd %. In terms of valuations, trading on the higher end, you would have to say, as compared to the other hospitals on a FY26 PE basis. So over 75 odd times is where Manipal is.
You take a 10% gain any day in a market like this. Strong, steady listing, you can call it that, for Manipal Health. The issue price of 590, still holding on to levels of around 650. Now, speaking of earnings reactions, then PNB Housing was one such name, came out with numbers after market hours yesterday. Ananya is here to break the numbers down for us. Ananya.
Well, yes, it was a good quarter for PNB Housing. Why I'm saying this? Because the numbers were operationally in line. Asset quality was stable. Credit costs were negative. And but if you look at the margins, there was some compression, with management clear that it has bottomed out and will improve from Q2 onwards. Now, if you look at the numbers, the loan book grew 15% year-on-year basis. AUM grew 13%. NII at 6% year-on-year. PPOP at 9%, while PAT increased 4% but was down 15% due to the NIMs, like I mentioned. And ROA and ROE also have moderated. Yields, if you look at on year-on-year basis, have compressed, was down 60 bips year-on-year basis, but is stable quarter-on-quarter if you see. Now, like I mentioned, asset quality was strong, with GNPA at 0.95% and NPA at 0.58%, both better year-on-year if you see. Credit costs continue to stay negative, supported by recoveries, with 67 crore recovered from the written-off pool year. Now, management also maintained 18 to 20% loan growth guidance, with affordable and emerging segment expected to remain the key growth driver, while credit costs will continue to stay negative going forward. So we'll watch out for these from Q2 onwards.
Okay, thank you, Ananya, for bringing us all those details. That's PNB Housing Finance, higher by 4%. While some of these stocks are doing well, markets continue to be very volatile. So let's get in Sudarshan. He's bringing us the latest trends from the F&O space. Sudarshan, over to you.
So market is completely, it's like you can say in the consolidation mode or whatever, but RBI's policy, as far as it's concerned, experts believe its tone was largely on the dovish side. At one point, we did try to hit the level of around 24,670, but now again, we are back to the levels of 24,615. Now, if you take a look at the PCR, Nifty PCR, now it's back of 1.07 versus yesterday's level of 0.99. It indicates you that there is a more put writing than the call writing. That tells you, that gives you a bit of confidence that in all probability, Nifty might close above the level of 24,600 because major action is happening in the range of 24,500 to 24,700. So on the put side, 24,600 if you take a look and 24,500. Maximum change in the open interest we are seeing, but at the same time premium for both these put options has seen a fall. On the call side, 24,700. And another call option which has been active the most is 25,000. So in near term, 25,000 remains a probability, but we'll have to see how does it move. So support 24,515, that's Monday's intraday low, and resistance, first resistance will be 24,850. As far as Nifty Bank is concerned, support will be 57,450 and resistance would be 57,900. Some of the stocks that I'll keep an eye on, first one, Godrej Properties. Earnings were largely better than expectations, but what has helped the stock to move 4% higher is the commentary, and on the guidance front, they believe that either they will exceed or manage to meet the guidance, whatever they have given for FY27. Minda again, positive guidance. They are saying that for FY27, margin is going to be 11%. Plus minus 50 basis points. That's the reason 2% up move. UPL, yesterday it was seeing addition on the short side. Today also it's seeing addition on the short side.
Every time Sudarshan does not leave us with a proverb, the viewers are left very disappointed. They log in every morning to listen to him to say exactly that. He has not said anything today. That shows the state of the market also. But anyway, Sudarshan, thank you for that. The couple of stocks that are extending their gains right now. ASK Automotive is now up 13%. That's at the record high as well. RR Kabel has extended its gains. Now is up around 5% as well. And a couple of other names, Bata India, Graphite India, Emphasis, all of them seeing gains of well over 4%. Take a short break, continue corporate conversations. On the other side, the management of Symphony joins in to discuss the road ahead for their company. Stay tuned.
Welcome back. A little bit of a recovery for the markets at this point in time. So 24,600 is currently where the Nifty is holding, but you'd have to say it's a tight range. It's range bound. It's a bit choppy in today's trading session. But a couple of stocks are managing to hold up. So Sudeep Pharma released its numbers. That stock is managing to hold up with a gain of around 4%. Newland Labs, which comes out with its numbers today, is holding up with a gain of around 3%. So it's going strong into its numbers. Now that's on pharma, but the entire healthcare space is showing a different trend. We have Metropolis, which released its numbers yesterday. That stock is down around 1.8% at this point in time. So it's a weak post its numbers. And we even have Fortis, which is releasing its numbers this week. And that too is under pressure ahead of its numbers. So that stock is down around 1% from the hospital space. So that's what's taking place in the pharmaceutical and healthcare space at this point in time. But let's get to another story then. Supreme Court has extended the mandatory third-party motor insurance coverage of new vehicles. Yash is here with this story. He joins in with more details on this. Yash, go ahead.
Well, the general insurance companies for years now have been asking for a motor third-party premium increase. That was from the Road Transport Ministry as well as the insurance regulator. But the blessing came from a very unexpected corner, and that was Supreme Court in the form of extending period for the mandatory motor third-party insurance cover. Let's just understand what happens right now. Whenever a new vehicle is bought, a two-wheeler or a four-wheeler, a motor insurance policy comes along with it, in which the motor third-party, which is a mandatory insurance cover, also comes along, and that has to be bought for a minimum period of 5 years for two-wheelers and 3 years for four-wheelers. The payment in terms of the premium payment has to be done upfront for that entire period of 5 years and the entire period of 3 years, depending on the class of the vehicle. Now, what Supreme Court has done is that it has added one more year to both those classes of vehicles when it comes to that mandatory motor third-party cover, which means that whenever a new vehicle is bought, a two-wheeler or a four-wheeler, a mandatory motor third-party insurance will come along with it for a minimum period of 6 years versus the current 5 years for two-wheelers, and 4 years versus the current 3 years when it comes to four-wheelers, which also means that the upfront premium payment will have to happen for 6 years instead of 5 years for two-wheelers and 4 years instead of 3 years for four-wheelers, which means a higher income booking in terms of premium receivable for insurance companies. Definitely a mild negative for auto companies, because this could increase the purchasing price of that vehicle by a couple of percentage points, but certainly a big positive for general insurance companies. They'll get to book higher amount of premium on sale of every new vehicle.
Okay, all right, Yash, that point is taken. Thanks very much for joining in and giving us that story. So general insurance companies would benefit from that. But let's talk about companies then and numbers. Symphony posted what was a good set of Q1 earnings. Margins expanded, but the net profits saw a decline on the back of higher input costs. To discuss more on their Q1 numbers, we have with us the Managing Director of Corporate Affairs, Nupesh Shah, who's joining in. Mr. Shah, thank you very much for taking the time out. So revenue growth was around 8% Majority of it, we do understand, was led by the domestic business. Just give us a sense in terms of what the volume picture was like for the domestic business. What was the breakup between price and volume? And what can you guide for? Okay, I think we have a little bit of a rough connection with Mr. Shah. Can you hear me?
I can hear you.
Okay, go ahead. If you could just start by giving us a sense in terms of what the domestic business did in Q1, if you could break up the volume and price growth, and what might that mean in terms of the next couple of quarters?
Yeah, so as far as Symphony India is concerned, our standalone top line has increased by 8%. However, domestic business grew by 15%, and that is completely volume-led growth. I will bifurcate it into two parts. One is the general trade, as general trade was sitting on huge unprecedented inventory. At their level, they completely sold off, and on top of it, we sold. So general trade sales was subdued during the quarter, but alternate channels, which comprises of large format store, RCS, e-commerce and D2C, registered more than 100% growth, reflecting very robust demand and sentiments. And importantly, year-end at a level of company, and at a level of trade channel, inventories completely normalized.
Okay, all right. So inventories have normalized. There is strong growth in the alternate channels. Mr. Shah, wanted your take on the export market as well. How is that performing in different geographies, be it US, be it Middle East? And what kind of growth did you see there? You expect FY27 margins to be better than FY26. What is that based on, despite the input cost pressures?
Particularly two geographies have done very well for us. One is United States, where YOY there has been 35% growth on account of the heat wave over there, and that is completely stock out with a robust margin and profitability. Similarly, in China, there has been a robust growth on account of sale in domestic market, exports from China, and also sale of large space ventilated air cooling. As far as IMCO Mexico is concerned, there it has been so far a subdued summer, and it was YOY some decline. And as far as climate technology, it has maintained its status in terms of low performing company. And about exports from India, particularly on account of geopolitical reasons and supply constraints and shipping constraints, we couldn't supply and export to Middle East during last quarter.
How much are you getting from US currently, Mr. Shah, as part of your overall top line? Is there a plan to grow that business further? And were you not looking at Europe as a geography? Because Europe has also been in the middle of a very blistering heat wave of its own.
Absolutely. No, so in USA, as I said, whatever we sold is completely stock out, even much earlier. And obviously, if this kind of the season continues, we do expect major growth over there. And some of the befitting models under our established brands in USA that also really work very well. As far as Europe is concerned, you are right. So we have initiated some strategies and steps towards that so that we can capture the market over there.
Okay. Your Australian business, we do understand that, it was pressured and you've guided in terms of divesting of stake in FY27. Can you just tell us what the update is on that market in particular?
So in December 25 itself, we revised the guidance saying that we explore that, but we were not getting adequate value. And due to strategic reasons, we decided to retain IMCO Mexico as well as its USA part. And hence, USA has been completely hived off and it has been made a direct subsidiary of Symphony India. As far as climate technology Australia is concerned, so we have already publicly declared that henceforth there won't be any further capital allocation. In fact, by March 26, entire investments has been completely impaired. Now nothing is left to impair. And on top of it, its total loan, about 225 crore in INR, acquisition loan and working capital loan, we have completely repaid, already accounted for in March 26.
Okay. So, Mr. Rupesh, last question before we let you go. If you had to guide for FY27 in terms of volume growth, both in domestic and export markets, and also margins, what would those numbers be? If you cannot give exact numbers because of whatever supply chain issues we are seeing, what would a qualitative figure here be if you can give us a range?
So, as per IR policy, I can't share the exact number or precise guidance, but considering there is a normalization of inventory at trade and company level, considering the overall robust demand and sentiments as we witness across alternate channels in some, it seems we are on a good start and we are looking ahead good year, not only in terms of domestic business, but also in terms of the BISP business, which is beyond India summer products that contributes 23% in standalone and about 48% on console. And our overseas subsidiaries, except Australia business. We expect them to deliver better and well.
Mr. Shah, pleasure having you as always. Thank you for sparing time and joining us. Wish you good luck for the rest of the year as well. Take a short break, then the management of Emami joins in on the other side to continue our earnings coverage. Stay tuned. Welcome back. Continuing our earnings coverage, the management of Emami joins in after its first quarter results. The revenues were up 15% from last year. Margins, though, saw a bit of an impact. To discuss the quarter gone by, we are now being joined by NH Bansali, the CEO of Finance Strategy and Business Development, and the company CFO as well. Mr. Bansali, good morning. Thank you for taking out time. You're starting off with the margin picture again. The gross margins saw some decline this quarter. But are you seeing this as a one-off this time around, or do you believe that the margins that you have reported this quarter, you would believe you would stay in this range itself for the rest of the year as well?
Yeah, it's very difficult to say exactly, because what's the reason for that margin decline? In terms of the COG as it is, there has been a decline of 360 basis points. There are two things. One is on because of the overall revenue mix. So that revenue mix probably may continue to around 1.5% kind of margin reduction going forward also. But for the cost push which has happened, mainly because of the crude and inflation rate cost push which has happened, I believe if the things settles down in 1 or 2 quarters, then it may get restored to the original level.
Okay.
We have also, in fact, we have also resorted to some moderate price increases in the earlier period, and we would again come back with some moderate price increases in the next 1 or 2 quarters further.
So when you say moderate, how much are they? Low single digits, mid single digits? And what kind of price growth are you looking at going forward? And considering the price growth, what would the revenue growth look like in FY27? Like for like and with the acquisitions as well? What are you targeting for volumes as well?
You have a lot many questions at the same.
The same line item, hence.
As you have witnessed, so we have delivered 15% overall growth with 20% on the domestic side of a growth, and which also includes our strategic investments and like-to-like growth of 12%. And so we expect this trajectory to continue. One can expect a strong double-digit growth for the FY27. And in terms of overall margins also, we expect this to improve, but would broadly, because of the cost push, the gross margin could be under some pressure. And so there could be some reduction in the gross margin, but still overall, we believe it would be a good profitable growth.
How is your new age portfolio doing, Mr. Bhansali? I think there's an 18% contribution to your total domestic business. How much do you think it is growing at this point in time, and how much do you think it can probably grow at for the entire year?
So for the first quarter, it has grown by 61% on a like-to-like basis. Though because there had been two additions in the current financial year, and so on the reported number, it is almost more than 3 times what was there in the last quarter same period. But going forward, we expect a very aggressive growth to come from these strategic investments as well. And this contribution over a period, which is now at 18%, is going to increase.
So just tell us what aggressive means in terms of numbers, and 18% goes to what by when?
So in a little longer term, we expect medium to longer term to increase up to 25%. Very difficult to put a very specific number there, but we expect a good growth to come in from these investments.
Fair to assume, Mr. Bhansali, that you would still end the year at 20% margins, if not 21 or 23. That's part one. And two being the fact that we have had an extended summer this time around. 40% of your sales come from the summer portfolio. Is there a normalization of trend that you see, or is this where we leave the year as well?
Yeah, summer has almost, this first quarter has witnessed a very disrupted summer. If you look at in the south and east, it was relatively good, but in the north there had been an intermittent monsoon also, and so this has impacted the offtakes. But nevertheless, there has been a good growth.
Mr. Bhansali, I would like to come back on the price hikes again. Is it only happening in the older portfolio, or the new age portfolio will also see price hikes, considering that there is cost issues across the board? And when will the new age portfolio turn profitable as well?
So on an overall basis, it is near to the profitability now, near to the profitability on an overall strategic investments. We are not too far. And we expect in the next few quarters to be more on an earning side as well.
Quickly on the price hikes, you didn't answer that. How much was it? How much do you plan to take further?
We have already considered around 3 to 4%, and which is normal on an annualized basis. We expect further around 2-3% kind of a price. We will be very calibrated price hikes would be there on an overall basis.
Okay, all right, Mr. Bhansali, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's Emami. That stock is up around 2.3% at this point in time. Maybe we can just pull up the yield and see what that particular parameter is doing post the RBI policy. It had softened a little bit to around 6.77. So let's see where that is at this point in time. Maybe we can pull that up for you. For the Nifty, just about lower by around 42 odd points. Mixed day, Bank Nifty has shown recovery from the day's lows. So that's the yield for you, just about holding at around 6.77 versus 6.8 or thereabout just before the RBI policy. We'll take a short break. We'll get you more on the markets once we're back. Stay tuned.
Welcome back. The markets continue to be very volatile. Nifty is closer to the day's low. We have the heavyweights, the likes of ICICI Bank, there's Tata Steel and Reliance Industries. All three of them leading to the pressure that we're seeing on the Nifty currently. And look at that. ICICI Bank at the day's low. We have Tata Steel and Reliance Industries, all of them putting that pressure that we're seeing. And we do have the RBI presser, which will be starting very soon. But before that, let's talk about Bharti Airtel. It beat estimates in Q1. Consolidated revenue rose. India mobile performance also surprised positively. Reema is joining us now with the analysis. Reema.
Thanks so much for that. So Bharti Airtel, the stock price is flat, but the performance is actually pretty good. Consolidated numbers have come in ahead of expectations. Airtel Africa was a strong performance that we knew. What we learned yesterday is that the India mobile business has also done ahead of expectations, and it's also industry leading. So for the India mobile business, the company's top line revenue growth was at 3.8%. This is ahead of Jio at 2.5% and ahead of market expectations of 2 to 2.5%. And the positive surprise was the average revenue per user, ARPU, which is your monthly bill that we pay. Now that went up from 257 to 264. The expectation was that it'll go up, but 1.5%, because there was no headline tariff increase. But perhaps, maybe, this is what one of the analysts was speculating, that maybe on account of large sporting events like an IPL, FIFA World Cup, we did see many people upgrade their data packs. So that may have resulted in an ARPU burst in the current quarter. That said, ahead of expectations, ahead of peers, and the street likes the performance. The conference call will begin at 12 o'clock, so we will get more details from that.
You'll get more details on that for sure. Keep an eye out on Bharti Airtel as well. So it's continue to remain around the flat line. Of course, the stock has been a big outperformer in this year as well. So nearing the levels of 2000. Reema, thank you for that update there. Take your leave on this edition of Trading Hour from Sonal, Ekta and me. Thank you for watching. Halftime report on the other side and the RBI Governor's press conference.
season we spent 1 day in office. That used to be the
Yeah. No.
You need to have
Really? That's only once in a while, you have so nice sea breeze, the clouds. Hey, you need to go to, Rajasthan. You'll get, all the gardens and everything. Then you'll realize that you are staying in bliss, I may say. Okay.
Yeah. So, with your permission, shall we start? Good afternoon, everyone. Welcome to this post-policy press conference, third for the financial year 2026-27. We have with us Governor, Reserve Bank of India, Shri Sanjay Malhotra, along with Deputy Governors, Shri Swaminathan J, Dr. Poonam Gupta, Shri Shirish Chandra Murmu, and Shri Rohit Jain. We also have with us Executive Directors, Shri Sanjay Kumar Hansda, Shri Indranil Bhattacharya, and for the first time, Shri Ravi Shankar. I also welcome my other colleagues from the Reserve Bank. Sir, there are 26 participants from the media. And before we begin, we have two housekeeping announcements. First, I request the media participants to please stick to only one question. I repeat, only one question, so that everyone gets a chance. And second, request everyone to please switch on the mic while speaking, so that those watching the live telecast are able to hear clearly. And once you have finished speaking, please switch off the mic. So with your permission, I will now call out the names.
Yeah, please do so. Even I want to emphasize that, please ask only one question. And in case you ask two questions, then I have the option to answer which question I will answer. So please be very sure which question you want to ask. And in case there are questions left, which I doubt there will be, we can come back. So don't think that your question will go unanswered, provided it's a different question which has not been asked by any of the 26 participants who are here. So kindly, let's follow this rule and keep it brief. So first question, as usual, is by Lata. And then, right?
Yeah.
So you are changing the sequence?
No sequence, sir. Yeah.
Okay.
Yeah. Thank you, sir. I'll request Ms. Lata Venkatesh from CNBC TV18 to please ask the first question. Lata, please.
Thank you very much, Mr. Brijraj, Governor, and everybody. Sir, the market found your policy statement more dovish than expected. And their reasoning was, if you look at your inflation forecasts, it is above 5% for almost 1 year. That means well above your target by 100 basis points, well above the given target. As well, the real rate, therefore, becomes negative for a better part of the next 6 months or so. So is it that you are going to concentrate on core inflation? And when you deduct, you're looking at T-bill. If you take the T-bill 1 year ahead and deduct the 1 year ahead core, only then you come somewhere near a real rate of 1.4. I mean, are you going to be reconciled to a negative real rate or a very, very low real rate?
So let me first of all say, we are neither, dovish nor are we hawkish. We feel that this is the right policy rate for the given growth inflation dynamics that we are in today and the outlook that we have projected ourselves. There is a lot of uncertainty, which will, of course, play out. The framework is very clear. I don't think there should be any confusion about the framework. Our target is headline. It's not core or core excluding pressure. It is the headline inflation, which is the target which has been given to us, and we'll continue to be guided by the headline inflation. And it will be our commitment, it is our endeavor to bring the headline inflation in line with the target over the medium term. As was mentioned even earlier. Now, why we look at core and core is because we need to know as to what the underlying inflation is and where headline or underlying inflation is going to converge going forward, because headline inflation because of food and now because of fuel, because of the external shocks, can be very volatile. And so, as I mentioned even in the earlier press conference, that this volatility is not something that we would like to bring in even in our policy repo rate. So it's in the medium term that we target our policy medium term target our headline inflation, and accordingly, we will take action as may be required, given the outlook and how the growth inflation dynamics play out.
Thank you, sir. We'll take some more questions from our left side before we come to this side. I'll now request Manojit Saha from Business Standard to ask his question. Manojit, please.
Thank you, sir. Thank you. My question is on FCNRB scheme. Is there an option for you to close the scheme prematurely before the deadline in case a certain amount of inflows coming? You may have a target in your mind. So, because I'm asking this because there is a cost to this scheme because RBI is subsidizing it, and there is a view that the situation is now not as bad as 2013, where India was considered a fragile five. Forex reserves were only 275 billion as compared to 700 billion around. So that concern is there. So is there an option to close it prematurely once you get the amount of deposits which you may have in your mind?
We have got robust flows, as you have mentioned, and we do hope to get good, healthy flows going forward. As of now, there is no proposal under consideration to close the scheme prematurely. We will keep you posted on this.
Thank you, sir. I'll now request Anup Roy from Bloomberg to ask his question. Anup, please.
Thank you, sir. Sir, we have seen $40 billion being mobilized by the FCNRB scheme, and yet the rupee has not appreciated much. I'm just trying to understand what is happening there. Is it because you are squaring off your forward position and the dollar is not coming into the market? Can you please let us know what is happening there?
I think the underlying fundamentals of our Indian economy are very strong, as I have earlier mentioned. There can be an argument, as some people have made, that it is perhaps, on nominal or real effective exchange rate terms, it may be undervalued. There is a lot of uncertainty. It is quite possible going forward as the tensions and the conflict de-escalates, it is quite possible that the rupee may further strengthen. It has strengthened over the last 1 month or so. It has strengthened from 97 levels now to about 95 levels. So it has strengthened. And our policy has always been that the markets determine the prices level and the band. We don't pursue. We only we only intervene in case there is an excessive volatility, there are speculative pressures that are getting built in. And it will be our endeavor that the trajectory for rupee remains orderly and there is no disruptive movement, or there is no expectation, self-fulfilling expectations getting built into the exchange rate.
Yes. Thank you.
Thank you, sir. I'll request Hamsini Karthik from Money Control to ask her question. Hamsini, please.
Thank you, sir.
Good afternoon. My question is also pertaining to FC and RB. I would like to understand if you could please help us with the geographical split of where this deposit flow has really come from and whether the deposit flow has ticked all the boxes in terms of BOP management, liquidity, and forex from an RBI standpoint.
Yes, as of now, it has ticked all the boxes. You asked two questions, but they are related, so it's okay.
Thank you.
And your second question is geographies we don't have. We don't collect geographies. But the flows, as I said, have been robust. We had, even before these measures, a very strong and a comfortable external position. This further fortifies our external position, including the BOP.
Thank you, sir.
Thank you, sir. I'll request Ekta Suri from Z Business to ask her question. Ekta, please.
आज आपने अपनी पॉलिसी में एक स्टेटमेंट से बताया कि मार्जिन्स जो हैं बैंक्स के अब उतने शायद ल्यूक्रेटिव या उतने अच्छे नहीं हैं. आपने ऑफ कोर्स इंग्लिश में बोला था, लेकिन उतने बेटर नहीं है जितने पहले होते थे. तो सर, क्या सर आरबीआई ने इसे अकाउंट में लिया और इसी वजह से जो आपने बल्क डिपॉजिट्स पर डिफरेंशियल रेट्स का पेपर निकाला, क्या उसकी एक वजह ये भी है? और क्या आरबीआई इसको ट्रैक करेगा कि बल्क डिपॉजिट्स पे बैंक्स जो हैं जो किसी और तरीके से मार्केटिंग एक्सपेंस या किसी और तरीके से ज्यादा पार्टीज को फेवर कर रहे थे या उनको एक्स्ट्रा पैसे दे रहे थे डिपॉजिट्स के नाम पर, सर उसको क्या आरबीआई ट्रैक करेगा? और ऐसे ही बैंक्स जो हैं अपनी जब रिजल्ट्स आते हैं तो सर उसमें टेम्पररी फिक्स डिपॉजिट्स लेकर अपने कासा को इन्फ्लेटेड तरीके से दिखाते हैं, तो इसको आरबीआई किस तरह से लेगा सर? सर सब कुछ डिपॉजिट से ही रिलेटेड है.
3 क्वेश्चन आपने पूछ लिए एक में.
सर अंडर वन अम्ब्रेला ऑफ डिपॉजिट्स.
वो एफसीएनआरबी में भी उन्होंने 2 पूछ लिए. बल्क जो हमने इंटरेस्ट रेट के गाइडलाइंस जो आज निकाले हैं या पहले जो निकाले थे, आपने पहले वाले के लिए जिक्र किया, वो निम की वजह से, निम में जो कमी हुई उसकी वजह से नहीं थे. वो जो अंडरलाइंग कॉस्ट है डिपॉजिट की, जो भिन्न जो डिपॉजिट जमा करता है उनके लिए भिन्न हो सकती है, क्योंकि हमारे जो दिशा निर्देश हैं विशेष करके एलसीआर के लिए वो अलग हैं. तो उस चीज़ को ध्यान में रखते हुए हमने वो गाइडलाइंस निकाले थे.
So the other 2 parts.
अदर 2 पार्ट्स अगर नहीं आएगा वो क्वेश्चन, अगर कोई नहीं पूछ लेगा तो ठीक है, नहीं पूछेगा तो आई विल कम बैक, तो वापस आपके पास आएंगे.
थैंक यू.
अगर कोई पूछ लेगा तो ठीक है, नहीं पूछेगा तो फिर वापस आपके पास आएंगे.
थैंक यू.
सभी प्रश्नों का जवाब जरूर दिया जाएगा, बशर्ते समय की सीमा में रहे.
धन्यवाद सर.
Yes, Suraj.
I'll now request Anurag Shah from ET Now Swadesh to ask his question. Anurag, please.
नमस्ते सर. सर, जिस तरह से आज एक बड़ा ऐलान किया गया है आपके द्वारा लोन इंटरेस्ट रेट कैलकुलेशन का, तो सर ये क्या उसी तरह का बड़ा ऐलान है जिस तरह आपने अभी मिस सेलिंग से जुड़ा हुआ एक ऐलान किया था, जो 1 जनवरी से नियम लागू हो रहे हैं, जिसकी काफ़ी सराहना भी हुई, बाकी रेगुलेटर के द्वारा भी सराहना की गई. तो लोन इंटरेस्ट रेट कैलकुलेशन के नियमों से सर आम जो करोड़ों लोन लेने वाले लोग हैं उनको क्या राहत मिलेगी, कब तक इसके नियम लागू होंगे और किस तरह से आरबीआई एक दिशा निर्देश देगा जिससे लोगों को राहत मिलेगी?
ये जो इंटरेस्ट रेट के नियम हैं, इसका प्रमुख जो कारण है वो ये है कि विभिन्न जो हमारे रेगुलेटेड एंटिटीज़ हैं उनके लिए भिन्न भिन्न निर्देश दिए हुए थे. तो उसको युक्ति युक्त करने के लिए और स्टैंडर्डाइज करने के लिए हमने ये नियम निकाले हैं. और इससे ट्रांसपेरेंसी, पारदर्शिता वो भी बढ़ेगी, क्योंकि लोगों को सबको मालूम रहेगा कि जो ब्याज दरें हैं वो क्या हैं, किस प्रकार से सेट की जाती हैं. तो मुख्यतः ये एक रैशनलाइजेशन एक्सरसाइज है जो कि कंज्यूमर प्रोटेक्शन को और अधिक बढ़ाएगी।
तो लोगों को ये नहीं समझना चाहिए कि ईएमआई बदल जाएगी, ईएमआई तो उतनी रहेगी, लेकिन आपको
जी हाँ जी बिल्कुल
सही पारदर्शिता तरीके से अपना ब्याज और प्रिंसिपल समझ में आएगा।
Sir, can you please repeat in English, because that was to be my second question also. The market is very confused. What do you mean by all regulated entities? Will NBFCs have to declare EBLR? All those confusions are there.
NBFCs have to have external benchmark.
देखिए वो all those details will be there in the draft guidelines that we are coming out with. So please wait for those guidelines. All the details are over there. It is not a major change, as I have mentioned to you. There is no requirement. There is no major change in requirement as you are referring to with regard to NBFCs and bringing them on to EBLR, etc. There is no major change. There is only a rationalization. Perhaps DG Shirish can further clarify.
No, you are right, sir. You have to wait for the circular to come out. Only thing I can tell is no major change, and emphasis is on transparency and basically conduct related. So don't look at the substantive part, but nevertheless, wait for the circular. It will come out soon. Thank you.
Okay. Yeah, thank you, sir. Sir, we'll now take a few questions from the right side. I'll request Sangeeta Mehta from Economic Times to ask her question. Sangeeta, please.
Thank you. So this, your policy statement, you have said that transmission of policy rates have moderated. And now with the swap window being opened, we expect liquidity to surge, and it has surged and it might surge further. But do you expect banks to pass on the benefits of liquidity to the customers? Because banks are already talking about improving NIMs and things like that. So it's kind of wanted to understand that.
Liquidity will obviously help everyone. It was required, but let me mention that the liquidity may be in surplus only, for the very short term. It may peak, around in Q2, around September or so. And going forward, it should get absorbed because of our normal needs of the economy through increase in currency in circulation, higher requirement for reserves because of deposit growth. We also have some forwards which are getting matured. So overall, of course, it will help, but it is not something that is extraordinarily high liquidity.
Doesn't answer that. Would you expect banks to still have some?
As I mentioned, it is not substantial. So it will only help, at the very margins. It's not extraordinary or substantial over a very short period of time. And this is the kind of liquidity that we, even otherwise, every year, through OMOs and other means, through swaps, we provide this kind of a liquidity. Now, a lot of it, of course, will depend on the amount of FCNRB deposits that we will get, but it should, more or less, it should get absorbed in the medium term.
Thank you, sir. I'll request Jasprit Kalra from Thomson Reuters to ask his question. Jasprit, please.
Thank you, sir. Governor, my question relates to succession planning at banks. There have been instances where banks have taken longer than a 6-month renewal cycle for the top leadership. Some other places, CEOs have left within one term. Given the ambition for India to have larger banks that can have a global reach, analysts have also pointed out that the tight grip on compensation, etc., for top talent at banks can have a limiting impact on the sort of talent banks themselves can draw. Do you see room to sort of review some of these rules that are in place and maybe relax some of them going forward?
There is no proposal as
well, given the ambition to have larger banks.
We obviously have a need. I mean, we all obviously, would like and aspire to have more and more banks. But whether it is coming in the way or not, as I mentioned, has not been examined by us, and there is no proposal in this regard, which is pending.
Thank you.
Yeah, thank you, sir. I'll request Piyush Shukla from NDTV Profit to ask his question. Piyush, please.
Good afternoon, Governor, DGs. Thank you, Brit, sir. Sir, yesterday the government has made some amendments to the Payments Act. Now there is chatter that there could be, government may levy MDR on certain transaction, whether above 2,000 rupees, or it could use that on large retailers. You have earlier mentioned how somebody has to bear a cost for this public infrastructure utility. I want to understand from RBI, will we look at transaction size? Will we target certain retailers? What is the strategy going ahead? If you can share some views on this front, sir. And last time, sir, you had said that the upper layer list of NBFCs will come out very soon. So how soon will it come, sir?
So, your first question I will answer is that it is very premature. Right now, the government is still carrying out the amendment. The costs have to be paid by someone. I mean, it's a public, we all want, that this public infrastructure should continue to strengthen, become more efficient, etc. We continue to do that. That's our primary focus as of now. Let's wait and watch for further developments on this. I don't have anything more to add.
Will the user get charged, sir? Because if you're levying a fee on a merchant, eventually it passes on to customer. So the goal is to have 800 million transactions a day or so. So imposing a fee.
Let's wait. It's premature right now. But please keep in mind also that ultimately it is the consumer in some way or the other who's paying it already. So it may not be the same consumer. It may be, the general economy, and you don't get to see it directly. But already it's, to answer partly, your question, whether it gets passed on, and somehow, it's already getting passed on. It may not be directly on to the user pays principle, but someone is paying the cost. This is what I meant. Someone will have to pay the cost. I said this earlier, and even now I'm saying. So what is important is that we continue to invest and we continue to find the means, whether it is through MDR or other things. I think those are matters of detail. Let's wait and see how the situation evolves going forward.
Yeah. Thank you, sir. I'll request Ankur Mishra from ET Now to ask his question. Ankur, please.
Thank you, Brice, sir, and good afternoon, Governor. First of all, I just wanted to get what is the assumption on crude and rupee? Please don't consider it as question. To ask on, I want to understand your sense more on GDP front. In last policy, of course, the FY27 forecast was 6.9%, then it came to 6.6%, and now we are at 6.7%. Given in the first quarter itself, you're saying 7% growth is possible. Is there a scope of overall 7% growth for FY27 which is possible, considering the fact that the data which has come in the past also has been better than what was forecasted?
The 6.7% growth that we have estimate, the outlook that we have given is an estimate. And we have also mentioned that the risks are evenly balanced on both sides. We also give a fan chart to give, the relative probability distribution. So if you look at the fan chart, it will suggest that there is a possibility that the growth, to answer your question, there is a possibility that the growth may be 7 or more.
Yeah. Thank you, sir. I'll request
assumption, if you can
answer only one question. And this is not something, that we answer. This is internal to us. And these are market sensitive information, which we would not like to give.
I'll request Shayan Ghosh from Mint to ask his question. Shayan, please.
Governor, I wanted to understand. So in April, RBI had asked banks to submit a board-approved policy on AI-related cyber security resilience to RBI. And within a couple of months, we have seen a large bank facing a cyber incident where a lot of customer data was put on the public domain. Will there be a cost to such incidents in the banking sector when banks fail to adhere to these guidelines, or they are not prepared enough to counter these attacks?
The IT systems of our major banks and big regulated entities are quite strong, robust. They have put in place checks and balances to ensure that they are secure. We have not only guidelines and regulations, we also have a supervision which is done very regularly. Any shortfalls or vulnerabilities are pointed out, measures to be taken to further strengthen the systems are suggested. They are followed up they are monitored, they are followed up to ensure that the systems continuously, while new threats and vulnerabilities keep coming up with new developments in the IT sector, at the same time, our banks and regulated entities also keep preparing and making themselves more secure and more resilient.
All right, that is the top brass at the Reserve Bank of India addressing the media after announcing that policy. For our viewers just tuning in, the Reserve Bank of India has decided to leave the repo rate unchanged at 5.25%, continuing with the neutral stance. They've raised the growth forecast by 10 basis points to 6.7% and lowered the inflation forecast by another 10 basis points to 5%. The commentary was neutral to dovish, but then in the governor's own words, he says we are neither hawkish nor dovish. The policy rate we currently have is ideal given the current growth inflation dynamics. From the press conference itself, you have the governor's commentary coming in on the exchange rate, which they think, given the underlying fundamentals of the economy, some could argue that the rupee is undervalued, and it is quite possible that the rupee strengthens further as the West Asia conflict de-escalates. On FCNR flows, the governor said they expect the flows to continue to be strong. There is no proposal under consideration, to prematurely end the FCNR scheme. Not much clarity coming in on those draft guidelines that the governor spoke about earlier. As far as the interest rate on advances across regulated entities is concerned, what happens to NBFCs, all of those details are still awaited. Apart from that, not much commentary coming in on MDR as well for UPI, where the governor said it is still premature. The government is still bringing in the amendments, but at the end of the day, somebody or the other has to bear the cost, and in some way or another, the consumer is already paying for it. So that is the summary of the comments coming in from the RBI governor in the press conference. Let's invite our guests for more on this. We have with us Jairam Sridharan, the MD of Piramal Finance, joining in to decode the policy, and we'll also be joined by Soumya Kanti Ghosh of State Bank of India, to further analyze the comments. Jairam, just quickly coming to you first. I mean, what is your deduction when, the governor says they will rationalize, they will harmonize the guidelines as far as interest rate on advances is concerned? What could be in the offing for NBFCs like you?
Good morning, Ritu. Thanks for having me. I don't think there is anything substantive. I think this is going to be likely on two fronts. One is on disclosure, where the disclosure norms, key facts that are disclosed to customers, etc., the KFS statement, all these might be rationalized. How APRs are actually calculated, I would expect maybe some sort of an annexure to come saying exactly how APRs are to be calculated and whether if it's an EMI structure, how to take care between 30-day months and 31-day months, and some technicalities like that. I might expect that to happen. And the governor used the word intent, or I think a DG used the word intent and conduct of lenders. So I would expect something on the some guidelines on the conduct front, kind of best practices and kind of how to talk about interest rates. I'm not expecting anything substantive to change.
By substantive, Jairam, do you mean the external benchmark linked, rates? Because that is the big differentiator between banks and NBFCs. Has there been any discussion at all with RBI since this has come up before? Could the rates be linked to EBLR? And if that does happen, won't it be negative for NBFCs like you?
I don't expect it to happen. There has been very little conversation on it. There were no indications in the presser either that they were headed in that direction. I don't think that's what they're talking about.
Okay, you're expecting only minor changes as far as conduct, etc. is concerned. Those are the softer aspects of rate setting. Nothing major to change the structure of how NBFCs set interest rates. No linked to an external benchmark. That is the summary of your expectations, Jairam?
I think so. Expect little. This was an Amol Palekar movie. Don't expect it to be an action film.
Okay, this is an Amol Palekar movie, not an action film. Soumya Kanti Ghosh, what is the action that you saw in the short and sweet, monetary policy, widely along expected lines? We expected to go in with a hawkish commentary. The governors completely flipped that around, and any expectations of a rate hike coming in October, I suppose, would have been laid to rest. Soumya Kanti Ghosh.
Yeah, thank you, Ritu. I think we are never in the camp of an hawkish policy. So we are in camp of a pragmatic policy. So, and actually after the policy was out, we did a very quick NLP on the policy statements and compared with the earlier policies. We actually divided the policy into three statements. One is the dovish part, hawkish part, and the uncertain part. You will be surprised to know that the dovish part, which was 41% last time, has moved to 51% this time. And the uncertainty part, which was 34% last time, has moved to 25%. And the hawkishness has almost remained at the same level. It has declined a little bit. So I think the policy is more of dovishness, less of uncertainty, and more of actually steering the market in terms of the data. So I think it's a good policy. And also the market and also the policy has talked about, as you were just discussing, in terms of more transparency in the rate disclosure across the entire set of financial entities.
But Dr. Soumya Kanti Ghosh, just very simply, by the third quarter when inflation is expected to peak at 5.9%, at 5.25% policy rate, we'll be in negative real interest rate territory. Is it fair to assume that by the third quarter, then we may see some action on rates?
Yeah, I think, Ritu, these questions have been repeatedly asked in terms of a real interest rate. But let me tell you very bluntly over here, in India, there is absolutely no empirical evidence of a real interest rates and deposit growth rate or other that. In fact, deposit growth rates are more sensitive to the tax structure, the prevailing tax structure, than the interest rates. And in any way, I think there has been a significant shift from the deposits to the overall other saving options as the households have them. Having said that, I think, and also the fact is that this real interest is actually it moves across cycles. So it's very difficult to say, and there are in fact no empirical evidence suggesting that the real interest rate has a significant impact on the financial savings. In fact, studies as old as 30 years have showed that the changes in real interest rate has to be significantly higher to make any changes in the deposit structure. And that's why we always talk about, if the camp which is talking about on rate hikes are talking about rate hikes in the excess of 50 to 75 basis points, so as to make the real depositors attractive. Yeah. So having said that, and if I look into the policy very closely, my sense is that the policy will be data dependent. Yes, there will be an inflation which will be over the 5%, maybe between 5.5 to 6% by the third quarter. But I think these inflation numbers, we have to look through the cycle, because ultimately it is the inflation targeting, flexible inflation targeting. And any number which is higher than the 5% should be looked into totality than in any isolation.
Interesting comments there. Pranjal Bhandari, Chief India Economist at HSBC, also with us now. Pranjal, good afternoon. What were the key takeaways for you from this policy, from the press conference as well? I mean, a very neutral tone from the governor, not hawkish, not dovish, not giving any kind of indication on the future path whatsoever.
Well, look, I must say that I didn't find too many hawks out there at the RBI today. I must say it felt quite dovish to me. I think some of this dovishness is justified because their first quarter inflation number, the actual turned out to be 30 basis points lower than what they had earlier forecasted. So that is justified. But still, I must say I found there was some difference between the inflation forecasts and the commentary. The forecasts on their own show slightly elevated inflation, more than 5% for 3 quarters in a row. But if you look at the accompanying commentary, that feels quite dovish, with the governor actually saying in the statement that a lot of it will be on the back of food and fuel, which can be looked through. And I was really intrigued by this look through concept because in the past we have focused on it more in terms of vegetable and fruit prices, where you get a crop every 2 months. So for 2 to 3 months, you can look through. But what happens when inflation is above 5% for 9 months? When can you look through? And on this question, I think Lata asked a question to the governor in the press conference, and he did say that they're holding on to their inflation targeting very specifically, and they would like to align inflation to 4% over the medium term. And he kept saying medium term a couple of times, which makes me wonder if he has a little more appetite, to for inflation to be higher than 4%, because at the end of the day, they are themselves forecasting 9 months of inflation more than 5%. So I think these are some of the new flavors, that I got. And I must juxtapose this with growth, because today, if growth was weak, then you can use monetary policy to help growth. But honestly, growth is very strong. And in the same press conference, the governor actually said that, growth could actually be even more, like close to 7% compared to their new forecast of about 6.7%. So that sort of difference between the numbers and the commentary is something that struck me. On the whole, I would say it was no surprise that it was a dovish policy meeting.
Yes, absolutely. I mean, it looks like from here on, the governor does see a potential for even higher growth than projected. So perhaps, that action may come sooner. But Jairam, quickly coming back to you, one of the big positives for NBFCs was this expectation of a rate hike coming perhaps in October later. Your sense, I mean, that getting pushed out now, you'll have to contend with perhaps similar margins, not much of a, not much of an impact right away, at least?
The other way, Ritu,
I mean, your cost doesn't go up. Your cost doesn't go up immediately. You have a longer window.
So positive for NBFCs, I would say neutral to slightly negative for banks, and which you see in the markets as well. Right after the results, you can see how the markets have reacted. Banks are down, NBFCs are up. It's because the markets expect that cost of borrowing for NBFCs can remain at these more moderate and modest levels for all the way till maybe Q4, right? So it seems pretty clear that till about the February policy, it's unlikely, given all the commentary that was shared, it's unlikely that there is going to be a rate hike. The governor made 2 points, I thought, pretty pointedly and repeatedly. One is that inflation is supply side driven, which essentially means don't look at monetary policy to solve for it. And he kept, Pranjal makes an important point about headline inflation being above 5%. But the governor went to some lengths to actually define this metric around core inflation X of precious metals, and said how that number is less than 3%, right? And used that as his argument for why he believes he feels good about where inflation is at. So effectively, this idea of core inflation X precious metals seems to suggest that yes, inflation headline number might be above 5, but all of inflation is coming from gold and oil. And if you remove those two things, inflation is below 3%. So don't worry about it, is what he seems to be saying, which is great news in terms of not having potentially a rate hike in the next meeting either, and probably looking more like a Q4 event.
Right. So, Jairam, let me get some numbers from you. Given that your cost will not go up immediately, at least not until October, given that there is no hike on the table, it seems to be. How do you expect this cost of funds to evolve for you and this benefit that you're getting of lower rates for longer? Will some of that get passed on to consumers, you think?
See, lower rates for longer in this case essentially just means you stay at where you are. It's not that it's going to get any lower. It cannot get any lower. Nobody's cutting rates, right? So it'll basically stay where it is right now for a more extended period of time. So it's the lack of increase rather than a decrease that you should expect. So you should sectorally expect cost of funds or cost of borrowing to remain relatively flat. For some companies that are going through some idiosyncratic situations, there might be some improvement. Like in our case, we recently got a credit rating increase or improvement. So you might see some improvement in our cost of borrowing in the coming months. But that's idiosyncratic to a company. Sectorally, I would expect pretty flat cost of borrowing from here on through the rest of the calendar year.
Yeah, with no action on rates, of course, that would be flat. But my question rather was versus what you had baked in, because earlier the expectation was of a hike. Now that that's not coming, is there some benefit you see accruing in terms of numbers, if you could give us?
Absolutely. So we had baked in, as the year started, we had baked in 25 basis points in this calendar year and 25 basis points in the early part of the next calendar year. That was our core plans. That first 25 basis points now pretty much goes away. So that is an improvement to our outlook.
Got that. Mr. Soumyakanti Ghosh, very quickly on the growth numbers. 6.7%, I mean, previous policy, there was a revision this time again, 6.7%. How does that anchor with your own expectations on what you're seeing in terms of high frequency indicators, even for the first quarter next year? It's pretty strong, 7.3%.
Yes. No, I think, Ritu, is very interesting. I have never seen central bank, the RBI, basically changing the growth forecast in 3 successive policies. So first it was 6.9, it was reduced to 6.6, 6.9, then to 6.6, now again increased to 6.7, and that too in all consecutive policies. So I think that's the most surprising front in terms of how possibly all of us are missing the buoyancy in growth estimates. And in fact, if you look into the RBI policy more minutely in the footnotes, there are numbers which shows that all the leading indicators are growing at significantly higher rates, including tractor sales, which is also growing at actually close to 15%, UAVs, tractor sales, passenger vehicle sales, EV sales, electricity consumption. So I think the first quarter growth rate has been hiked from 6.6 to 7%, but my sense is that it will be possibly be quite higher than 7%. If the leading indicators are any indication. And I think this 6.7% forecast coming so quickly from the Reserve Bank indicates that there could be more upgrades in the second half of the year if growth numbers go as per expectations. So I'm not ruling out a 7% plus growth rates for the full fiscal year as of now.
Okay, Pranjal, are you also expecting a further revision? 3 revisions have already happened. One more to raise this further through the year?
Look, oh, sorry. Yeah.
Our sense is also that for the calendar year 2026, growth is in the 7% ballpark. So I'm in agreement with the governor, what he said in the press conference. But, for the fiscal year, it gets a little tricky because it brings in Jan to March 2027. And that, I think, is when we'll get to know the El Nino impact. Now, according to all the weather experts, El Nino is expected to become very strong in the last quarter of 2026, October to December. And if that happens, the impact of that can be felt very quickly in the next quarter. So it's possible that suddenly in early 2027, we'll see growth fall if a big, strong El Nino takes force. But barring that, I think a 7% growth handle is probably the right number. And, our numbers are there. Where growth has surprised all of us, I think, is the resilience of manufacturing. Through the energy crisis, when one would have thought production will be impeded, actually producers started producing even more. There was a lot of front loading of production. And also remember, exporters were exporting to the US in great speed because after a long time, the tariff rates were reduced from 50% to 10%. So all of that, I think, really helped. Also, the GST cut last year, the tailwinds of that was also very supportive. So generally, growth has held on pretty well.
It has indeed held on pretty well. Dr. Ghosh, just a quick comment on the currency as well. We opened the rupee pretty strong today. It was in the 94 territory, now at about 95.18. It's still appreciated a bit today, but the governor, with the commentary that he's come out in the press, of course, saying that they don't have a target band, but they will curb volatility, they'll check speculative behavior, they'll prevent disorderly movements. All of that not really moving the markets much. What more would you have wanted to hear from the governor in the presser?
No, I think the governor made the correct observation in the policy also. And if you find out, there is a self-fulfilling word in the statement.
Yes, yeah.
So I think that self-fulfilling word is actually appearing, if I am correct, is appearing for the first time because the RBI has clearly emphasized that it will not allow any disorderly movement and allow the self-fulfilling prophecy to take over. So I think that is an important observation, but I agree with you that given the avalanche of capital inflows, around 41 billion has come in so far. And the other important thing is that if you look to the foreign exchange reserves note today, I think the numbers have been given for 31st July 2026. The number is actually at 693 billion. So there is a 10 billion increase in foreign exchange reserves from the 24th July. So overall foreign exchange reserves is now quite significant since the FCNRB schemes were ruled out. So I think if I have the numbers in front of me, the total FCNRB inflows has been 36.7 billion and the total increase in foreign currency reserves has been around 20 billion. And if I look into the net forward sales in the short-term window of less than 1 month, that is around 13 billion. So that pretty well explains the maths of a 36.7 billion change in the foreign currency reserves. So I think that the rupee should have appreciated more. Maybe still a sentiment driven in terms of the exporters and importers expecting that the rupee could actually move to the benefit of their direction. But my sense is that in the coming days, we can see that the rupee appreciating from the current levels if the foreign exchange flows continue to look healthy at this rate.
All right. Jairam, any quick closing comments, especially on growth, with the governor saying 7% is not impossible? Credit growth even stronger from here?
Yeah, going back to my kind of Bollywood metaphors for a moment, we entered Q1 expecting lots of action and violence. It ended up being a quarter of romance. And now if you look at where we are now compared to where we were 3 or 4 months ago, inflation is better, oil prices are better, USD INR is better, monsoon has been better. So everything has moved more positive than where we were 3 months ago. And you already saw what we got in the first quarter in terms of growth momentum with an even better starting point now. It feels like that good narrative is just going to continue into Q2.
All right. Thanks very much, Jairam, for adding some romance element to this monetary policy discussion. But unfortunately, out of time. Such a pleasure having you all. Pranjal, Dr. Soumyakanti Ghosh, Jairam Sridharan. Thanks very much for your time here and helping us parse through this Reserve Bank of India monetary policy. Time for a short break. We will be back with more on the markets and buzzing stocks when we return. So stay tuned. Welcome back. You're tuned into Halftime Report here on CNBC TV 18. Let's focus on some of the earnings that have come in. PNB Housing Finance, now that zoomed up in trade after there was positive management commentary. Ananya joins in now with more details on this one. Ananya.
Well, yes, the stock is rallying on the back of positive management commentary, like Ritu mentioned. But operationally, it was in line quarter. The loan growth was healthy, around 15% year on year. AUM grew 13% year on year. NII grew 6%. PPOP around 9%. While PAT only grew 4% year on year, but declined 15% sequentially because the key, laggard was the NIMs. Which weighed on the profitability. The NIM compressed 19 basis point sequentially, while 24 basis point on year basis. But the management mentioned in the commentary that it will start to improve from Q2 onwards. So we'll watch out for that. And also ROA and ROE have also moderated this quarter. But asset quality here remains strong with GNPA at 0.95% and NPA at 0.58%, both better year on year. If you see, credit cost was a major positive. It continued to stay negative, supported by recoveries with 67 crore recovered from the written-off pool. Management also mentioned 18 to 20% loan growth guidance with affordable emerging segments expected to remain the key growth drivers. And also credit costs will remain negative going forward also. So we'll watch out for that. So all in all, a good quarter for them, and the stock is rallying in trade today.
Well, yes, a good quarter for PNB Housing and generally doing well for NBFCs today with that rate hike at least ruled out for the near term. But let's move on. Manipal Health, that operates Manipal hospitals across India, has made a steady debut on Dalal Street. It listed with gains of about 10%. Let's bring in Ekta now for more on this one and what's going on there. Ekta.
Well, definitely a good listing coming in for Manipal. Remember that they raised around 9,275 crores via IPO. 8,000 crores of that was a fresh issue. It is one of the largest IPOs in the healthcare space in the recent times. Subscription, however, was a bit subdued. Total was around close to 5 times. We had QIB at around 8.25 times, but they raised a hefty amount from anchor investors, which was around 4,167 odd crores, which was at the higher end of the price band. Now, overall, they operate Manipal Hospitals, Pan-India multi-speciality hospital network, 49 hospitals, 13,000 beds, and India's largest private hospital network by licensed bed capacity and second largest in terms of revenue. Now, in terms of the proceeds, majority is going to go into debt reduction. So 47% of their debt is going to be reduced post the IPO. And in terms of revenue, they did around 10,300 odd crores in terms of revenue. Margins were on an adjusted basis or pre-adjusted basis at around 27.05%. Now, the company, in terms of key points, net debt zero post the IPO infusion. They are looking at M&A opportunities when it comes to Delhi North, which is a focus. They are looking to launch a hospital in the next 18 months in Juhu in the city of Mumbai. Sayadri, they're looking to improve the margins for this particular acquisition from 18% to 23%. Price regulation continues to remain a risk. And in terms of Temasek and their plans for Manipal, they don't have any plans to exit as of now. So they are committed in terms of their investment in Manipal. Guidance in terms of occupancy, 65%. Aspiration is 75 to 80%. Blended RPOP, 72,000 rupees per day. And the growth is estimated to be around 9 to 10 odd %. In terms of valuations on the expensive side as compared to the other hospitals, very close to max and over 75 times in terms of a PE if you compare it on an FY26 trailing basis.
All right, Ekta, thanks very much for that one. We did in fact speak to Temasek earlier that did indicate it will remain invested as far as Manipal is concerned. Let's move on to some more earnings then. Metro Brands, now that interestingly tanked in trade despite reporting a resilient show in what was a seasonally weak quarter. Let's bring in Manglam Malu for more on this one. Manglam.
Well, Metro Brands is lower in trade today. It's a seasonally tough quarter, the first one. And in that as well, demand was relatively muted during both April and May due to external factors. Add to that, the consumer sentiment, the company says, improved from mid-June. And that's why we've seen a revenue growth of just around 15% as against the company's historical averages, which are a lot higher. The EBITDA, however, grew at 10%, which implies there was margin compression. And the net profit on a reported basis has declined. But remember, a large part of that is on account of a non-cash expense increase, which is that on depreciation. They've added 9 new stores during the quarter, total over 1,041. And e-commerce sales grew by about 9%, contributing to about 13.1% of the revenue. For Metro Brands, the important part will be how sales picks up as wedding dates pick up. And at the same time, do we see some sort of improvement towards the second half of this year with the kind of diversification that they've had with newer formats and newer categories like caps, etc. as well. So to that extent, Metro Brands, more of a second half story as against the first half, which is why the stock is lower. And, seasonally weak quarter, consumer sentiment muted. Despite the recovery in the last month of the quarter, we've seen the stock lower today.
Stock lower today on the back of that. Manglam, thanks very much for bringing us that update. Let's move on to another one that's in focus, and that is Cummins. Now, they're set to report their first quarter numbers, later in the day today. Let's bring in Vinny Motiwala to get us up to speed with what to expect from that report card. Vinny.
Hi, afternoon. Thanks so much for that. For Cummins, obviously what we're expecting this time, a 13% growth in terms of revenue. 3,286 crore is where we're expecting the revenue to come in at. EBITDA is expected to see a growth as well, 10% EBITDA. So overall margins are largely flat, a slight bit of a contraction, 21% versus 21.5%. But profits of the company are expected to do better. Why? Because do not forget, last time there was an exceptional gain in Q1 FY26. So that is also something that one should factor in. 652 crores is what we're expecting the profits of the company at. Now, revenue growth will be supported by the main divisions, that's going to be power generation as well as distribution segment, which will be leading the growth for the company. Exports, that is expected to be muted. West Asia impact, that's something that is coming in. So maybe, we could see a muted growth or even a decline is a possibility that could come in on the exports front. So that will be key to watch out for. And obviously margins, commodity prices rising is a factor that is keeping that 50 basis point contraction that we're expecting in terms of margins. Other than that, let's watch out for demand stability. Any commentary on that front? Export outlook, is that something that is improving now? Ramp up in orders, order inflow, and data center point of view, the order inflows, how is that shaping up, will be key to watch out for from the company.
All right, Winnie, we'll keep an eye out on that one. Thanks very much for joining in with that. Well, quickly take a look at the markets. 24,521. It's in the red, down about 0.4% as we speak. And that's primarily on the back of what you're seeing in the banking pack. They're sulking. Rate hikes generally good for banks, but that's not to be. In fact, the expectations have been pushed further. The Bank Nifty now down about 350 points as we speak. 57,550 on the Bank Nifty. What is doing better? The IT pack, of course, also reeling under pressure. Some of these rate sensitives reacting to what has been announced. But the market breadth tells you, though, still, there are more stocks that are in the green than in the red. There you have on your screen, pretty much red across the board. The broader markets, though, still holding up. The mid-cap index is, flattish, but seeing still in the green. And the small-cap index also seeing gains of almost 0.6%. The advanced decline ratio there, the lines seem to be converging, but still more stocks in the green than in the red. Apart from that, sectorally, what you have today is realty, auto, PSU bank, metals, all of that in the green. But pretty much everything else looking in the red. For now, we'll take your leave on this edition of Halftime Report. But stay with us. Business Lunch is going to take all of the action forward.
Market slips to the day's low, led by a sharp fall in private banks and IT stocks. A dovish RBI aids sentiment for interest-sensitive sectors. Realty, auto and cement gain.
A stronger than expected economy in the first quarter amidst easing supply prompts the Reserve Bank of India to put a pause on interest rates. And while the El Nino risk remains, the central bank has cut its inflation outlook and upped its growth expectations, dimming prospects of a rate hike.
Stocks of general insurers perk up after the Supreme Court says the term for third-party insurance for cars must be increased to 4 years from 3 years and for two-wheelers to 6 years from the current 5.
Manipal Health Enterprises makes a strong debut on the bourses with over a 10% gain to its offer price of 590. The healthcare major's 9,275 crore IPO was subscribed almost 5 times.
RBI Governor says the cost of UPI needs to be paid by someone as it is important to continue to invest in the payment system. He adds that a way needs to be found whether via MDR or other means. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan and with me as always is Harmaz Patakia. Harmaz, good afternoon. You know, the market's now in the red. We saw a little bit of a recovery post the RBI policy announcement, right? But that's been sold into now.
Indeed. Good afternoon to you as well, Arundhati. You know, it's that kind of a market where you can't put an adjective to. It's the kind of moves that you have seen, particularly over the last 20 minutes of the trading session, both on Monday and Tuesday. It becomes very difficult to give a directional view right now. But of course, at 24,500 is where the Nifty currently is. You pull up the futures and the spot prices side by side. You tell you the divergence that we have been seeing over the last couple of days in terms of the price differential between the two. The Nifty futures yesterday, the price differential was around about 70 odd points and in comparison to Monday where it was 120. So it remains to be seen whether there you can see the spot price is currently at 517. The futures are at 585. So still a 70 point differential is what you can see. The Nifty Bank too, that has been the one that has been struggling all through last week, and barring Monday's close, that one pop which took it past 58,000 back at 57,500, and here too the futures are showing a divergence of well over 200 points right now. So that's the kind of move that we are factoring in for the benchmark indices, but stock specific action is the one. In terms of earnings, it's a relatively quiet day. There's still plenty of results that you need to watch out for, but in terms of names, it's a quiet day, but there are result reactions that are dominating proceedings right now.
Absolutely. And if you take a look at the sectors, we've got that realty pack. That's the top gainer, right? Godrej up 4%, DLF and Lodha, both of them up 1.5%. As you can see on your screens, DLF now over 2% higher. Auto stocks also in the fast lane. We've got TVS Motor, Hero Motor Corp, and we've got Ashok Leyland, all of them up over 2%. TVS Motor there nearly 2% in the green. But on the flip side, we're seeing pressure from those private banks. We've got HDFC Bank, ICICI Bank and Axis Bank down nearly 1% in trade as we speak. So pressure there for the private banks. But you know, the top focus today is the RBI policy, and that's the story of the day. Ritu Singh is here to get us all of those key highlights. Ritu?
Well, thanks very much for that. You were just talking about banks and they're sulking in trade because, you know, you're pretty much ruling out a rate hike, at least in the near term, until October. And that's thanks to the fact that the commentary coming from the Reserve Bank of India governor, it was expected to be hawkish, but it turned out to be more dovish, surprising the street. So therefore, any rate hike is ruled out. But, you know, quickly coming to the policy, no action on rates, and that was widely expected by the street. 5.25% repo rate, no change there. No change in stance. That is still at neutral. Good news on the macro front. On the growth forecast, it has been upped by 10 basis points from 6.6% to 6.7% for the year, and the inflation forecast has been revised downwards from 5.1% to about 5%. Keep in mind, the first quarter inflation reading, the actual numbers are actually lower than what the RBI had estimated, and therefore that minute revision in the inflation numbers. Now, going ahead is a big question. When do we see any rate hike at all? And, you know, at least until October, according to some, even until December. That could be ruled out. Apart from this, you know, one of the key highlights coming in from the RBI governor was on the fact that, in the press conference, he commented on what could come on the NBFC policies, the interest rates on advances. There was talks about rationalizing it across all regulated entities, and there was speculation whether EBLR would be, that is external benchmark linked rates, would be brought in for NBFCs as well. Of course, the governor later clarifying that was not to be. These are minute changes. And we had the Pirimal Finance MD also saying, don't expect an action film. This is just an Amol Palekar move. So, not much expected there. Quickly on MDR as well. The governor did not address it directly, whether an MDR would or would not be brought in, but he said ultimately someone has to pay the price, and currently the consumer in one way or another is already paying for it. In fact, take a look at some of the interesting comments coming in from the RBI Governor Sanjay Malhotra on today's monetary policy.
After a detailed assessment of the evolving macroeconomic and financial developments, as well as the outlook, the MPC decided unanimously to keep the policy repo rate unchanged at 5.25%. Consequently, the SDF rate shall remain unchanged at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. The MPC noted that headline inflation has edged up above target as expected. The realized inflation for Q1, however, remained marginally lower than projections, reflecting limited pass-through of cost pressures. The higher inflation is mostly on account of fuel and food, with little signs of generalization of price pressures so far. Core inflation, excluding precious metals, continues to be benign. As projected earlier, headline inflation is expected to rise further in the near term. It is expected to peak in Q3 of this year, primarily again due to food and fuel, and thereafter moderate. Renewed tensions in West Asia, which are disruptive of global supply chains, volatility in international financial markets, and weather-related shocks, however, pose downside risks to growth. Taking all these factors into consideration, real GDP growth for this year is now projected at 6.7%.
The RBI policy, the big event of the morning. Just pull up HT Media. Numbers came in a couple of minutes ago. They're flashing at the bottom of your screens. Very strong performance on the top line and the bottom line front. 12% higher now is where the stock is. A sharp spike is where that is what you have seen. The advertising revenues have grown 15% this quarter. Operating revenues have also grown 16% as well. Operating EBITDA has more than tripled from last year. So a strong performance from HT Media. 12% higher on the stock. And not just HT Media. There are a whole host of other stocks that are also buzzing on the back of results. Ria is joining in with a complete update of that. Ria.
Well, a lot of stocks are buzzing today on the back of their respective quarter one results. Let's start off with Marico first. We've seen revenue growth of nearly 23% in this quarter, and the domestic volume growth has come in at 11%, below the pole of 13 to 15% that the street was factoring in. For BSE, it has been a steady quarter, although the stock is still down 3% today after seeing a run-up in the recent few trading sessions. For quarter one, the trading momentum has continued through the quarter, with the revenue and EBITDA being largely flat and trading activity remaining elevated in this quarter. Revenue has come in at nearly 1,566 crores, EBITDA over 1,072 crores, with margins being stable at 68% in this quarter. For MCX, it has been a weak quarter this time around on a sequential basis, although it has been in line with what the street was estimating. Revenue has gone down by nearly 21% on a quarter-on-quarter basis, with margins also taking a hit of nearly 460 basis points at nearly 73% in this quarter. For Kalyan Jewellers, the revenue has gone up by nearly 46% compared to the previous year, although the margins have tanked by nearly 100 points to 6% this time around, with the net profit increasing by 32% to 349 crores. And lastly, Nykaa has also been in focus today, with the revenue going up by 27%, EBITDA margin coming in at 8.5% versus 6.5% that we saw on Q1 of last year, and the net profit going up substantially by over 226% to 80 crores in this quarter.
Yeah, thank you for that update. There are plenty of earnings movers in today's session. Now, the Supreme Court has extended the mandatory third-party motor insurance coverage of new vehicles. Yash is now joining in with more details on that and how it benefits companies like GoDigit and ICICI Lombard. Yash.
Well, general insurance companies for the last few years have been seeking an upward revision in the motor third-party premium rates. Nobody knew that the blessing from them would come from an unexpected corner. In this particular case, the Supreme Court. What the Supreme Court in its order has said is that, motor third-party premium, which is mandatory, the duration of that coverage, the mandatory coverage has been increased to about 6 years from 5 years for two-wheelers and 4 years to 3 years for four-wheelers. What that does is essentially it gives 1 more year of mandatory coverage of motor third party to all the new vehicles, be it a two-wheeler or four-wheeler, which have been bought. When a new vehicle is bought, a motor insurance policy is bought, so far the premium, the motor third party premium and the entire motor premium had to be paid upfront for that entire period, which was so far 5 years for two-wheelers and 3 years for four-wheelers. Now, with that addition of 1 year, what will have to be done is that the vehicle owners, the people who are buying a new bike or a car will have to pay the motor third-party premium for an additional year to the insurance companies, which means these general insurance companies will get to book an additional year of motor third-party premium when any new vehicle is bought. This essentially increases the cost of insurance behind every motor vehicle by about 20 to 30%, depending on the class of the vehicle. ICICI Lombard has about 20% share of the total GDPI, which comes from motor third-party. GoDigit has 42.5% share. New India has 14% share. The biggest beneficiary is GoDigit because of the sheer higher share of motor TP in its entire book. And as far as general insurance companies are concerned, it is certainly a big positive for them because an additional year of motor TP collection, but slight negative for auto companies because this will increase the cost of the vehicle by a percentage or a couple of percentage points when it comes to this additional cost of insurance getting added to it.
Right, Yash, absolutely. And stay on. Sources are telling CNBC TV18 that SEBI is closely watching close-in auction session rollout. Yash, tell us what are the key updates on that front?
Well, that has been a point of discussion in the markets for the last 2 days. Today is the third day of the implementation of CAS framework. Of course, brokers, market participants have had their concerns because of the uncertainty in terms of the closing price once the spot market closes and the future markets start trading. It is because of that the volume or the participation has been on the lower end. What we've been given to understand is that several market participants, including brokers, met market regulator SEBI chairman yesterday, where their concerns were put forth before the SEBI chairman. We've been able to pick up what SEBI chairman's or SEBI's view was on those concerns. Essentially, there is no plan from SEBI's end to change or stop or alter the CAS framework in any manner. SEBI believes that there is no issue whatsoever with the framework, with the technicalities and the implementation of the CAS framework in the way that it is being done right now. The problem, according to SEBI, is that retail participation is not coming through, and because of that low volume, there have been wild swings in terms of the closing price after CAS, and exactly why market regulator SEBI has urged brokers and market participants to enhance retail participation in that CAS window or under the CAS framework. This meeting happened yesterday. According to our sources, there's a meeting which is expected to happen today as well. But SEBI's line of communication is expected to remain the same, which is no change, no alteration, or any kind of changes to the current CAS framework. What needs to be focused on is to increase retail participation to avoid that volatility.
Yes, thank you for that update there. All eyes again on at 3:15 p.m. this afternoon. Take a short break. Back with more on the other side. Welcome back. On to the latest updates from West Asia. Then, US President Donald Trump said that his administration had, quote-unquote, very good discussions with Iran, fueling expectations of an imminent end to the conflict that has now entered its sixth month. CNBC's Ritika Gupta filed this report.
Oil prices continue to slide this morning. This following Tuesday's steep fall on the back of US Treasury Secretary Scott Bessent's comments to Squawk Box that a deal between the US and Iran on the Strait of Hormuz is imminent. Meanwhile, Qatar says mediators are also progressing on a deal to reopen the waterway and that a proposal has been drafted. The country's emir held talks with President Donald Trump late Tuesday in a further bid to de-escalate the conflict. Bessent told CNBC he sees energy prices easing further on a prospective deal.
There is a chance we may have a deal today or tomorrow to open the strait and move towards a more normalized position in this conflict. I think it would be freedom of movement, and even though things are still a little dicey there over the past few days, we've saw quite a few ships coming out even now. So, I'd expect the energy prices to settle back down, which, as I said, will be good for the entire world.
And Iran could reportedly grant European nations permission to demine the Strait of Hormuz as part of a potential deal. That's according to Bloomberg. The move would represent a significant climb down from Tehran, which has previously insisted it would not allow other nations to oversee the safety of the passage. It would also offer welcome assurance to shipping firms and insurance companies around the security in the region.
So, Ritika, there with the latest from West Asia. Meanwhile, US President Donald Trump also said that the negotiations with Iran are moving along very nicely and will know the outcome in 48 hours. Take a look.
Moving along very nicely. We'll find out. We'll know in 48 hours. Though. They had a very good day. The negotiations were good. The stock market was up tremendously over the last 3-4 days. We set new records today in the stock market. Yesterday, today. I think it's like 78 times now during a very short period of time. So a lot of good things are happening.
Now, even as optimism grows over a possible deal to reopen the Strait of Hormuz, attacks on civilian shipping continues in West Asia. An Indian-flagged commercial vessel came under attack in the Red Sea yesterday, and it was hit by an unknown projectile near the coast of Yemen, causing it to capsize and sink. All 14 crew members on board were subsequently rescued by Yemen's Coast Guard. Now, India's foreign ministry has condemned the attack and has called for an end to the targeting of commercial shipping.
On that note, it is time for us to head into another short break. More news and updates coming up on the other side. Stay tuned. Welcome back. Yes, you're still with us on Business Lunch. The PM Surya Ghar Muft Bijli Yojana has crossed a major milestone, with more than 50 lakh households across India now equipped with rooftop solar installations. CNBC TV 18's Abhimanyu Sharma spoke to MNRE Secretary and Joint Secretary, and they hailed the pace of installations with the program adding around 1 lakh households every 6 days. Take a look.
In its ambition to cover 1 crore household, is the biggest ever DRE scheme, rooftop DRE scheme in the world. And achieving 50 lakhs is a big milestone, and we are making our best endeavor to achieve 1 crore households by 31st March of 2027. Well, as you rightly pointed out, states like Maharashtra, Gujarat, Kerala, Uttar Pradesh have been doing extremely well in the PM Surya Ghar scheme until now. In the recent past, we have seen states like Andhra Pradesh, Odisha, Madhya Pradesh having picked up the pace of installation in their respective states. Going forward, we expect states like West Bengal, Tamil Nadu, Karnataka, Chhattisgarh also to ramp up installation and try and avail maximum facilities under the scheme.
Now, the MNRE Secretary also spoke about the 20% renewable energy loss due to a lack of an uptake. Listen in.
Pointed out that transmission remains one of the critical factors for better integration of renewables. There are two forms of transmission lines on which we focus on. One is interstate transmission system and the other one is intrastate transmission system. As far as the interstate transmission system is concerned, the CEA, the Central Electricity Authority, and CTUIL do the planning and bidding process for this. Currently, to achieve the 500 gigawatt target by 2030, whatever ISTS lines are required are either been completed or are under construction, and we have been assured that all these lines will be up and ready by the end of 2027. We should be able to evacuate a lot of RE from the RE states of Rajasthan, Gujarat, Karnataka to other portions.
Bangladesh's ousted former Prime Minister Sheikh Hasina is set to make her first virtual public address today, exactly 2 years after being forced out of power. The 78-year-old leader, who has been living in India since fleeing Bangladesh in August 2024, will address an event hosted by the Foreign Correspondents Club of South Asia in New Delhi this evening. Her son Sajib Wazid Joy and former Bangladesh Education Minister Moibul Hassan Chaudhry Nofil are also expected to join the event and address the gathering. Meanwhile, the Indian government has clarified that it has no involvement in the privately organized event and does not endorse any views that may be expressed during the forum.
With that, we take a leave on this edition of Business Lunch. The markets continue to remain as choppy as they have been. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Putra. With me, as always, Vivek Iyer. A very volatile market. That's how the day has been so far. RBI policy in line with what the street was working with, but there is underperformance from Bank Nifty. And as we speak, markets are at the day's low, so they surged as much as 50, 60 points at a point in time, but now low by 85 points.
That's right. As the market crunches the policy, the document, and what exactly has transpired, especially as far as a slightly dovish RBI this time around as far as the policy was concerned. But we have a lot lined up on the show, some important corporate conversations as well. So let's start off with the top headlines. Market slips to the day's low, led by a sharp fall in private banks, FMCG and IT stocks. A dovish RBI aid sentiment for interest-sensitive sectors, realty, auto and cements gain.
Listed exchange stocks BSE and MCX trade lower. BSE falls despite delivering a record quarterly performance, while MCX reports a sequentially weak Q1 with margins contracting by more than 457 basis points.
PNB Housing Finance trades higher after an operationally in-line Q1. Healthy loan growth as well as stable asset quality supported sentiment, while management reiterates the 18 to 20% FY27 loan growth, 50 to 60% affordable housing loan growth, and says it expects to outperform guidance.
Ask Automotive fires up after reporting a strong Q1 with record high revenue, EBITDA and profit. However, higher alloy prices weigh on margins. All right, those are the top headlines that we are tracking, and we do have some corporate conversations lined up. But before that, markets at the day's low, the mid-cap side of things are better than what the benchmarks are doing, but still under a lot of pressure. Every attempt to recovery has been sold into, so that's the flavor of the market for now, and a lot of pressure coming in from the Bank Nifty.
A lot of pressure from the Bank Nifty, but we also have to take into context, the last 15-minute spike that we're seeing, especially as far as CAS is concerned, and that's also something that's gone ahead and impacted prices, especially during the trading session. But this is our special segment, Mid-Cap Movers. Upasana standing by the big wall to take us through all of the mid-caps that are moving around in the session.
Well, first up, let me address the Nifty Mid-Cap Index, which is up just about 0.1% as we speak. Now, let us look at the top gainers in today's trading session. Topping the list is Ola Electric, up nearly about 7%. Engineers India is up nearly about 5%. RR Kabel is trading at an all-time high, nearly up 4%. Cello World is one of the key volume buzzers today. Volume out 20 times the weekly average, up more than 14% as we speak. And New India Assurance is also seeing a good amount of buying, with an uptick of 5%, and the volumes have also continued to remain strong here. Now let us look at the key stocks in focus on the back of the result reactions. ASK Automotives is up nearly about 14%. Deepak Nitrite is up 1.3%. PNB Housing Finance is also seeing a sharp move up more than 5% as the management certainly says that it will outperform its guidance. MCX is seeing a downtick on the back of that weak results. Sequentially, Kalyan Jewellers has also seen a downtick of nearly about 4%. Now on the flip side, let us look at the top losers in today's trading session. Sonata Software taking a cut of 3%. Web of Global down nearly about 8%. Balrampur Chini, which has seen a sharp surge in the last 2-3 days, is correcting now, down about 3%. Delivery and Tatacom seeing a cut of 1 to 2%. So all in all, these are the stocks on our radar.
Okay, all right. Thank you so much for joining us with all those details, Upasana. So those are some mid-cap movers on our radar. But the focus continues to be on earnings. So it's time for an earnings conversation now. It was a solid show in Q1 for Marico. The company reported 23% uptick in revenues, but profit and EBITDA growth stood at a 28-quarter high. My colleague Magna Malu began by asking about what worked in the June quarter and the outlook ahead. To the management of the company, listen into that conversation.
If you ask me, there are 3-4 things that have continued to play. I think we have been delivering high single-digit volume growth even last year. And what's hurting is on a 2-year CAGR basis also, we have delivered a 10% kind of a volume growth. What happened this quarter definitely was that obviously the copra prices have come back from their peak, and therefore we took some price corrections in our loyalty packs of Parachute, which led to the Parachute growth. Our mix driven both, the fact that the premium part of the value-added hair oils is now delivering, mid to high teens volume growth, which is leading to also market share growth. Our focus being on driving behind investment and brand equity as opposed to trade spend growth. Obviously, the other vectors of growth, which is the food and digital, is playing on well. So I think it's a multi-vector kind of a growth that's happening and firing on multiple cylinders. And we have coped with some of the adversity last year we faced, which is a unique adversity where our input cost copra went out by 100%. This year, obviously, we are facing similar headwinds, whether it's in crude-led inflation, some of the logistics-led challenges in some of our international markets. So I think overall, I think it's based on execution and resilience. And one of the other heroes which is there is our entire distribution drive, which is Setu, which has delivered not only good growths in India, but we have actually replicated the Setu model in Vietnam recently.
Right. So that's very interesting. You've, grown via distribution, execution, resilience, despite the sort of uncertainty that we've seen. But, my question is, you've guided for high single-digit volume growth this year as well. First quarter, you've done about 11%. What makes you conservative? Do you believe that going forward, you can consistently do double-digit volume growth in all the other quarters as well?
See, this year is going to be a little uncertain. Although the rainfall deficit is much better than what it was thought in June, I think there could be inflationary uncertainty, although I think India has been fairly insulated from this, but there are other markets which is there. Number two is, I think, what we do is that something which is a base case is a high single-digit volume growth. And I believe that maybe once in a while, we can try and attempt a double-digit growth.
Right. What happens in the edible oils business, right? Because that's been slightly slow. Is that a conscious decision to decommodify your business? Or is there something strategically reshift that you're doing?
Absolutely. I believe that the edible oil business, there are two parts of the business, which is the premiumization agenda, which we are doubling down, especially with cold press oils and Saffola, some of the premium part of Saffola. The entry level part of the business, I believe that volumes or market share gain is not sustainable. It is based on a certain pricing, which is below the threshold level of profitability. In any case, our long-term agenda as far as Saffola is concerned is to convert into a majority food brand, which is going on well. The journey is going on well. And as far as edible oil is concerned, we are okay with a long-term growth of mid-single digits and a premiumization of the portfolio. I believe cold press oil is a very big trend which is here to stay, and we will double down and invest behind that initiative.
So, what is the current contribution coming in from the premium part in edible oils, and how is that part growing versus the overall part, obviously, which you expect to grow in mid-single digits? So if you could give a deeper nuance into that portfolio.
So the premium part of edible oil is growing well. And as I said, we are taking a conscious call of, in certain channels of, not pushing on the entry level Saffola or something which is not making our threshold level of margin.
All right. Just a final question before we let you go. The diversification agenda is fairly well and truly on. By the end of this year, where should we see your digital first and premium personal care portfolio when it comes to margins? And also, if you could give us a sense on the 15,000 crore top line, would you have about 20-21% margins?
I believe the way to look at it is that we should be able to deliver high teens EBITDA growth, and we are aspiring to hit 20%. Now, the margin is optical depending on the pricing and the revenue part, and obviously there will be an improvement in EBITDA margin this year. We are pretty confident about the 15,000 crore journey, the way we are tracking today. And I think it will be one of the fastest, our 10,000 to 15,000 crore journey in 2 years. It will be one of the fastest in recent times in the industry. As far as the digital, the overall diversification part of the portfolio is concerned, it could be anything between 26%, 27%. So it's tracking well to get into 30% plus by 2030.
No, I wanted the margins for this portfolio. If you could tell me the margins for this 25%.
I think the digital brands should exit in somewhere close to double digits. The premium personal care part of it obviously makes very good margins.
Well, that was the management of Marico sounding quite confident, especially as far as the future outlook is concerned in terms of the revenue growth. Well, we'll now slip into a short break. Up next, we will connect with the management of Wonderla Holidays to discuss their Q1 numbers. Stay tuned.
Welcome back. You're still tuned in to Midcap Radar on CNBC TV 18. Markets continue to trend lower and be very volatile as well. For now, the Bank Nifty is at the day's low, leading to that further fall on the Nifty as well, which is now down 110 points. When we started the show, it was down around 85, and Bank Nifty is the one which is leading to the cuts from the highs of the day. But this is our special segment, Midcap Spotlight. Sudarshan is joining us now. He'll focus on Ask Automotive. Sudarshan, how did the numbers look?
It's been a very strong quarter for Ask Automotive. Highest ever revenue, highest ever EBITDA, even highest ever profit company has reported. And if you talk about the revenue growth, its overall revenue growth has come in at 52%. But net revenue growth, including pass-through impact of alloy price, if you look at, still it's at 25%. Profit has seen an up move of 29%. EBITDA has increased by 34%. And margin, despite a sharp increase in the raw material cost that we have been seeing over the last few months, company has reported margin of almost 12%, and that's versus 13.4% in the same quarter last year. Talking about the segments, advanced braking systems, revenue growth of almost 50%, aluminium light weighing precision, revenue growth of more than 70%, safety control cables, revenue growth of 20%, and exports revenue too is in line with the guidance that company has provided for FY27. Guidance is of 18%, and company has given revenue growth in Q1 of 18%. Now, despite the margin coming in below 12% in Q1 FY27, company is confident of maintaining the margin above the band of above 12 to 13% band. Let's see how does it move going forward. But as of now, for today, stock is sharply higher, currently up almost 13 to 14%.
Well, that's right, Sudarshan. Thank you so much for bringing us all of the details as far as the sharp up move we've seen in ASK Automotive, up almost 15% on good volumes today. Well, time now for another earnings conversation. Wonderla Holidays reported a good set of June quarter numbers. Revenue saw 44% uptick while profit rose nearly 40%. Margins also witnessed a marginal expansion. To break down the quarter gone by, we are joined by Arun K. Chittilapalli, Executive Chairman and MD at Wonderla Holidays. Good afternoon, Arun, and thank you so much for joining us. Well, the first question is very strong growth, especially when it comes to volumes as well as revenue realization. FY27, can this momentum continue? What was the contribution you saw from some of the newer assets that is now there in your portfolio? FY27 guidance, can you lay out for us?
Thanks for having me on the show. Always a pleasure chatting. So this year is the first year that we've had our Chennai park operational. So that contributed roughly 45 crores of revenue. Also, the other parks have contributed really well. I think we've seen about a 15% growth in revenue from our established parks as well. Our resort revenues have almost doubled. So I think these are the main factors that led to this performance. So I think overall, it's even the established parks and the new park also has contributed really well for us.
So what are you expecting in terms of growth in FY27, Arun? What is the expectation from the Chennai park? When will it break even?
Chennai park, as of now, it's already broken even in this quarter. It's in fact, the EBITDA margin is similar to our established parks, but it will keep varying depending on the quarter. Like, for example, Q2 is a weaker quarter, so we'll have to wait and see how that will pan out. But I think Chennai is off to a very strong start. It's already tracking footfalls of a very established park like Cochin. In fact, Chennai is now currently number 2 in terms of our footfalls. Only Bangalore has higher footfalls than Chennai. So I think it's very, very strong start for us.
You said Q2 hasn't been strong. That's for the overall business in general?
No, Q2 is good, but it's traditionally a weak quarter for us. It's not as strong as Q1, so that's what I meant in terms of footfalls and revenues. But overall, I think we are very happy with the way Chennai is shaped up. Again, I can't give you guidance on how the year is going to come out because it's a new park and it's the first year for us.
Okay, give us a sense of what is it that you're targeting, especially as far as ARPU growth is concerned. What will be the overall targeted revenue mix or the ideal mix for you? The ticketing versus non-ticketing. We understand non-ticketing margins should be significantly higher.
Our ARPU growth for the current quarter, the last quarter was about 7%, and I think we should be able to maintain that. I think low single-digit growth in ARPU can be expected for the remainder of the year. And I think footfall can be, a small growth in our existing parks. And of course, Chennai will be a completely new, footfall for us as well. Our resort business also is tracking very strong numbers. I think we should continue in that momentum for the remainder of the year. That's the hope. And ARPU growth for the year, we don't have a budget for it because it keeps varying depending on the seasons. But I think definitely ARPU growth can be expected for this year. I think low single digits, 5 to 7%.
Okay,
sure.
Low single digits, 5 to 7% will be the ARPU growth. You mentioned the resort business. Tell us how much will this business contribute, say, 4 to 5 years down the line? What is it currently? And how does that change your EBITDA margin mix? Is it different from the parks business? If you can give us more details on how the metrics work here.
Yeah, so the resort business, again, it's a new business. I mean, we have revamped our resorts and we rebranded them. And so it's, again, the first year of operations for this, this vertical as well. As of now, it's tracking double revenues compared to, our previous year of operations. But that will change, I think, as the business matures. Again, I can't give you guidance because it's a new business for us in terms of, the upgraded rooms and the new offerings that we have. But we are very bullish on this. I think we are seeing much more traction for our business, resort business, especially in this quarter. Profitability also will be same or better than our parks business. That's the hope for the first year.
Okay. Arun, give us a sense of the kind of investment we've made. So, how's the current balance sheet looking like? What is the total debt on books? Going forward, can we understand that peak debt is now behind us? And what are the debt reduction efforts?
We are zero debt. We don't have any debt on the books. All the investments that we have done in the last year was through equity and internal accruals. I think we have invested roughly about 610 crores in Chennai. And about 40 plus 20, so 60 crores in our resort business as well. So this has been the current investment. This year, we don't have any major capex plans, but we are planning to, venture into other states, and we will be announcing when we have some, solid news there. So definitely, we can expect more investment.
Which are the states you're targeting, Arun?
We are looking at Maharashtra, we are looking at Gujarat, we are looking at Goa. Also, we are looking at the NCR. So these are some of the places that we are looking at.
And by when, do you now have to narrow it down on a state where you set up a facility or you set up a park, or you've already decided and in all of these states, sometime in the future, we will see a Wonderla resort?
Definitely, we can expect something to come in all these states. We will definitely focus on the larger cities like Bombay and Delhi. But as and when we have some news on this, we will.
And a tentative timeline, Arun?
By the end of this year, we will have something. We will announce something.
Okay, take that point, Arun. Thank you so much for joining us today with the number analysis and the outlook for the business going forward. That's the word coming from Wonderla Holidays. Strong Q1. They expect the trend to continue in the remainder of the fiscal as well. Slip into a short break now. When we come back, we'll get you more on the markets, get some stock-specific action on the other side as well. Stay tuned for that.
Welcome back to Midcap Radar. Well, when you're looking at the markets, the Nifty and the Sensex continues to languish, but the Midcap Radar and the Small Cap Index are seeing certain amount of buying even at the current levels. A couple of stocks on the radar. Jubilant Foodworks, yesterday was the top mover, up almost 8%. Today adding on to those gains, higher by another 6%. And Sona BLW or Sona Comstar is the other stock that's doing very well in this session.
Okay, all right. On that note, we'll take your leave on this edition of Midcap Radar, but do stay tuned, your stocks, when we return to answer all your individual stock queries.
Hello, welcome to your stocks on CNBC TV 18. We are coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny. Along with me is my colleague Arundhati as well. Arundhati, good afternoon. And today in the markets, again, we've come off from the day's highest point. Right now, we're trading near the day's lowest point for the Nifty 50. Obviously, when you're looking at the Nifty, 24,500, around that is what the Nifty is managing to hold on to. So that is interesting to watch out for in the trading session. Now, in terms of sectors that are not doing well, we have banks, ITs that are continuing to see that decline in the trading session as well. So let's watch out for those and where it's going to be headed in the next hour or so in the trading session and last hour as well. When you see that last 15 minutes, what has been happening since the cash has come in, that's something that is something that everyone is keeping an eye out on. Other than that, obviously, we had the policy that came in, realty, autos that did well. And that's the update right now, this afternoon.
Absolutely. And we saw that little bit of a recovery coming in post that policy, but that obviously got sold into. Markets are waiting more details on the tensions in West Asia and what happens on that front. So all of those things will be key to watch out for, and how the market ends as well because of those new rules that we are seeing, right? But on that note, it's time to answer all of your stock queries. And joining us today to do exactly that is Somil Mehta, Head of Retail Research at Mirae Asset Sharekhan, and Sneha Podar, the Vice President Research at Wealth Management at Motilal Oswal Financial Services. Thank you so much for joining us on the show. The first query today is coming in from Kohinoor Ghosh. He holds L&T shares at 2,100 rupees a piece. He can hold it for one more year. He wants to know the likely target in 1 year, and he also wants to know what the headwinds and the tailwinds are for the counter. So, Sneha, let me come to you first, right? Tell us, what do you make of this stock, and what are the tailwinds and the headwinds for this counter in the next 1 year? That's the question here.
Hi, good afternoon. So we are very positive on L&T because it has unmatched execution, and it's one of the giants on the infra side. The current, if I talk about the headwinds, in West Asia, war is a major headwind which is keeping the stock under consolidation, and that is because L&T draws almost 30% of its order book from Middle East segment. Because of which the execution has slowed down a little. But on the positive side, on the domestic front, the order book is continuing to swell. In fact, over the last 1 month, there has been host number of new orders announced by the company. And once the West Asia war settles down, then there will be lot opportunities arising from the Middle East in terms of replenishment that will be required in those countries. So from long-term perspective, we are quite positive on the stock. And if you want to know the target from 1 year perspective, then we have a buy rating with a target price of 4550.
Okay, that's the word in the fundamentals. But on the technical front, Somil, good afternoon. What's your view coming in on L&T? They are making a profit on this one. What should they be doing? The target price and levels to keep an eye out on for 1 year.
Good afternoon to everyone. Extremely bullish on L&T. L&T has always been in the top picks for us. In a uptrend, high top, high bottom formations on all the time frames. It has been trading about 20-40 daily moving average, 200 daily moving average. I think the next target in the medium to long term would be 4,500, 4,600 levels on the upside. And I would say that the short-term support would be around 3,800 levels. However, in the medium term, I think 3,700, 3,600 would act as a base for L&T, and I don't see the stock going below that. So my view would be positive. Buy on decline should be the strategy, and hold on for a target of around 45, 4,600.
Okay, let's move on to the next query for today. We have Manav who's calling us from Chandigarh. This is an investment query. And Manav, afternoon. Thank you so much for calling us on the show. You have a query on 2 stocks. Take it away.
Yes, good afternoon. My query is on Sirma SGS. I'm holding 100 shares at the rate of 1490. Should I continue holding? And its results are also expected in a day or two. Second query is on India Glycols. That I am holding at 1050, 100 shares. Should I hold for target of 1200 in near future? The other one is Cohance Life Sciences. That I'm holding 439 at the rate of 439. Should I continue holding? Its results are expected today only.
So, which is the last stock that you mentioned?
Cohance
Life Sciences. Okay. We'll take that query there. Sneha, your view coming in for Sirma SGS, India Glycols, as well as Cohance Life Sciences. Numbers are expected today. Sirma SGS, Manav is bought at 1490 and India Glycols at around 1050. What should they be doing with these 3 names?
So we are very positive on Sirma. We don't cover the rest of the two names, so I won't be able to comment over there. Now, with regards to Sirma, the overall business is transitioning towards a very higher, on the higher value side of the electronic manufacturing, and they are expanding into the PCB manufacturing, which will commission the plant towards the end of CY26 or the start of CY27. They are also trying to move up the value chain in terms of they're trying to reduce the exposure towards the low margin segments and taking higher exposure towards high margin segments such as aerospace, medtech, defense electronics. So with these, their overall EBITDA margins are supposed to improve over the next few years, and the growth is likely to stay very buoyant. So that makes us very bullish because especially the new plant which is into PCB manufacturing, there India is almost 80% import dependent. So this and Sirma being one of the first movers will definitely gain tremendously out of this. So we're quite positive on Sirma, and I would suggest to hold on from the long-term point of view.
All right, so that's the view coming in there for those stocks. Somil, what about the technical levels to watch for? Investments in Sirma, SGS, India Glycols and Cohance as well.
Sirma and Glycol, both stocks looking good. I think I would suggest to hold on to it. Sirma, keep a very, very strict stop loss around 1250. I know it's a very deep stop loss, but this stop loss is for a medium-term outlook. If you're holding on for long-term, 2-3 years, probably just hold on to it. It's a great stock to be in. Do not trade in the short term. Glycol, absolutely positive on the stock. I think you can hold on to it. Keep a stop loss in the medium term. Keep a stop loss around 1030. I'll be expecting the stock to continue the uptrend. However, Cohance, now this stock we've seen very sharp corrections from the very highs of around 1300, 1350 levels and the lows of around 250, 270 levels. Very recently, in the last 1 year, it has started bouncing back from the lows, and now it has been in a very small range and creating a triangular pattern. I'll keep a very strict stop loss around 390. Keep a very strict stop loss around 190 and hold on to this. I think the next level on the upside would be 600. I'm not expecting more than 600 at this point of time for this stock. Keep a very strict stop loss and targets would be around 600.
All right, so strict targets and stop losses there for those stocks. The next query coming in from Shekhar SR, who writes to us from Coimbatore. He holds 500 shares of City Union Bank at 220 rupees a piece, and he's making a loss on that stock. And he has 100 shares of GMR Power and Urban Infra at 100 rupees. He wants to know the future prospects of both these stocks. He is making a loss on both of them. So, Sneha, let me come to you first. What do you make of City Union Bank and GMR Power and Urban Infra?
In case of City Union Bank, it's a very traditional bank, but it largely focuses on high growth segments, which is the retail and the MSME segment. Now, given their little conservative approach, the growth is comparatively lagging the peers both on the private and the PSU side. But then they have very stable balance sheet and asset quality is quite decent. I would suggest to hold on if the risk appetite of the investor is very moderate. Otherwise, if the investor has a high risk taking ability, then he can make switch to some other bank. But just to keep one thing in mind, that the stock has corrected sharply. So at this level, the risk reward seems favorable. So he can make a switch, whenever the stock makes a slight up move, then probably near the cost price or something, he can switch to some better names. Now, in case of GMR Power, it is a good play on the energy generation and the transmission side. The company is going under a transformation wherein it's trying to deleverage its balance sheet and it's trying to monetize the non-core assets through which it would be it's trying to clean up the entire the balance sheet. So this along with the power sector tailwinds should drive the future growth in the company, but these are the key monitorables till the cleanup activity doesn't get completed. Probably the market will keep a watch on it, so hold with a caution on GMR Power.
Okay, that's a word coming in on the fundamentals for both the names. On the technical front, Somil, City Union Bank as well as GMR Power, what is your view? They bought it at GMR Power at 100 as well as City Union at 220.
The City Union, I'm very positive in the long term. I'll be expecting this stock to continue the uptrend. It's been in the uptrend in the long term, like in the monthly and quarterly charts. It's an uptrend. I'll be expecting the uptrend to continue for a target of more than probably 250, 275 on CUB. Hold on to it. My suggestion would be hold on to it. The other stock, GMR Power. Now, this stock, I'm not too bullish. I'll be bearish on this stock. You just bought it at around 100. So I think my suggestion would be to exit. I think the stock is going down till at least 90, probably below that. So I'll be bearish on the stock and my suggestion would be to exit.
Okay, let's move on to the next query then, and this is coming from Sunil Kumar. Actually, he's calling us right now from Vishakhapatnam, and he has an investment query on Anant Raj. Mr. Kumar, thank you so much for calling us on the show. Go ahead with your query, an interesting play. You want to make your investments or you have already made them?
I already made the investment in Anant Raj. I bought 100 shares at the rate of 650 rupees.
Okay.
Can I hold or sell?
Okay, 100 shares at 650 rupees of Anant Raj. Sneha, what's your view coming in on Anant Raj, right? This is that play, where they're talking a lot about data center as well, the real estate side. That pushes also at the benefit is what the company has spoken about. What's your view on this one?
So Anant Raj is present both in the traditional residential and commercial real estate, and along with it, they have also diversified into the data center side. Now, what the company is trying to do is they are trying to demerge these segments. So it will split the data center into a separate subsidiary, and the existing shareholders of Anant Raj will get the shares of that subsidiary as well. This is being done in order to fund the capex of data centers separately, so that the pressure does not get it's not reflected on the balance sheet of the real estate as well. So it's a good step which the company is taking, and with the once a demerger takes place, then the future capex on the data center side would be funded largely through the stake sale from the promoter side in order to meet the regulatory requirement, and also with the post demerger the funding through the sale of the few of the non-core assets. So with these, the funding will be done, and this will drive the future growth for the company. So I think it's a good long-term play on the data center side, and one can hold on to it if the risk appetite is little on a higher side.
All right, hold it if the risk appetite is on the higher side. Somil, what's your take on Anant Raj? This person has 100 shares at 650. So should they exit or continue to stay invested?
Continue to stay invested. I'm positive on the long term. Absolutely, it would, be a little sideways for a little while now. And I'm expecting it to be, in time-wise correction. But overall long-term trend still remains positive. I'm expecting the stock to, consolidate between 500, 550 levels on the downside and 600, 650 levels on the upside, and then break the entire consolidation on the upside. So I'll be positive for a target of at least minimum 750, 800 in the medium term outlook. But in the long term, hold on to it. It's a great stock to be in. Data center play for the stock is great for the stock, and I'll be at least targeting 900 plus in the long term.
All right, 900 plus in the long term. But on that note, it's time for us to take a quick break. But don't go anywhere. We'll answer the rest of your stock queries on the other side. Stay tuned. Welcome back. You're still with us on Your Stocks. We still have with us Sneha Podar of Motilal Oswal Financial Services and Somil Mehta of Mire Asset Sharekhan. The next query is coming in from Bikash Saha, who's calling us from Kolkata. He has investments in Welspun Corp. Bikash, can you hear us? Bikash? So we seem to have lost the caller there, but he holds a few shares of Welspun Corp, which he bought at 1,700 rupees. The stock is currently trading at 1,774 rupees. So, Sneha, let me come to you first. What do you make of this investment? Should he continue to hold? What's the call?
We don't cover Welspun Corp, but Welspun Corp is likely to benefit from the overall infrastructure development. It is almost like, one of the large pipe companies, and they are largely into the LSAW and the HSAW pipes, where the definitely with the overall infrastructure development that is taking place in India. So this company would benefit out of it. So definitely the tailwinds are there, and moreover, it will benefit from the further capex plans that they have planned for the aggressively for the next few years. So my suggestion would be, from the long-term perspective, this can be held on in the portfolio.
Somil, do you have any view on Welspun Corp on the technical front?
Absolutely. We are very positive on the stock. We've been, holding on to the stock report for a little while now. Very strong up move. Holding on to 20 daily moving average, very high top, high bottom formations on all time frames. In the very short term, support would be around 1,540. That will be the support. Another support in the medium term would be 1,400. That can act as a base. I'm not expecting the stock to go below 1,400. On the upside, I'll be expecting this stock to target at least 2,000, 2,100 in the long term. So hold on to the stock. Please do not trade in the short term, because it has already, moved very sharply. Do not trade in the short term, but in the medium to long term, please hold on to it.
Okay, Bikash, I hope that answers your query there. But let's move on to the next query. This is coming in from Amardeep. He wants to know the fundamentals and the technicals for Equus Limited. Sneha, this is obviously fairly recent in terms of a company that we've seen coming in, more on the defense side. What is your view on this one?
Equus is a small company. It's a very specialized company into precision manufacturing, and it caters to the aerospace along with the overall toy manufacturing segment. Now, in the toy manufacturing, the government, in fact, recently has set up a task force to boost the toy manufacturing exports. So that would be quite positive for Equus. And on the aerospace side, in the defense budget this year, aerospace was given the highest budget allocation. So that keeps Equus in the sweet spot. On the balance sheet side, though, we might see some strain because of the heavy capex that the company is undergoing. But in the long run, all this will reap benefits to the company. The stock has run up a little, so valuations are on a higher side. But purely from the long-term perspective, there's a theme. The aerospace is a emerging theme which has a structural growth opportunities. So from that angle, I would suggest to hold on to the stock.
So you would suggest to hold on to the stock. Somil, what's your view there? Equus did list very recently, but any technical levels that the viewer can watch out for?
I think even I'll agree. I'll hold on to the stock already in the uptrend, a strong uptrend, because every time it corrects, it takes support around the averages and again starts the up move. I'll be positive on the stock. Keep a stop loss around 210. It's a little deep stop loss, but keep a stop loss around 210. And I think the next target on the upside would be 280, 300 levels. In the medium term, do not trade in the short term.
So do not trade in the short term with a stop loss of 210. All right, Sneha and Somil, thank you so much for joining us on the show and answering all of our stock queries. But with that, it is a wrap on this edition of Your Stocks. But do remember to email us your queries and we will address them with our experts. But stay tuned for Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
$186 points now is where the implied open is. So at this stage, if the implied open holds, we most probably open above or near the mark of 24,800.
We are in talks with the Iranians, and I think there is a chance we may have a deal today or tomorrow.
I'm looking at the Nifty futures prices, and if I can, the spot price, the Nifty spot yesterday at 315 left off at 24,463. And at 3:30, that price was 24,615.
General insurance companies kept asking for a motor third-party price revision from the Ministry of Road Transport, from IRDAI, but the blessing really came from Supreme Court.
79,055 on the Sensex. The Nifty is going to be in focus. 24,646 is the first start.
No, I think the earnings season has been pretty strong, especially on the mid and small, where the earnings growth is almost 20%. Even for Nifty, after a long time.
The MPC decided unanimously to keep the policy repo rate unchanged at 5.25%.
For Manipal, it's one of the largest healthcare IPOs in recent times. So 9,275 crores is what they've raised via the IPO.
We've been able to pick up what SEBI chairman's or SEBI's view was on those concerns. Essentially, there is no plan from SEBI's end to change or stop or alter the CAS framework in any manner.
A very volatile market. That's how the day has been so far.
Well, gains have petered off. The day so far has been, that kind of a day. I think on yesterday's 315 close, we are up only about, 65 odd points or so. Actually, not even 65 points, 40 points, right? So 25,500 is where we are at. And yesterday's 315 close was 24,463. This is Closing Bell. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant and Rima is with me. Rima, hi, afternoon.
Hi, afternoon. Just taking stock of some of the big movers. Tech names are under pressure. HCL Tech, TCS are down close to about 2%. Apollo Hospitals has been subdued since the start of the trading session. BEL, Reliance Industries, HDFC Bank. In fact, banks have been lagging today. They moved to the day's low, and it's HDFC Bank with a cut of 1.25%. Axis, ICICI Bank falling 1%. ITC, HUL also underperforming today, down nearly 1%. What's holding up the other end of the market is Grasim. Shriram Finance has been strong. It added about 3% yesterday, and today another 2%. JSW Steel, L&T has been moving well. Hindalco, Interglobe Aviation, and SBI. The mid-cap index for now is holding on the flatter side, but a lot of individual names catch your attention, many of them reacting to numbers. And Manipal Health has had a good day one, with the stock today up close to about 14%. Kirloskar Ferris numbers up for you on your screen. That stock is down nearly 4.5%. Let's tell you what we've lined up on Closing Bell today. Today we go all the way up to 4 o'clock. Markets are near the day's low. The Nifty is testing 24,500. The broader markets outperforming the larger peers sectorally. Auto, metals charge ahead. On the flip side, FMCG, IT on the back foot. India's Apex Court enhances the period of mandatory third-party motor insurance coverage for new vehicles by 1 year, which means new cars will have to have 4 years of insurance coverage, third-party coverage. Two-wheelers will now have to have 6 years. So which is why ICICI Lombard, Go Digit, New India Assurance are all surging in trade. We'll analyze the moves in just a bit. In key earnings reaction, we'll understand how the likes of BSE, MCX, PNB Housing Finance fared in the quarter gone by. The new kid on the block, it's been a good steady debut for Manipal Health. Stock up 14% versus the issue price. We'll compare the business model versus the others on Closing Bell. Before now, 1 hour to go before we wrap for trade. How should you position yourself? Mitesh Thakkar is now joining in. Mitesh, explain the slide through the course of the trading session. Is it just profit taking? And what are the trends that have emerged, or your technical analysis of the same?
Good afternoon. So I think, the Bank Nifty, I've been highlighting that if the Bank Nifty starts getting past 58,500, 58,550, there could be some breakout on the Bank Nifty, which in turn would help the Nifty capture higher levels. I think that's not happening. To me, I think it is still a phase of consolidation. The bank Nifty is broadly doing 56,500 to about 58,500, and therefore I think the index is also, failing to find momentum to sustain above 24,600, 650 zone. So for the time being, I think index, a long trade will occur in case we get closer to about 24,400, and then you can take a 50, 60 point kind of a stop loss and maybe, trade on the long side. But otherwise, it's more of a stock-specific market where people should, or traders should, look at trading into individual stocks.
And what would those individual ideas be?
I have a buy on RBL Bank. See, it's broken above the earlier highs of 380. If you look at the charts in the last few months, multiple times it failed to close above 380. Today is trading above that. So buy with a stop below 379. Look for a target of around 405 to 408. And a sell on max help with a stop at about 1096 for targets of 1020.
Okay, we'll come back to you, Mitesh, for more trading ideas. For now, let's talk about those insurance companies, because the Supreme Court has extended the mandatory third-party motor insurance coverage for new vehicles. This covers both four-wheelers and two-wheelers. It's been extended by 1 year. Yash joins in with the details and the impact on each company. Yash.
Well, as you rightly pointed out, about 1 year has been added with respect to the mandatory coverage of motor third-party insurance policy for both two-wheelers as well as four-wheelers. Currently, when a motor third-party insurance is bought, which is compulsory to be attached to every vehicle, it comes for a period of 5 years for two-wheelers and 3 years for four-wheelers. And now that would become 6 years for two-wheelers and 4 years for four-wheelers. What that means is that upfront payment in terms of the premium will have to be made for a period of 6 years for two-wheelers and 4 years when it comes to four-wheelers. That itself is a big positive for general insurance companies, because they'll get to receive 1 year worth of premiums higher than what they were doing before because of this addition of 1 year in terms of the mandatory coverage. I'll just quickly focus on the numbers in terms of the three companies that are listed, who gets to benefit the most. In terms of just purely the numbers, Go Digit is expected to be the biggest beneficiary because of their sheer market share as far as Motor TP is concerned. The Motor TP contribution of total GDPI, on that basis, Go Digit has a 42%, 42.5% share. ICICI Lombard has a 20% share. New India has a 14% share. In terms of addition to financials, in terms of premium, four-wheeler, the 1 year which has been added, Go Digit, it would add about 530 crore rupees. In terms of the two-wheeler portfolio, it would add about 230 crore rupees. Improvement in underwriting performance, that would be about 30 crore. Improvement in PBT would be about 90 crore. And PAT would be about 70 crore. Same ways for ICICI Lombard, addition to premium on four-wheeler about 740 crore. Two-wheelers would be about 270 crore. Improvement in PAT because of this 1 year addition to ICICI Lombard, that would stand at about 90 crore rupees.
Okay, and stocks are moving in that sense. Somebody's really wanting to get in touch with Yash there. The phone's going off non-stop. Yash, take that call now. Thank you for that. Siddharth Khemka is with us. Sid, good afternoon. Good to have you with us here. By the way, Whirlpool numbers. Revenue is up 12, EBITDA down 34, and I think profits are also down quite a bit. These are all year-on-year comparison numbers. Stocks down about 4%. I think it's taking a bit of a dip as we speak. Look at margins as well. There's a sharp slide. Stock, I think, was maybe flat or maybe slightly lower, but now it's down fully, 4.5 down. And margins have also shrunk to 30% compression as far as net profits are concerned. So this is, I mean, unless I don't think there was any expectation around this, perhaps except those who are tracking it on a quarter-on-quarter basis. In terms of sell-side coverage, I don't think there's any. But year-on-year, the numbers look poor, prima facie. Well, Sid, I don't know if you have any thoughts on the insurance story on motor side and anything you like there.
Yeah, hi, good afternoon, Prashant. I think overall, this is a directive from the Supreme Court which adds 1 more year to the third-party insurance. So essentially what it does is the lock-in for a customer gets extended, and hence the chances of changing the insurance provider goes down by that percentage. So I think it's a positive step, and I think across companies in the general insurance space, I think it will be a big positive step. What we like, ICICI Lombard, which is under our coverage, has been consistently reporting strong growth both in the motor as well as in the health insurance space. I think some of the larger government companies like New India Assurance, GIC, RE, again with the stickiness increasing, and given that now that insurance coverage should go up, that should also help lower the cost for the reinsurance companies. So I think twofold benefit: the general insurance companies where we like ICICI Lombard, and the reinsurance space, New India as well as GIC, RE.
Got that. Siddharth, you all like the QSR space. You believe they are reaching an inflection point because going ahead, the number of stores they will be adding will be less than what they've added in the past. And therefore, the unit economics, the same store sales growth should also pick up now, the unit economics. So amongst the pack, which one do you like, or will the entire sector, all of them, do well?
So yeah, good afternoon, Rima. Thanks for highlighting that. I think, yes, what we believe is that the QSR sector appears to be nearing an inflection point. As you rightly said, FY22 to FY26, we saw store additions growing in the range of about 15% CAGR. Going forward, this is likely to be much more stable at around 10-11%. What we're also seeing is that the capex done in the last few years, these store economics are improving, some of them definitely breaking even and adding to the overall profitability. Also, another fact is that the recent underperformance from the sector has been because of some of the demand weakness, and I think that is also now witnessing gradual recovery. Going forward, we see that the overall there are early signs of recovery emerging. Strong, we are seeing strong same-store sales growth. In-dine traffic is improving, and with stores maturing, better profitability across most of the brands. We also expect margins to improve further, again because of operating leverage, stronger same-store sales growth, as well as a gradual earning recovery. I think the entire sector should do well. What we like, Devyani International, Sapphire Foods, these are the two stocks that we continue to like and have a buy rating. Restaurant Brands Asia came out with very strong numbers, and we are seeing sharp recovery. Losses are coming down. That is another stock that one can focus on. We have a buy rating with a target price of 125. Finally, we are also upgrading Jubilant Foodworks, which has now underperformed for quite some time, and the stock has fallen about 35% in the last 12 months. But we believe now, with the demand environment improving, store economics improving, and the most part of the negatives already priced in, we believe from here on things could look much better, and hence we are upgrading the stock to a buy with a target price of 625.
Got that. Just look at Shilpa Medicare. I just want to highlight what's happening to that stock. And maybe our research team will come up and sort of provide. The numbers came out basically, and the numbers are super strong. Is just like, nothing was happening. And then it all changed. It's like a vertical move, take off. And numbers came out at 145. I think around 140 or so. And it's up $100 since. All of it post results in that sense. So Shilpa Medicare, and as I said, we'll try and have the research team come up on this one in a bit from now. So
give you the numbers, but I don't have more than that. Revenues are up 45%. Margins have expanded by 75 basis points, and profits have doubled. So 47 crore in the comparable quarter of last year has become 101. So revenue growth 45%, PAT jump 50%. So
50% goes on net profits. So that's
net profits are doubled, 47, 101.
Oh, 100%.
So 100% jump. The top line is 45%.
45%. Okay, all right.
So yeah, it's
numbers look very, very strong, and I think that's the reason why you're having this kind of a move on Shilpa Medicare. More in terms of margins and what's done well, and how does this change full year estimates if there are any. So I think those things will be important to look at as well, and we'll try and do it. PNB Housing is the other one, right? Numbers came out, and we were talking about this in the morning. Numbers were a mixed bag because NIMs were lower, yields, etc., were lower. But otherwise, in terms of growth, loan book, etc., pretty strong. But then there was a conference call, I think, in which the management sounded pretty confident for the full year. Ananya is here with details on this one. Ananya, take it away.
Well, yes, it was a good quarter for PNB. I think why I'm saying this because the numbers were operationally in line. Asset quality was stable. Credit costs were negative. And but if you look at the margins, there was some compression with management clear that it has bottomed out and will improve from Q2 onwards. Now, if you look at the numbers, the loan book grew 15% year-on-year basis. AUM grew 13%. NII at 6% year-on-year. PPOP at 9%, while PAT increased 4% but was down 15% due to the NIMs like I mentioned, and ROA and ROE also have moderated. Yields, if you look at on year-on-year basis, have compressed, was down 60 bips year-on-year basis, but is stable quarter-on-quarter if you see. Now, like I mentioned, asset quality was strong with GNPA at 0.95% and NPA at 0.58%, both better year-on-year if you see. Credit costs continue to stay negative, supported by recoveries with 67 crore recovered from the written-off pool year. Now, management also maintained 18 to 20% loan growth guidance with affordable and emerging segment expected to remain the key growth driver, while credit costs will continue to stay negative going forward. So we'll watch out for these from Q2 onwards.
Okay. Well, there is PNB Housing coming in there with numbers. There's lots of stuff doing well, and we are looking at many of these individual big movers at the bottom of the screen. Sid, just coming back to you on I don't know if you have a view on Shilpa Medicare, which we were talking about earlier. PNB, if you have coverage on both, do come in.
Yeah, Prashant, Shilpa Medicare, I've not had a look. Just results came out just some time back. I think pretty good set of numbers. PNB Housing, definitely we have coverage. What we saw earlier was that earnings came in line with expectations. However, NIMs contracted 19 basis points. Loan book growth, retail loan book growth 16% was again in line. I think as you rightly highlighted, the management con call, that was pretty sounding pretty confident given that it has maintained its FY27 guidance of 18 to 20% overall loan book growth, especially if you look at the affordable loan book. There the management is expecting the 50 to 60% growth. I think that is something that has helped improve the sentiment. Management also aims to sustain the ROAs at about 2.3 to 2.35% in the medium term, and around 2.4% is the exit run rate. I think overall things are falling in place for the housing finance companies in which PNB has been delivering in-line kind of numbers. So currently, I think with this management commentary, stock has been doing well, and I think we would continue to do well with this kind of commentary. Results were mixed, but as I said, again, disbursements remain strong, and the guidance also pretty strong with valuations comfortable. I think that should help the company continue to do well.
Two more stocks came out with numbers sometime back, seeing big moves. Gateway Distriparks, that's down 6.5%. This is after the company's bottom line has gone down by nearly 19%. EBITDA is flat, revenues are flat. So stock has nosedived 6.5% down. And the other one is Monte Carlo, where the EBITDA loss for the company has doubled on a year-on-year basis. EBITDA loss at 12.7 crore. The bottom line loss has also widened to 23 crore. And Monte Carlo too is down 7%. Rolex Rings and HT Media on the flip side are reacting well to their numbers. So some of these small mid-cap moves on the back of numbers are seeing some wild swings. But let's talk about MCX, BSE. They're reacting to their first quarter numbers. Devyani gets us a review.
Well, MCX reported a weak set after a record quarter four, and this was in line with street expectations though. Now, futures and options average daily turnover came in at 10.5 lakh crores, up 58% quarter on quarter, yet revenue fell 21% to 702 crores. Now, this was largely as a result of the significant cool-off that was seen in the volatility. In fact, yields have almost halved on a quarter-on-quarter perspective for the company, and as a result of the lower revenues, operating leverage also reversed, with EBITDA down 26% and margins dropping 460 basis points. PAT as a result fell 22%. So all in all, a weak set for MCX. Coming to BSE, it was a steady set from the company. Trading momentum has continued throughout Q1 with premium yield to notional turnover in fact having increased this time around, with average daily premium turnovers up 2.4% in spite of a drop that was seen in the notional turnovers on a quarter-on-quarter perspective. Now revenue came in flat at 1566 crores, EBITDA came in at 1072 crores with margin stable at 68%, and PAT has gone up by 10% to 874 crores. But keep in mind, this is largely on the back of mark-to-market gains as a result of the better markets that were seen. Now what is weighing down on the stock today is the management commentary. Now they noted that the SCT hike as well as the RBI bank guarantee rules have actually impacted volumes across the system, but BSE's direct impact cannot be discerned at this point in time, with legacy bank guarantees still clearing throughout the entire system and the futures segment for BSE being small at this present moment. That said, brokerages have cut target prices for BSE including JP Morgan, which has cut its target price from 4,330 to 4,090, maintaining the buy call on the company though.
Rima, for BSE, I think this is of course numbers which are there for the last quarter, but I think for BSE what will matter is the expiry tomorrow, because BSE, like NSE for example, and so I think we were trying to do this exercise, look at NSE's volumes in the F&O segment, because yesterday was the first expiry under the new cash segment, Tuesdays. How does it compare to the last, say, average of last 4 Tuesdays, right? I would suspect there's a big dip.
Yeah.
If that is true, then I think for BSE as well, because I mean, because the BSE Sensex contracts expire tomorrow, the weekly contracts that is, is it the cash system, is it going to keep people away from participating because you don't know what you're doing? As I think Rajesh Baheti yesterday was saying, and it's a valid
settling early.
It's a valid point, right? Why you don't know what's going to happen because you have kind of a blackout period for about 10 minutes and suddenly the price opens up 150 rupees. F&O market is still open till 340. So actually anything can happen, right? So, but that we will only know on Friday. What happened on Thursday? So NSE is not listed, but BSE is listed. So I just want to, I think there was some chatter in the morning. Stocks down 3%. I'm not sure if this is because of on the back of numbers. Maybe it is. But the trigger to look ahead and watch out for, of course, is what happens as far as tomorrow is concerned. So if you look at yesterday's session on the BSE, the total turnover in the cash during the cash segment is some 1.5 crores.
But did it go up yesterday versus the prior day? I mean, the second day it would have gone up anyway on account of expiries, so the volumes would have been higher.
So actually wrong to compare because tomorrow is the expiry, right? I mean, so, but my point is that on cash, cash is every day, that is cash, right? On the cash segment, yesterday the turnover in BSE was some 1.5 crore rupees. So, so cash, because cash market share is much smaller. Options BSE is doing fantastically well. So that if the volume is say not even 1.5, is it 2 crores, 5 crores, whatever it is, right? But such a small amount traded on cash, determining the much larger option segment. That is the worry in that sense. So we'll see if participation dips or not. But as I said, we'll only know on Friday.
Siddharth, at Motilal Oswal at the desk, are you all settling early to avoid these wild fluctuations that we've seen over the last 2 days?
Yeah, Rima, so actually the first day we are all perplexed with the way the kind of settlement happened. I think now a lot of understanding is happening across the trading floors. We are doing sessions to make people, dealers as well as the clients understand how this is going to happen going forward. But definitely, I think this will lead to some volume contraction in the near term, given that there is cautiousness how the prices will react post 315 when the F&O stops trading and then resumes to do the matching. So definitely a lot of these transactions are now being wound up before the 315 cutoff. That is definitely happening, yes.
Thank you very much. Stay on. Let's talk about Shilpa Medicare. Ekta is now joining in to analyze the numbers. And Ekta, I don't know if you had a chance, but even the outlook of the company has been released. So they've released that investment update, and they are talking about improved utilization is likely to drive a meaningful improvement in revenue and EBITDA margins going forward. Make sense of the numbers and the way forward?
Well, yes, they have been showing this kind of a growth in the past couple of quarters, at least in terms of the consistency, in terms of margins. So if you just look at this quarter's numbers, it is a 45% growth in terms of revenue is what they've reported to 466 odd crores. The EBITDA margins have come in at around 29.3% versus 28.5% year on year and versus 27% on a sequential basis. So there has been this consistent improvement in terms of margins, which the company has been undertaking. And the profit, in fact, has come in at around 101 crores versus 107 crores Q on Q and versus 47 crores on a year-on-year basis. So good improvement on a year-on-year basis, and on a quarterly basis, they've managed to sustain. Now, I did manage to glance through the investor presentation, and they have indicated that growth was led really by all of the verticals this time. API, for example, was up around 15% on a year-on-year basis. Their novel products segment, which is still small, was up around 100% in terms of revenue on a year-on-year basis. So those seem to be key additions for the company in terms of growth this time. So overall, good set of numbers. Company has indicated that yes, utilization as it goes up is going to be a growth driver for both revenue and margins.
Yeah. Okay, that's Shilpa. Thanks very much for putting that in context. The other one, of course, is a new hospital company, Ekta. So one more added to the list to track, and this is a big one, well-known brand, etc. I mean, people were saying it was expensive at the IPO price, but I mean, I think it was up 10% on top of that this morning on listing. So how does it look now?
Well, yes, it's definitely a great brand, Manipal Hospitals, and it's really grown because of the number of acquisitions that they've made. So they've really increased their scale through that. If you look at the overall, revenue growth, it has been steady for the company. It's over 10,000 odd crores in terms of revenue. They are the second largest hospital via revenue, as well as the first largest in terms of bed capacity. They got good response to their IPO. Overall, it was subscribed around 4.5 times, but the QIB did show a lot of interest. The anchor investors were around 133. They subscribed to over around 4,000 crores of the IPO, and it was at the upper end of the price band as well. Now, going forward, in terms of what the company has guided for, they are saying that they will be looking at Delhi and the northern region as a key area in terms of expansion when it comes to Manipal going forward. They will be looking to increase the Sahyadri margins because that was one of the key acquisitions that they made. So looking to increase it from around 18% to 23%. And overall, they will be net debt zero post this fund infusion from the IPO once it takes place. So in terms of valuations, yes, it is expensive. It is more in line with probably what Max is trading at on an FY26 trailing PE basis. So expensive, but you are buying into a hospital which has around 49 centers across the country. It is a multi-speciality bed hospital with around 13,000 beds.
Well, indeed, quality franchise, Manipal Health. Thank you very much.
At a quality multiple.
At a quality multiple, 70 times trailing, 70 times plus trailing. But the company has been growing fast. But a lot of the growth has also been led by the acquisitions that the company did, the latest being Sahyadri. But with the money raised, they will pare down part of the debt. So that should improve the bottom line as well. Siddharth, on Manipal Health, do you all have a target price? Can one buy now at 667? Or there are better plays?
So, Rima, unfortunately, we have not yet made any coverage on Manipal. We were one of the bankers to the IPO, so right now, no view. But overall, healthcare space looks very interesting. Some of the companies which are already there, we like Medanta, which is your global health, very strong numbers. Apollo hospitals continue to do well. We are seeing traction both on the occupancy as well as the average revenue per operating bed are seeing improvement. And with that, the per unit, again, operating matrices are improving, leading to better profitability. I think Apollo Hospitals and Medanta, these are the two currently under coverage stocks, which are the preferred picks ideas in the healthcare space.
All right, we lead the conversation here. Siddharth, thank you very much for that. Get into a break. On the other side, our Alpha manager for the day, Jitendra Sriram of Baroda BNP Paribas Mutual Fund, will join in for a chat. Stay tuned.
Lots of numbers keeping us busy and some news flow as well. NBCC is backed a near 800 crore order. That is the flash which is coming in right now. Jitendra Sriram is with us, Senior Fund Manager, Baroda BNP Paribas Mutual Fund. Jitendra, good afternoon. Good to have you with us on the program today. So, is CAS closing auction a topic of conversation at your end?
It is. So if I were to, so it is creating a little bit of an aberration into the closing in a sense that, you have a disconnect in the timing between where cash equities closes and where derivatives closes. And if you were to compare it with global markets as well, see, most other markets don't have single stock futures. So to an extent, this aberration seems to be a little bit more pronounced here, which is where I think people are taking a little more time getting adjusted to it.
Yeah. No, yeah, absolutely. You're right. In terms of the adjustment process, yes. And of course, I mean, the fact that the F&O segment, I don't know why we have that cash closing for F&O stocks right
3:15, and do you have?
I think they're putting that in 15 minutes on the other side. So if you see the right-hand side of the screen.
I was confused. I said, this is only happening at 3:15.
Countdown. There is a countdown to that. There you have it.
Oh, I see. Okay, that's the countdown to the cash closing. Okay, fair enough. Jitendra, so what's keeping you busy in terms of, big result reactions, right? I was just discussing Shilpa Medicare, there's a listing, Manipal. It's an absolutely vibrant market with both primary and secondary action, but largely concentrated, of course, in the smaller stocks. Manipal is not small, but predominantly has been some of the smaller companies.
Right. In a sense, if I look at the results that came out till the prior weekend, till the Friday close, I think small cap is doing quite well on the earnings front. If I look at the broad numbers, it seems to be suggesting a late 20s kind of a growth in earnings on a YOY basis for the small cap segment compared to, say, large cap doing just about a double-digit growth. Mid cap is obviously a little bit corrupted by oil marketing companies. So if I were to exclude that, that's like a mid-teen kind of a growth. But small cap is definitely doing far better. The thing that is quite interesting in market is that despite so much of primary paper supply, you are able to absorb all this in the market is still fairly resilient, which is a good sign of depth in the market.
As an institution, we're all interested in LIC's offer for sale. It came at a discount, and also going ahead, given the increase in free float, it will be a part of various indices, and that will result in passive inflow. So that is a tailwind which lies ahead for LIC. So any view on? Yeah.
Yeah, you're right in that. In a sense, see, even from the point of the biggest overhang on the state insurer has all along been that there was a big supply overhang because you have a certain listing mandate that you have to get down your available ownership down to a certain level, etc. That was a constraining factor because that was always an overhang on the stock. So to that extent, once that overhang goes away, I guess there should be a little bit of a sentiment booster as well. And if I were to just look at pure fundamentals as well for most of the insurers, the fact is from a point, see, all the players now are fairly reasonably converged in that VNB margin between, say, 21, 22 to, say, 25, 26. So there has been a fairly resilient, robust operational metric which is kicking in. Also, the fact that, as you keep raising your non-par business, etc., the implications that it won't have too much of an impact or drain your solvency ratios is also being appreciated a little bit more. So those are things that are definitely positive for the insurance space.
Okay, right in queue, we could see that flash that the retail portion of LIC's offer for sale has also been fully subscribed. So Jitendra, you were telling us how that the earnings has come in much better than street expectations. Which sector, according to you, has the most visibility, earnings visibility, where we can expect strong growth to continue, say, for the next 2 years?
So one thing that has definitely been a surprise element in this entire quarters has been the auto segment, auto and auto ancillaries, and they have delivered quite handsomely. And you can see the stock reactions also in the last couple of months. Auto sector has been doing quite well. I think the real challenge for the sector will come in 3Q as such, because see, 2Q you had last year the Prime Minister announcing on the eve of Independence Day about a potential GST cut, and till it became operational, say in late September, you had a little bit of a deferral of sales. So you have a fairly benign base in auto sector for last year. And I'm sure that on that benign base, you will be able to show fairly handsome growth numbers into July, August, September kind of a thing. But what happened last year was that some part of this demand has actually has spilled over into the festive quarter. And what we'll need to see is how the festive quarter this year, with the base of a spilt over demand, also fares. But as of now, the indicators are fairly positive that there generally seems to be some strong underlying demand trends in this sector.
Okay, Jitendra, we leave the conversation here. Thank you very much for joining in. Well, we're counting down to the cash closing, but before that, let's get the latest trends from the futures and options space. Sudarshan joins in.
So in the last few minutes, there is a minor recovery in the market, while Nifty and Nifty Bank, even Sensex, all three indices are in the red. What is if you talk about the market breadth, it's still in the favor of advanced, and the reason of that is the broader market, especially mid-cap index, that is in the green. And the reason of Nifty in the red is because of the heavyweights. You talk about Reliance, HCL Tech, TCS, all these stocks are dragging market. And from the financial space, HDFC Bank and ICICI Bank are dragging market. And that is the main reason why Nifty Bank is also in the red. Now talk with the put-call ratio. Now at one point today, it was closer to 1, or even it had crossed 1.07 it had hit, but from that it has come down. Now it's around 0.80. Now that tells you that there is an aggressive call writing, and where exactly it's happening above 24,500 to as high as 25,000. So on the top, the range for Nifty is from bottom 24,500 to 25,000. That's the reason on the call side, 24,700, 24,600 and 25,000. These are the strike rates which are seeing the maximum increase in the open interest. At the same time, premium for all these three call options has seen an increase. On the put side, the biggest active, the most active put option is 24,500. So immediately support for Nifty would be 24,463. That was the level at 3:15 p.m. yesterday. And if you talk about the resistance, that would be 24,850. If we cross that, next resistance comes around 25,000. For Nifty Bank, support would be at 57,460. Very important level. It's the level of 20 DMA as well as 200 DMA. And next support comes around 56,800. For resistance, 57,900. Some of the stocks that are in the focus, first one is Godrej Property. It was a strong set of earnings, and commentary has been positive, and that's the reason stock has been seeing fresh longs. Dixon Tech has started seeing short covering, and all the other EMS names are in focus too. Cummins, ahead of the earnings, has started seeing addition on the short side, and also from the heavyweight side, Reliance is seeing addition on the short side.
Oh, absolutely. Thanks very much. So for that, that's very useful at this point. There's 7 minutes to the closing auction session to kick off. Let's get what's happening on D Street chatter. What is Nimish picking up? Nimish, take it away.
Hi, Prashant. A def consolidation, but I would say the institutional activity is on a higher side. So expect high volumes, and generally there is a bit of activity both on the future side as well as in the cash market from large institutions. So the flows are on the both sides as far as the FI interest is concerned. Clearly, the sector seems that stands out today is the auto names. So not only auto stocks, but even the auto ancillary names are buzzing in trade, and big outperformance in that space in today's market. Even some bit of metal names have outperformed in the last couple of days, largely because underlying assets have gone up and the dollar index is also below 100. So these are the two sectors where there is a bit of momentum and a bit of chase as well. From a technical point of view, the current level of 24,500, 550 is acting as a big resistance. So if that gets taken out, you'll potentially see further short covering rally. We've seen a bit of short covering in the last few days, but that momentum on short covering can continue if we sustain about those levels. But purely from a flow perspective, it's both sides today, but the interest clearly seems to be in the auto names as well as some metal stocks.
Yeah. In terms of individual stocks, Nimish, what's on your list?
So the first stock is Jio Financials. It's flat in today's trade, but off late we've seen a bit of HNI interest back, and the street is anticipating some corporate development as well in Jio Financials. So that's the first stock. Second stock is Indus Tower. Again, stock which has been consolidating with a negative bias, been under pressure as well. But first signs of institutional interest back, and I believe one of the leading domestic mutual fund has started accumulating interest cover at current levels. So that's the second stock. Third is Vedant Fashion. Again, kind of a bombed out stock, has not done anything in the last 3-4 years. Some bit of interest seems to be back in that name as well. And post earnings, there was a bit of, some domestic mutual funds seems to be accumulating at current levels into Vedant Fashion. And last couple of stocks where Street is anticipating block deals, Pine Labs as well as in the Piramal Pharma. Both, while it's been in the range for a while, but expect large block deals in both these names. In Piramal Pharma, the private equity investor is likely to be a large seller, and that can expect sometime very soon.
Interesting deals, lots of them, right? Pine is in focus and Piramal Pharma is in focus out there as well. On CAS, Nimesh, any feedback?
Well, it's been a bit confusing for most of them. I've been talking to so many dealers, fund managers, and everybody seems to be grappling with this whole. It's just a 2-day process. I guess everybody will take some time to adjust to it. But yeah, for the first 2 days, it's been quite hectic, as well as a bit surprising as well as to what's the real intent of doing this. So everybody's trying to figure out what's the way out. But I guess it's still early days. But I guess it's going to be a reality. We'll have to live with this. So I guess everybody will learn and figure out how to trade in this last 15 minutes.
Yeah, absolutely. So Geofinance, Indus, Vedant, Fashion, Pine and Piramal Pharma on the charter list. Thanks very much, Nimesh, for that. Berger Paints numbers are out, 15% growth in EBITDA. So 607 crores compared to 528 crores same time last year. Stock spiking as we speak. That is Berger for you. Margins are flat at 17%. And I think we'll have top line numbers coming through. Revenue, profits are up 21%. The numbers actually seem pretty good. 404 compared to 334 same time last year. Revenues are up about 12%. As well. Okay, so that is Berger for you. We'll take a quick break. We'll come back and we'll get you some technical trading ideas with Mitesh on the other side. Okay, well, it's 3:15, which means the closing auction session has begun. Which means that the Nifty is now at 24,570. So that becomes a reference price. And you saw that a small spike, right into the end of the close. As you went into 3:15, I think everything went up a little bit, because I think the expectation is that I'm assuming the expectation is that out of it, on the other side at 3:30, 3:28, you'll get a bit of a bump. So 24,570 is the close, and we are at 24,610 on the Nifty futures. So Sensex at 78,502 and 78,700 as far as futures are concerned. So, and let's look at the Nifty Bank as well. Same thing. I'll give you a quick sense of where we are on that index as well. Nifty Bank should come up and in just a bit. So 57,630. And 57,854 is the Nifty futures rate, Bank Nifty futures rate at this point in time. Okay, so basically, the special auction session actually starts at 3:20. So 3:15 to 3:20, nothing. 3:15 stop trading, and 3:20 is when the special auction session starts. You can put in rates, etc. And between 3:28 and 3:30, basically we'll get the final values. Futures, of course, trading will continue undisturbed. Continuous trading will go on, not till 3:30, but all the way till 3:40. So that's what we are looking at. Uttam Bagri is with us, Managing Director at BCB Brokerage. Of course, he's been associated with industry forums like the Bombay Stockbrokers Forum. And Mayuresh is with us. Uttam, welcome to the program. I know you... Uttam, by the way, for those who don't know, wrote a note yesterday. What was it? Why don't you tell us? Uttam, what was it called?
So, this is a note I had written 1 month back.
Oh, 1 month. Okay, so then that was prophetic, but go on.
So I had written it 1 month back, and it was you give it for publication around a month in advance. It was issued on 1st August, before the market, before this whole thing happened. And that article was called "Mujhe Dar Lag Raha Hai."
Mujhe dar lag raha hai.
Yes.
Yeah. This is 1 month ago, but this was about cash.
It was about cash, all the way about cash. And basically, I was fearful, and I was hoping I was wrong, and it turned out to be a little prophetic, if you may say. Yeah. So again, it's a standard stuff. That article had 2 aspects. And since we have 5 minutes to go, number one, please, we have to ask ourselves, what is the closing price? Historically, we are the 30 minutes average, weighted average. Now, some people say, hey, the markets have moved in half an hour. It's not nice one. It should be 15 minutes. Some say it should be last traded price. But then again, there's a risk 15 minutes is too less. So there is no perfect closing price. We find the least inefficient closing price to figure out our life, to make our charts, to do the NAVs, to do everything. Now, throughout the world moved to cash. They believe that cash is the least inefficient closing price. The world moved, India had not moved, and we were under a lot of pressure. Hey, even we should do that. So SEBI, in its wisdom, came out with 2 consultation papers, talked to a lot of people, and said, let India go down that path. We'll try to we'll follow the world standard. Here we are. And at that time, point of time, when the consultation happened, the entire Indian domestic industry was very, very skeptical about this project. However, there were international passive funds who were very excited. Yes, you're becoming international standard, great, lovely. And that's where we moved to. And always the question we asked ourselves was, who will participate in this session? Because the whole game is participation. In the current closing session, half an hour trading, which derives the closing price, has everyone trading, retail, institution, fund, the speculators, the DIs, the FPIs, everyone. They trade as a closing price, just a derivation of all their trades. Now we are all trading together to trade, but to discover the closing price. Who is going to trade? But I'll speak about it in a couple of minutes. So this is my opening remark on this topic, sir.
So, 1 minute. Uttam, you're saying that the issue is the way the cash session is designed? Is that the problem?
No. The session is designed the way it is designed internationally. All right, cash is
It's
everywhere.
because what I think is that there is the linking of the F&O with the cash, which seems to be the problem, isn't it?
In India, all derivatives are designed to close at cash market prices, right? So that's why the futures, and that's what connects the futures prices and the cash market at the hips. We don't have options on futures. We have options on stocks. We have futures on the stocks, and the index comes from the stock. It's cash design is not an issue. It's the same design throughout the world.
Correct.
Okay, it works everywhere. The whole issue is participation. So that comes for part two.
But why will participation not come? Participation will come, right? If the issue is participation, it'll come. It'll take time.
Let's go ahead on this. Now there's a retail investor. Okay, me. Okay, we want to buy 100 shares. What are we going to do? Are we going to wait? I'll go in cash. I'll put in an order. Maybe it will trade. Maybe it won't trade. Or if there's a normal market, I'll just buy the 100 shares and get on with my life. I don't think why will a retail want to trade? Look at the pre-opening session. It is very similar to post-closing session. In the pre-opening session, we same as the order entry for 7-8 minutes and then a random closing price. None of us even look at it. Most of us don't look at it.
No, but pre-open, you don't do it, because you got a full session in front of you, right?
Fair point.
Right?
Fair point.
So
fair
if
point.
you want to take a position now and so you will do it today because if you think, yeah.
Fair point. But you had the full session right 5 minutes back.
Correct.
No,
so I have no problem. I'm saying that retail may buy at 315 or 314, right? Whatever they want to do. Correct.
Retail will finish their job by 315. My whole question is who is going to trade in this 320 to 328? That is a question I ask myself. I don't have an answer. And I'm giving some submissions for whatever it's worth. So I don't think a retail would be too excited there. Not talking about arbitrage funds. Arbitrage funds play in two markets together. One, we have a future market running fine, great. It's a normal market. And then we have a cash session where I put in an order, a trade which may happen, which will not happen. So our guy taking a trade in one place and taking a punt in the other is not ARB. He's doing something else. So I don't see the reason why ARB should be there. Now let's come to a fund manager. Suppose you're a fund manager who has 100 crore to deploy. What will you do? Will you deploy between 915 and 315? Or you going to know, I'm going to wait for cash. I'll take a chance. I'll put in an order. The trade may happen, trade may not happen. I don't see a serious investor trying to invest there. Who are the people who have a natural economic incentive to participate in cash? Are the passive funds. The passive funds who don't want any tracking error to their record.
But
so
this is but Uttam,
who will they trade with?
Yeah.
Who will they trade with?
Yeah. No. So look, I spoke arbitrage funds, etc. What they seem to be saying is that there are right now participation is low, volumes are low, and once volumes pick up, I mean it's chicken and egg, right? Volumes beget volumes. It's a network effect. I mean that's the reason why.
I agree with you. With you. But when does volume happen in cash? It happens in one split second, in that random 1 minute. Before that, you're just putting in orders, removing orders.
No. 1 minute. That is actually. There are lots of broking. I mean, the data is available, but what I'm told is it's not being. All data is available. I spoke to a large broker today who said that the problem was not on their end, but on many broker screens, right? You are supposed to display the data at any given instant. If what is that price, which is not visible on many screens. So to the point where it is going to happen at any given point in time, Uttam, and you don't know what it is, actually that is, if the data is displayed properly and there is enough volumes, I mean, it's both together. But because right now, apparently on lots of broking screens, the volume, that price is not available, at any given instant.
I've not seen other broker screen. I'm assuming what you're saying is correct. So let's take this forward. Okay, from 320 to 328, there's some indicative price. Okay, it looks like, given the current order book, this is likely to be the price, which changes every minute. And I can't trade at it. It is just an indication. Okay, the indicative price is 100. Oh, okay, I'll put it 99. Hey, the indicative price has moved to 101. Hey, I'll move my order. They'll move the order. But I'm just changing my orders. Okay, it's nice to have more data. But
this is not more data. This is basic data.
I agree. Okay, currently the thing is, the market is not active. People are not participating because brokers are not displaying the indicative price in the market. This seems to be the statement or the belief. Okay, it's a matter of time. Technology.
No, it's one of the reasons, not the only reason. It's one of the reasons.
Yeah. See, I love blaming brokers for everything. I'm a broker myself, but you brokers, it can go on forever. All right, I'm not worried about that. Then again, my submission is the only people who will be excited in trading in gas are people who expect a distorted price. So if the expected price is 100, I'll put to buy at 97 and I put to sell at 103 because there's a 3%. Ki galti se, if I get a lower price, great, I'll make money. If I sell at higher price, great, I'll lose money. But the problem is we don't want distorted price. We ideally want 100 to happen. Ideally, in my mind, the correct gas price would be the future price with the cost of carry discounted at 328. That is the closest the correct price should be discovered. It did not happen day before yesterday.
So Uttam, but you were 1 minute. You're saying both things. You're saying it's designed perfectly. This is how it works all over the world. And then you pointed out 10 mistakes with it. So which one is it?
Point is, let me clarify again. It is designed the way the world has designed it. Okay? They have taken the world design, which is fine. Will the world design work in India is a question we need to ask ourselves. It is just 2-3 days. We have to give it time. All right, we have to give time to find all the reasons why it should not work. But I am still very skeptical. मुझे डर लग रहा है. Okay, and I pray to God I'm wrong.
No, look. I take all your points, Uttam, but I mean the point about if it works all over the world, but यहाँ पे कुछ और हो रहा है because यहाँ नहीं काम करेगा. That is my. I think वो थोड़ा. Maybe it's you know.
This is exactly the belief, or this is exactly the contention. The most CB officer says, "Ki you guys are scared for no reason."
Okay, let me put an alternate view. Let me put an alternate view, and there are lots of views on this. Is that, and I think it made sense to me. So it's not my idea, but I think we had Rajesh Baheti yesterday with us, and his solution was that de-link F&O and close expire contracts before CAS. Basically de-link it. I mean then, and as volumes pick up, okay, another way to do it maybe is introduce CAS and you know, say prescribe. I mean, but it should have happened before the launch. But prescribe some notional, I don't know, some 10,000 crores in volumes or something in CAS before you actually link it with F&O. Right? There's enough volume in cash, so a decent price is found, and then you link the F&O segment with it if you want to. Keep it linked. I mean, only do it once there's enough volume. That's another way to look at it. Anyway, let me
back to chicken and egg. Anyways, please.
Yeah. Let me get in. Mayuresh is waiting and watching. Mayuresh, 3:15 के बाद market की बातें खत्म, cash की बातें शुरू.
Absolutely. No. So somebody commented, Prashant, that the RBI policy was like an Amol Palekar movie and the cash is like a Mad Max movie. So
ये तो आपने बिल्कुल ही मतलब. We have Chirag Shah also joining in. Mr. Shah, good afternoon. Good to have you with us here. First thoughts, sir. How do you see this? What we have? I think you're on mute, Mr. Shah. While you unmute, maybe I should take the opportunity to just look at, can we have the Nifty price? Because it's 328. Do we have a price? What do we have? 24,624. Okay. Do we have a price? I think, yeah, 24,624. I think we have a price. We have an adjusted price. The spot was at 24,570. So it's about a 50 point bounce compared to the 315 price. I mean, yeah, that's the thing. I mean, maybe we should put out a flash as well. In terms of the fact that the price looks like we have a price and it's 24, or is it still changing? I don't think it's changing, right? It's a small change, but I think it's just adjusting now. We'll see if there is a dramatic adjustment. I hope not. But compared to the 315 price, which was 24,570, this is about 55 odd points higher. So I think this is it. In terms of the final price. Yeah, that's the closing price, which is coming through. So 55 point premium. Yeah, there you go, on your screen now. 315, so 55 points above the 315 price. So it looks like every day that, Monday it was 200 points, yesterday was 150 points, today it is 55 points. So it's, I dare say, getting a little better, but anyway. let's just look at, let's bring in Mr. Shah. Chirag Shah is with us. Mr. Shah, go on, sir.
So, as I said, I was keenly listening to Uttam's views. Uttam and I actually go back a long way. But he still remains to be a market practitioner. I've kind of, taken a slightly different path. The way I see it, honestly, is that there is a segment or there's a section of people who participate in our markets, and there's a kind of money that is attracted to our markets. I would say that the passive funds who are now wanting to come in increasing numbers and who are attracted to our capital markets, they have a legitimate request or a legitimate ask that the way we are used to or accustomed to a certain style of how the closing prices are arrived at. Now, for whatever reason, the tracking errors and all those things are statistical issues which settle and normalize over a period of time. Now, that's I'm not going to get into that and get into any kind of conspiracy theories. We've had enough of that already. My short point is that if we are able to attract a new source of capital, and those people have a ask which is simple, which is globally accepted, then to have any kind of exceptionalism, which is, so in a way it is typical, our markets are typical in varied ways, right? So I'm not going to take that away. We are who we are. But I'm saying if we, again, to repeat, if we are able to attract a fresh stream of significant chunks of capital from a new class of investors who have a legitimate ask, which is globally accepted, then there is no harm with this process being rolled out. I do understand the volumes are not there. It's just 2-3 days, 4 days, whatever, since it started. I think started on Monday. As you rightly pointed out, the convergence is already started taking place. Now, it's anybody's guess where it's going to go. And the first expiry that we will have will be the real proof of the pudding. But I don't believe that it is such a, that it's such a big deal that we require. I think it will, according to me, it's going to normalize over a period of time. And I don't see it as a matter of any concern at all.
Yeah. Uttam, Chirag is calling that he's already heard a lot of conspiracy theories today.
I assure you, if it is not changed, sky is not going to fall. For me, today, there are 4 markets together. Number one, there's a cash normal. People who want to trade from 9:15 to 3:15, they'll trade. There's a cash. Those who want to trade, they will trade. Nobody forces you to trade. It's okay. Okay? And there's an F&O normal, which is non-expiry day, where you trade from 9:50 to 3:40 like a normal trade. The F&O expiry is something that scares me, because if a distorted price, especially in cash settled indices and options, that's true. If a distorted price is formed, with nothing gets corrected today evening, my profit loss is booked. Similarly, for stock options, which become suddenly from out of the money, in the money, or something like that, and you'll have to end up taking and giving delivery.
That is the point. That is the point.
But these are the rules of the game. If you are so scared that a distorted price may get formed, please square up your positions at 3:15. So if you want to be part of that market, and if from experience we say, even if there's some little inefficiency, we as a country decide to stick with this. Those who are not compatible with the rules of the game, which announced many months in advance, don't participate. Nobody forces you to participate. This is what I'm saying. However, a country like India, the market size like India, what is the kind of volumes which will determine your closing prices is something that still worries me a lot.
Yeah, hopefully that will pick up. And as I said, maybe it's not as if ek baar bol diya to bol diya. I mean, I'm sure regulators are also watching, and they're interacting with brokers and all of you. And they are we reported that, in terms of design, etc., it's well set, but they're watching and taking feedback in terms of what needs to be done to improve, etc. It's a new system for everyone. That I think is absolutely clear. I just want to put up the graphic once again. That graphic which came up, which is 315 and 330 across the 3 indices, Nifty, Sensex and Nifty Bank. Yeah, there you go. So the Nifty has settled 55 points above the 315 price. The Bank Nifty has settled 110 points above the 315 price. And the Sensex has settled 300 points. Yeah. Sorry, not 300 points, sorry. 80 points, right? Yeah. 80 points above the 315 price. So, yeah, that's what you have. Uttam, I have a specific question to you. Have you seen any... Okay, two questions actually. Last 10 minutes, it accounts for what percentage, typically, forget cash and all, last 15 minutes accounts of what percent share of volumes would you have, broadly the number, on any typical average day?
So I looked at the Friday numbers. I looked at last half an hour numbers on Friday, where there was non-cash. So I thought the turnover was around 10,000 crores, give or take on NSE. I may be off by 20%. So that was the volume on that day. And when I looked at the same 15 minutes number, I actually don't remember the numbers now. But then the corresponding cash. So
No. Uttam, my question is, typically, last 30 minutes, it accounts for what percentage of turnover traded every day?
Assume a turnover of 1 lakh crores a day, 10,000 would be 10%. But I don't have the numbers handy, just approximate.
Okay, last 30 minutes. No, and since over the last 3 days, have you noticed any drop in volumes?
It's 1%.
Drop in, 1% drop in.
The cash volumes are 1% of the total.
No. I'm saying, so, okay. But that's the, so overall, on a full day basis, what has been the drop in volumes?
I don't have the numbers, but that's nothing to do with cash. The total market participation during the day is nothing to do with cash, right? There's so many factors that...
No. I'm saying if the last 30 minutes is the line is 10% of a daily average, what you said, right? That 10 is now, if there were 10 orders traded, is that 10 now 5 orders, 6 orders, 7 orders? I mean, that's what I'm trying to get at in that sense. So that we'll have to look at all that, right, in terms of...
So the part of half an hour trade would have moved to 15 minutes, which is normal.
Correct. So maybe that would have happened.
I would expect 50%, 60% to move there.
मैं इसलिए पूछ रहा था, मैंने कहा 15 मिनट और मुश्किल होगा. That's why I was sticking to 30 minutes. But yeah, you're right. Last 15 would have moved to the first 15 between 3 and 3:30. That is fine. By the way, I spoke to one of the large brokers today, and they said, I asked him whether the volumes, that is without naming the broker, but that's essentially what I got as feedback.
If I can give an example, if you have a minute.
Go on.
So, when commodity markets started out, commodity markets, the spot price on the basis which the futures settle, right? Those prices were pulled for the longest time, right? Now, is it a perfect system? The answer is no, because the underlying market in the commodity spot market is disparate, very wide, very divergent, and commodity prices have an inherent issue with what is called the basis risk, right? So, but did that mean that the commodity contracts were not successful? They are now not as successful as they used to be because of other regulatory reasons or because of other economic compulsions that the government had to intervene or whatever. The reason I'm saying this is because the settlement price is one variable in the larger scheme of things. All right. So I don't see, and see, as I said, all this while before the Jane Street report came out, we were all murmuring, and everybody was whispering to the other that yaar kuch to hai yaar, matlab I don't know whether markets are really being themselves or there's something that is at play or something at work. Now what happened? Now everybody post facto, everybody's analysis will be perfect. Arey ye ho raha tha, wo ho raha tha, manipulate ho raha tha, kisi ko samjha nahi. So my only point is, the way I would see it is, of course, I would want to see more volumes in this segment. I think it will happen when more and more people realize that large funds which deploy larger amounts of capital are going to be relying on this, the prices arrived at this point in time or in this time period. You will possibly see more liquidity gravitating to this market. Why are we assuming that it may not happen? I understand where Uttam is coming from, that why should I wait the entire day to get ostensibly a fairer price, right? But the point is, for somebody, for an investor, he doesn't really anyways trade that much throughout the day. He has to sell 500 shares or 1,000 or buy 1,000 here or there. If he believes or starts believing that with this change, the prices between 315 and 330, the way they are arrived at is a fairer price, or he's not getting, or what. So my point is, the volume may gravitate there. So I think early days, absolutely. Whether it is the signs are encouraging, of course, it's a new thing. It's going to take its time to settle down. I'm 100% sure 90% of the market participants don't even know what this is about.
Yeah.
And that's
No,
why we are having
I take that point. Yeah, that's fine. Uttam, just one point. Do you trade the options on BSE expiry day?
My clients do, even I do. Yeah.
What are you going to tell them tomorrow? Because that is the problem. Yesterday also there was calls zoomed up into expiry, right?
I've told all my clients, okay, listen dear, there are two markets now. If you trade 0-day options or whatever you do, your weekly options, 315 is where you have to take a call. Do you want to punt on the cash closing? It's basically a punt. Okay, at 315, if you're holding an option, you will either say, I think the cash will go high, or it's like closing price, right? For half an hour we estimate it, and then by 325, 326 we have a damn good estimate. In this case, you won't have an estimate till 327. So suddenly, because if somebody wants to do a last trade, he's not going to expose his entire trade at 320 or 321. He's going to come at 327. You look at IPO. IPO is pre-opening of 1 hour. Just on the IPO.
By the way, Uttam, I'll tell you.
In the last 2 minutes.
Yeah, that's fine. That's fine. But in this case, there are rules against spoofing, etc. There are, which basically means that you can't show a large trade and disappear, and you have to.
No.
In the cash segment.
There's no such rule that I can't remove an order. No, sir.
You can, but after a certain point you can't. You can't spoof. The
market orders have to remain. The limit orders can be removed.
Be changed, modified.
It can be removed. See, it's like this. I put an order at 324, and suddenly at 326 there is a event. You won't make it. If you don't permit me to remove the order, fine. If that's the rule of the game, I will not put any order till 327.
So that is the thing, right? Which is the bit about the options thing, which is, and I hope that it's not a wild one tomorrow, because in yesterday there was options prices went a little berserk. One just hopes that first of all, volumes are large, price is sensible, but as for now, of course, I think as Uttam said, that's a sensible thing for anyone who's watching and who trades options, etc. That it's better not. So far, the point is every day the 330 price is higher than the 315 price, so there are no option sellers. But one day, if the price actually settles 100 points lower, they'll all go in reverse, which is it'll suddenly look very, very different.
Put will behave differently, calls will behave differently. It's all going to be all over the place. Also remember, the Nifty, if my understanding, I may be wrong, the Nifty closing is determined at the prices traded in NSE cash. The BSE Sensex closing is determined by price traded in BSE cash. So tomorrow, BSE cash segment, cash volumes will also become a very significant number to watch for.
Yeah, got it. We can go on. It's an interesting discussion. And 30 seconds, quickly. Chirag, you want to come in? Go on. 30 seconds.
I was just saying on a personal level, I also trade some options basis. I do some covered calls for the portfolio stocks that I've been holding. Now, everybody has a right to believe that he knows how things work. Okay, my point is, Theta Decay is a play which scores of investors who are long only otherwise have started deploying over the last couple of years, and I'm hearing more and more of it. So Uttam is damn right that this expiry will be the proof of the pudding whether I really want to keep my positions open to and leave it to the forces at large, right? So. But as I said, I don't fear it so much because I believe that it may take. So maybe this time I may not want to wait and I may liquidate at 314 before this whole thing starts, right? And in that way, it will help the brokerage industry because otherwise I would let it expire. I don't pay any brokerage. I don't pay any charges. But I will have to now, assuming I still
उत्तम को वापस बैकफुट पे कर दिया आपने. Anyway, I can go on, but I am time limitations. Mayuresh, thank you very much for joining us, and thank you for staying and being an enthusiastic listener for the last 15 minutes. Thank you very much, Uttam. Thank you for joining us, and Chirag, thank you for being here as well. Okay, we'll take a quick commercial break here. We'll come back, and there's more coming up. The RBI policy, of course, is the big story, so we'll get you some highlights of that on the other side. Stay tuned.
Welcome back. The RBI Monetary Policy was the big story of the day. Ritu joins in to get us the key highlights. Ritu.
Well, there was very little expected from this policy, and somehow RBI has been able to deliver even lesser. On rates and stance, unchanged as widely expected. Stance maintained at neutral, rates at 5.25%. That was a unanimous decision. But the commentary is where the surprise came in, with the governor sounding neutral to dovish as against the hawkish expectations that the street had. So, nothing in the commentary to suggest that RBI is worried enough about inflation to immediately hike rates. Apart from that, good news on the macro front. Growth forecast has been been revised upwards to 6.7% for this year. Q1 of next year is seen at 7.3%. Inflation forecast has been lowered by 10 basis points to 5% for this year and 5.3% for Q1 of next year. And inflation is expected to remain above that 5% mark from Q3 when it peaks all the way into Q1 of next year. Quickly on the commentary on the FCNR flows, they're expected to be healthy in the next 2 months as well. And there's no proposal on the table to prematurely withdraw the scheme. RBI has clarified. They also said they're not particularly concerned about any excess liquidity that gets created out of this. That could be easily absorbed. On other regulatory updates on MDR, the governor made it clear at the end of the day, somebody or the other has to pay. And even without MDR, customers are already paying. And quickly, there was this one comment made that there would be harmonization of guidelines when it came to interest rate on advances for all regulated entities, which led to some speculation that perhaps RBI may introduce external benchmark linked rates for NBFCs. But the governor quickly clarified that is not what the RBI is working on. This will be more conduct related guidelines that will come out. Here are some of the key comments coming in from the RBI governor.
Renewed tensions in West Asia, which are disruptive of global supply chains, volatility in international financial markets, and weather-related shocks, however, pose downside risks to growth. Taking all these factors into consideration, real GDP growth for this year is now projected at 6.7%.
Okay, moving on now to tomorrow and the expectations from numbers. Trent is all set to report Q1 numbers. Manglam joins in to get us the street expectations. Manglam.
Trent was one of the underperformers after their first quarter update that came in slightly shy of street expectations, 19% revenue growth versus expectations of about 21 to 22%. So the top line is what we know already. What we need to understand is what the street is working with regards to the operational performance. And out here, our poll throws up an EBITDA growth of 22%, close to about 1,050 crores, which means that the margins would be stable at around that 17.5 to 18% mark itself, and the net profit grows at 15%. An element of higher depreciation could dent the growth in net profit as compared to the growth that we're seeing in EBITDA. Same-store sales growth seen between 6 to 9%, with a large part of the growth led by obviously Zudio, and a stable performance coming in Westside. Star, which the company owns about 50%, there the revenue is likely to grow by about 10%, and low-cost inventory will protect their margins in the first quarter. Commentary around demand and margins in the second quarter extremely crucial.
Okay, all right. Thanks very much, Mangalam, for that. So we'll look at the numbers as they come out. We'll take another quick commercial break here and wrap up this segment. And thank you very much for staying with us on an extended session of Closing Bell. Thank you for watching. More coming up on the other side. Okay, well, there's just to wrap up things, right, on the Nifty in terms of 315 and 330. That's the final close. As we've been sort of, saying, today, of course, is because there is no expiry. There is, what we saw yesterday with options prices going haywire will not be the case. Today, of course, it's going to be just simply, on the option side, and the futures and option side is all orderly, no problem. But on the cash side, there is a bit of difference, as you can see, 55 points or so compared to at 330 compared to the 315 price, and 50 points in the Sensex and 110 points as far as the Nifty Bank is concerned. So that's the final. Those are the final rates which are coming through. But while we are talking about market structure, new closing mechanisms, etc., there's a whole there's the whole business of actual market stocks, earnings, etc., which has been going on as well, and that's going to be the focus here. It's a wrap. Thank you very much for staying with us on this extended coverage of on Closing Bell. But more coming up on the other side in just a bit.